for 4 years, and Pete Buttigieg was the head, and he goes bicycling to work. He takes a bicycle to work. Can you believe it? He's running the biggest air system in the world, and he takes a bicycle to work. And they say he's going to run for president. I don't see it. Who knows, right? But I don't see it. But when I look at what they've done, is so horrible what they've done. And the work they did do, they wasted billions of dollars. They're trying to hook up air systems to copper, and they tried to hook up copper to glass, and the glass doesn't work with the copper. And they had 30,000 different contractors doing 30,000 jobs. And when they put it all together, they spent billions of dollars. It didn't even come close to working. And we're going to be giving out a brand new system. It's very important. We'll have the best system, and we think we know who that system is. But we have a lot of bidding. But we want one check. We want a unified system. We don't want to have 5,000 contractors in all different places. Have in common is AI. So I don't know if that's a good thing or bad. Maybe you shouldn't do it because too many people are doing it, or maybe you should follow the crowd, fellas. Okay, so you're going to figure it out. We have a man who's here who has been unbelievable, Scott Bessent, who's our Secretary of the Treasury, and who's so respected. When he speaks on television, it's like everyone just says, "Oh, okay." I had somebody the other day said, "Well, Scott Bessent said." I said, "Well, that's pretty good, Scott." You know? So I'm a believer. I'm a believer. But when he speaks, the markets really listen. And the big thing is that we have, to me, the most important thing of all is that forget about the recent stock market being so good. Much more importantly, we have hundreds of different big companies pouring into America now, creating jobs like we've never seen before. Now, the bad news, it takes a little while for that to, you know, when you build your factory and it takes a year and a half, 2 years, and they're going to build them very fast, and they don't need financing. That's the nice part. They don't need any financing. They have plenty of it. But they're building factories at levels we've never seen anything like it. And these are, you know, 10 billion, 12 billion, 50 billion. I said, how do you spend 50 billion on a factory? We have the chip companies coming in from Taiwan. We have Jensen, as you know, coming in with 600 billion. We have actually the biggest company of them all. You know all about it. Coming in. That was a big, Mr. Wei. I said, Mr. Wei, you're a smart man, aren't you? I never met him. And I said, because I understand you control 99% of the chips. Oh, yes, I do. I said, that's pretty good. I said, is there any way of breaking that grip? They said it would take you many years. So I said, you know what? If you can't beat him, you join him. But he's going to be building the biggest factory anywhere in the world in Arizona and spending over $200 billion. And we have Apple, as you know, is coming in. And I had a little problem with Tim Cook yesterday. I said to him, Tim, you're my friend. I've treated you very good. You're coming in with $500 billion, but now I hear you're building all over India. I don't want you building in India. You can build in India if you want to take care of India, because India is the highest, one of the highest tariff nations in the world. It's very hard to sell into India. And they've offered us a deal where basically they're willing to literally charge us no tariff. So we go from the highest tariff. You couldn't do business in India. We're not even a top 30 in India because the tariff is so high, to a point where they have actually told us, I assume you too, Scott, you were working on that also, that there will be no tariff, right? Would you say that's a difference? They're the highest, and now they're saying no tariff. But I said to Tim, Tim, look, we've treated you really good. We put up with all the plants that you built in China for years. Now you got to build us. We're not interested in you building in India. India can take care of themselves. They're doing very well. We want you to build here, and they're going to be upping their production in the United States. Apple. So Apple's already in for $500 billion, but they're going to be upping their production. So it'll be great. So I really think we have, we've gone from a laughing stock 6 months ago to the hottest country anywhere in the world. And that's not just in business, that's in everything else, and it's psychologically hot too. And I just want to thank everybody for being here. I want to thank the media. The media, I have to say, has been very fair. They've been very fair. They've been terrific, actually. I was watching some of our, normally they would not say good things, but they're having a hard time saying bad, because this is a record tour. There's never been a tour that will raise, it could be a total of $3.5, $4 trillion. This, just in this 4 or 5 days, and it's from great people. And our relationship now is very strong with Saudi Arabia. Nobody's coming, nobody's going to be bothering that relationship. Nobody would be able to break that relationship because of my relationship with the Crown Prince of the family. The relationship is really strong, and when you talk about Qatar, the relationship is equal. I mean, it's just like, nobody's going to break that relationship. We have never had a relationship with Qatar as strong as it is now. You know that better than anybody. And they're very happy, and we're going to protect you. We're going to protect you. That's the one thing you need, maybe. But I don't think you're going to need too much of that. And I said last night, it was a great meeting, great everything. They brought in Lee Greenwood to sing. It was a beautiful evening, and I appreciate it. But I said last night that Iran is very lucky to have the Emir, because he's actually fighting for them. He doesn't want us to do a vicious blow to Iran. He says, you can make a deal, you can make a deal. He's really fighting, and I really mean this. I think that Iran should say a big thank you to the Emir, because the Emir is fighting very much that we don't. And there are many people that want me to go the other route. They say, just knock it out, because nobody can beat us. No, we have the strongest military in the world by far. Not China, not Russia, not anybody. We have the best military equipment in the world, and we have the strongest military in the world. If you remember ISIS, General Raisin Kane, right? We knocked it out in 3 weeks. Remember they said it would take 4 years to knock out ISIS? We did it in 3 weeks. That's because you had the right leader. With a stupid person, you'll do it in 4 or 5 years. You won't even do it. You'll fight for 4 years and then you'll leave, like we always do. You fight. We had a president that blew up half the Middle East and then he left. That was it, It was like spent $10 trillion on blowing up the Middle East and then he left. Just said, let's leave now. we're left with nothing. And we don't do that. We take care of our friends. And so you have a great ally in us, and there's nobody even close. In terms of military power, there's nobody close. And I'm not only talking about nuclear. I don't like to mention the word because the nuclear is so destructive that it brings you into a different category. But we're number one in nuclear. I rebuilt our military, by the way, in my first term. We had a really successful first term. Then the election was rigged, and I had to wait, and it became more historic, and I was able to watch and see. And the good news is although it's bad news in another way, but the good news is that Biden was so bad, worst president we've ever had by far. There was never a president like this. This man was grossly incompetent, and now that's been proven. But people were able to see how bad it is, and it gave me a mandate. We won all 7 swing states. We won the popular vote by a lot. We won the counties by 2,725 to 505. That's why the map is completely red. When you look at it, the map, it was an obliteration, this election. And we got 312 electoral votes, so it was just an obliteration. And that means mandate. And we have a mandate that nobody's had. They said the most consequential election, and this was a enemy paper, the most consequential election in 129 years. So it's been a tremendous trip. I've really liked it. This is going, we're going 20 hours a day. And people say, how do you do it? And I said, I do it because I like it. I like it. I like the people I'm dealing with. I said last night, I stood on the line for, it seemed like hours. I said hello to Larry. I said hello to Kelly. I said hello to your 250 competitors. I said hello to everybody. And that was a long sucker, I want to tell you. They say, how do you do it? I said, I do it because I like the man standing on my left. And I said it 2 nights before about the Crown Prince, but last night I had the Emir, and he's fantastic. And I said, it's really not hard. When you like the people, and when you are doing something, we have a term, MAGA, Make America Great Again, very simple term. And I remember Biden saying, we will not let MAGA take over this country. I said, no, you stupid person. It says, Make America Great Again. It's okay if it takes over the country. It's called Make America Great Again. And that's where we are right now. It's America. We'll put America first. But because we're putting it first, we're doing so well, there's going to be plenty left over to help the world. And we can help the world psychologically. So we think we're going to do well with Russia, Ukraine. 5,000 soldiers are being killed every single week on average. 5,000. And they're not from here, and they're not from the USA. They're from Ukraine and Russia. So some people would say, why are you bothering? Because these are 5,000 young people. Well, they're getting older because they've gone through so many that they are actually getting older. But these are 5,000 people that leave their home, wave goodbye to their parents. Their parents are so proud of them, their sisters, their brothers, and that's the last they ever see them. They're wiped out. And if you would see the satellite pictures, I get satellite pictures of that battlefield, and I want to tell you, I've never seen anything like that. I wish I never saw it. You have heads and arms and legs strewn all over the field. And you just take a look at that, and when you think 5,000 a week on average, and that's actually a low number. So we're going to see if we can end that. I was thinking about going, but it's very tough because of what we're doing today and tomorrow. But if something happened, I'd go on Friday if it was appropriate. But we have people right now negotiating, and I think that I just hope that Russia and Ukraine are able to do something because it has to stop. Not only the money, we spent $350 billion there. Just hand it. Nobody even knows where the money is. They just send them a check. There's no accounting. There's no one. Just give him money. Every time he came, I have to hand it to him. I think he's the greatest salesman maybe in history. Every time he came to the United States, he'd walk away with $100 billion, That's a good salesman, right? Even by your standards. This is a big standard right here. But that's a pretty good set. No, he'd walk in, leave with $100 billion. Last time he didn't do as well. He only got $60 billion. And it was so easy. It was like taking candy from a baby. That was the last administration. This administration has been a little bit tougher, but would like to see it end, and I think we're going to have a chance at doing it, and would like to see if we could solve the Iran problem in an intelligent way as opposed to a brutal way. There's only two, intelligent and brutal. Those are the two alternatives. So I want to thank everybody for being here very much, and we're going to take some questions, and perhaps now we'll ask the press to leave, and we're going to see you at the airfield. We're going to have a display of American equipment, okay? Yeah. Jennifer, go ahead.
Mr. President, no Putin speak interest. No Putin interest. Are you disappointed by that?
No, I didn't anticipate. I actually said, why would he go if I'm not going? Because I wasn't going to go. I wasn't planning to go. I would go, but I wasn't planning to go. And I said, I don't think he's going to go if I don't go. And that turned out to be right. But we have people there. Marco, as you know, is doing a fantastic job. Marco's there, Secretary of State, and we have people there. But I didn't think it was possible for Putin to go if I'm not there. Jennifer?
Do you have an update, sir, on the Sovereign Wealth Fund, your proposal for the Sovereign Wealth Fund?
That we're planning on doing?
Yeah.
Well, look, Howard likes the idea. I'm less, I want to really make a lot of money, pay off debt, and just get it, and then you do a fund, you know. These people have no debt. It's nice to have a fund. I say to Howard, we're a little early because we have debt, and really, it sounds like a lot, but relative to the kind of income and everything that we have, it's not really that much, but it's still a lot, and I'd rather pay the debt off and then do the fund after the debt's paid off. And, you know, to me, the fund is just pay off debt. We're making a lot of money. We had a situation 6 months ago. We were losing $5 billion a day on trade. Now we're making money on trade. Don't forget, we were losing $1 trillion to China, so we essentially went cold turkey with China for a period of a month. Therefore, we weren't losing $1 trillion. You know, I think that's pretty simple, Scott, right? Scott did a great job over there. They made a deal. They have great relationships with China. You might want to speak about that while the press is here for a second, Scott, the relationship we have with China.
It was a very important step in establishing a working relationship below the two heads of state. So with the tariff program, we had a plan, we have a process, and now we have a mechanism with our Chinese counterparts to prevent an escalation again. We're going to go into a series of negotiations. They're going to be fulsome, and we have a lot to talk about, but I think over the next 90 days, we can accomplish a lot.
We're going to be, I think I can mention, I'm not sure if the press will understand this, but I've devoted, I find it, number one, I find it fascinating. If you don't like things, you're not going to do well, but I do, I find it amazing. So I'm so looking forward to watching some of the power that they purchase at great price. But you'll see some jets today. Some of the reporters were in the plane. Were you in the plane as we were surrounded by 8 F-15s? You saw that? Were you concerned at all? It was a little bit spooky, right? It's a little bit different when I'm reading the name of the pilot from I'm saying the name, Rigraw. I look at you know, his helmet. He's got his name and he's waving to us, and he's like, you know, he's like where you are. And so I'm not sure I feel great about it, but we certainly had a lot of firepower surrounding, and as we were coming in, it was beautiful. And then just before we landed, boom, they took off, and nobody's ever seen it. Like, you know, they circled the plane, 8 of them, and we're landing, so now we're there. And it was really a display of beauty, and we heard it too. We were in the plane. I said, what is that? Because they stepped on the gas, because it's hard for them to only go 500 miles an hour. That's called very slow. It's not that those planes they're not meant to go 500 miles an hour, but it's really good. Great pilots, great display. So we're going to see that. But one of the things for the people that are interested in the military that I asked to look into, the F-35, we're doing an upgrade, a simple upgrade, but we're also doing an F-55. I'm going to call it an F-55. And that's going to be a substantial upgrade, but it's going to be also with 2 engines, because the F-35 has a single engine. I don't like single engines. Even this man, he's the best in the world at engines, but on occasion, I know you won't admit this, if an engine goes out, it's nice to have 2, 3, or 4. That's why I like the 747. It's got 4. And but today they're getting very big, and it's a little more cost saving to have 2 very, very big ones. But no matter how good, they tell me, Larry, the engine will never go out. Well, I think it goes out on occasion, very rarely. And we're going to do an F-55, and I think if we get the right price, we have to get the right price. And that'll be 2 engines and a super upgrade on the F-35. And then we're going to do the F-22. I think the most beautiful fighter jet in the world is the F-22, but we're going to do an F-22 Super. And it'll be a very modern version of the F-22 fighter jet. And I don't know if you know it, but you know who copied it? China. They copied it. I said, I'm looking. They said, that's the F-22. They copied our design. But they won't be able to copy our engines too quickly or anything else. So we're going to be doing an F-22 Super. And this will be a plane like no, to me, it's the most beautiful fighter jet ever made. And so I want to do that. And sometimes, stealth, they do stealth. I'm not a huge believer in stealth, because stealth is basically, a lot of it's the design and the shape. And, I'm sure you maybe think, but also if that's the case, they're going to figure it out pretty fast, I think. So you're going to design an ugly plane for stealth reasons, and then 6 months later, they're going to figure out this, and then you're stuck with a plane. Now, we're doing a super F-22, and we're going to be going with it pretty quickly. And then, as I told you, we're going to be doing a tremendous variety of drones, from lots of very inexpensive drones, and on the F-55 and on the F-35, but much more on the F-55 and on your plane that you're doing, which he calls the F-47. F-47. I said, how'd you come up with 47? That's an interesting. It was very nice, actually. But you said there's a tremendous capability for it. Travels with many, many, potentially hundreds of drones, right? Do you want to talk about that? Because it's very interesting to people.
Well, the F-47 is the first 6th generation fighter in the world. We're very excited to be developing that, and we'll be bringing that into production in the near future. There's not much I can say about that for security reasons, but we're very pleased to be in the development process of that airplane.
Yeah, it's going to be great. It's got a beautiful weapon out, as you say. We're also doing very heavy on submarines. We have a lead on submarines that I don't think, unless you have a really, really stupid group of people, including the president, I don't think anybody can catch us on submarines. We have our submarine, in particular, the late model. We're 15 years advanced on the submarine. Nobody can even come close. It can stay underwater for 30 years. Think of it. The only reason it has to come up is for food. It doesn't need water, because they have their system of water, which is, they can stay forever. The only reason it has to come up is for food. Can you imagine? It could stay underwater for years, going at fast speeds, to very fast speeds, but it has to come up once every couple of months for food. There's something about that. I don't know if we're going to be able to solve that problem, but hopefully it's not going to be a problem we have to worry about. But the submarine, we are so far advanced in the submarine. So we're very proud of it, and we've taken a country that was scoffed at, and we're the hottest country in the world right now. We're going to keep it that way. And just in finalizing that, the military was having 6 months ago, and you wrote about it, Jennifer, I saw an article, but the military was having a very hard time recruiting people, our military, and they were not able to even come close to their goals. That was only 6 months ago. And now, as you also have written, we have a military that we have so many people want to get in. We've never had anything. They say 30 years plus, because they only go back, but probably ever. We have never had such excitement to join the military. So we went with a military that couldn't recruit very easily and was really way, way behind, to a military where we're actually picking the people we want. And it's very hard to get in. It's actually hard to get in. And that goes for the police force and the firefighters. I always mention the firefighters. They're incredible. But the police force and the firefighters, we're having a very hard time getting people to become policemen like we had never had before. That was 6 months ago, Biden, because the country had no spirit. It was like just had no heart. It was a dead heart. Now we have the liveliest heart you've ever seen. So I just think it's such a great contrast to think 6 months ago you couldn't get, and now we're setting records. Who would think that could have happened? Thank you very much, everybody. Thank you.
Okay, we have wrapped up the press conference that the president has been conducting. Part press conference, parts speech, dealing with a whole series and a vast range of issues. Just in terms of some of the headlines that have come out of it that are market moving, we are certainly seeing the Iran comments getting close to a deal, though other options are on the table, having a significant impact on the oil market. We'll come back to that. He talked about India. India apparently has offered to drop all tariffs, so pay attention to that one as well. We'll see how that one develops. And when Besant speaks, the markets listen.
Yeah, he also talked about Apple, didn't he?
Oh, yes.
He's
Yeah,
been weighing in on Tim Cook's manufacturing destinations.
Yeah.
Don't build in India.
Yeah, exactly. Weighing on him, pushing him not to build in India, to build in the United States instead.
And those comments moving the Indian rupee tick by tick, not a massive move. I think for me, at least, the highlight are two key theses, which is, of course, he talked about Iran. He said that this is a two-step process. He doesn't want to get to step two, but that a deal is looking likely. That was enough to move the markets to the tune of 3.5% on Brent. He also talked about Ukraine and this idea that he didn't think Putin would attend if he didn't attend. So if appropriate, he may consider going to Turkey on Friday. So of course, we'll keep everyone apprised of those headlines and how that all fans out. In the meantime, while he was speaking, we did have the European markets open. Let's get an instant analysis if we can. Nanette Hetschler-Federb, EMEA CIO at Lombard Odier, joins us this morning. Nanette, a pleasure to have you on the program. Thank you for your patience as we listen to the President of the United States. There are a lot of geopolitical headlines. The concerns around the deficit have fed back into the market narrative as well. For you, what is top of mind in terms of trading this market?
I think really now it's all about yields. In the recent days, obviously, as rate cut expectations by the Federal Reserve maybe got reassessed, global bond yields moved up, U.S. Treasury yields moved up. But I think for the market to continue really building on this more constructive geopolitical setup and also much more compromising trade setup, it will be essential to see also those global yields, bond yields coming down. So this is really top of mind for me. And then I do think that risk assets continue to be on a very constructive trajectory.
If yields continue to move higher, though, can risk assets, and by extension, I think you're probably meaning stocks. Can stocks continue to rally if we see high yields and higher yields and higher yields?
I think there must be a limit here. And I would just say I'm really expecting that now macroeconomic data in the US are going to show a slowdown in the second quarter, in the third quarter. And you contrast basically the real yield level at above 2% for 10-year US Treasuries, for example, with where GDP in the US is likely to stay closer to 1 or 1.5%, something in these ranges, and yields are bound to come down. So I'm really quite positive that there is going to be a move back. But even if yields were going up, we saw from recent past that equities can also overcome that hurdle if benefits, if obviously the earnings are strong enough to sustain that. So I think it's very important to continue watching here how much export and activity, economic activity, the new administration is really bringing to the United States.
And Nanette, are you staying away from oil stocks right now? Energy stocks, the worst performing sector this morning. Oil prices down by more than 3% in today's session because of geopolitical headlines around Iran, because of what the president has just said around Iran. A very soft price environment for oil is how Francisco Blanche at B of A described it to us earlier.
Yes, we would agree with that. I think that oil prices are headed lower. I think that supply is going to continue rising. And that is, on the one hand, very good for consumers in the U.S. That have first to absorb increases in certain goods prices because of the tariffs. So energy prices coming down is very critical. And that is not very good historically for the energy sector, for sure.
We'll leave it there. Nanette, thank you very much indeed for your patience listening to the President a little bit earlier on and answering our questions afterwards. Nanette Heschler-Feder, the EMEA CIO OD at Lombard ODA. This is the challenge. If yields come down because growth is slowing, is that good for equities? Maybe not. How good an inflation hedge are equities if yields continue to move higher as well? There's lots of kind of unknowns at this point in time. At the moment, the rally is in equities. Does that continue? Can that continue with higher yields?
There were periods where you used to get stocks rally just because we expected rate cuts, so if growth slows sufficiently, then maybe that's the case. But I don't know, a lot's changed since that period.
It absolutely has, because inflation, although maybe Jay Powell would disagree with this, is no longer the primary concern for a lot of these corporates.
And not with oil prices down 3%.
Exactly. Now it's a growth concern. It's ultimately keeping that market share, keeping a consumer engaged in terms of purchases, despite some of the kind of cost pressures that they may face. More analysis after this break. Stick with us. This is Bloomberg.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
This is the opening trade, about 30 minutes into today's session. Seeing some softness in these markets across the board. I'm looking at a stock 600 that's down about 0.4%. The losses concentrated in the DAX and the FTSE 100 as well. Some of that is the oil story, really reacting to perhaps what we saw or heard, I should say, from Donald Trump in Doha, talking about the gambit when it comes to China, India, Ukraine, Iran. All of that covered.
So the oil story's big impacted this morning. We're going to hear from Val in just a second by what is happening with the Iran comment. So it's going to be really interesting to see how that one feeds through as well. But Trump, it's interesting to hear that his kind of view on what is happening with the trade deals as well. Are we heading towards zero with India? He talked about that. That would be an amazing development. Does that take us below the 10% minimum tariff level that he's talked about as well? What happens on that front as well?
Yeah, he gave us some tantalising suggestions about what the Indians may have committed to. He said he gave us his view on what they committed to in terms of the trade deal with India, which we know is a very live conversation. I thought it was interesting, given the amount of focus we've done around yields and where the long end of the curve goes. Interesting that he said the focus for me is not on creating a sovereign wealth fund, it's on paying down debt. And that's something that maybe the market is going to be listening to a huge amount. And we also had lines on Ukraine. We've been focused on whether he might go to Turkey to talk about Ukraine-Russia with Ukraine-Russia today. That doesn't seem as if it's happening. But he mentioned Friday, so maybe there's something we still watch for on that front.
He also implied that Putin's not there because he's not there.
Yeah,
I can't quite work out how the choreography on that one works. But anyway, let's get back to the markets and figure out exactly how the market's perceiving all of this. Valerie's here with the details.
Guy, we saw continued declines in oil, both Brent and WTI hitting session lows on those comments from Trump you guys were just discussing around this Iran deal. Seems to be dragging down on the oil price. This is Brent crude behind me, down some 3.1%. We also saw declines in the Bloomberg Dollar Spot Index. That was spurred seemingly around his comments about India wanting to drop all of their tariffs on U.S. We saw the Indian rupee jump slightly, the dollar soften slightly on the back of those comments. But that's the wrap from Trump there when it comes to the market reaction. I also want to keep an eye on what's going on in the long end of the Treasury curve. Those 30-year yields really flirting with 5% here, and this is something to keep our eye on. I think this is telling us that the market is really trading off of deficit concerns around this tax bill making its way through the House instead of tariff concerns. I think this is really a sea change in what's driving the market as we eye this tax bill making through the House. Even the House Speaker saying they want this bill done by Memorial Day, and that's less than 2 weeks away.
Okay, taxes perhaps a focus in the United States then rather than tariffs. Valerie, thank you very much. Bloomberg's Valerie Teitel with her analysis of what we heard from President Trump, the market impact, and also other themes dominating market thinking right now. What does this mean for the global economy? Let's talk to Christian Keller, Head of Economics Research at Barclays. Christian, good morning. Now, you've been listening a little bit to what President Trump was saying there in Doha, just as we have. And one of the things that stood out and has caught the market's eye, oil prices were already weaker going into that press conference, and they weakened further as he talked about Iran. Now, we don't know where that one ends up, I suppose. But I guess with oil prices dropping so quickly, what kind of upside? Is it upside? If they drop this quickly, is it upside for the global economy?
For the global economy as a whole, given that there are more oil importers and exporters, typically that is upside because, energy goes into everything, and that typically is a good thing. I mean, we've been seeing so many deals. I almost feel like saying it's a dealflation, right? We're dealing with it. But oil lower is certainly positive news from an aggregate global perspective.
And from the U.S. perspective, President Trump is quite animated about wanting lower oil prices. I was just wondering, are you increasingly factoring lower oil prices into your modelling for the years ahead?
We do. I don't know necessarily for the years ahead, but, for us now, it looks like we're working with a lower oil price scenario than we had before. It is very important. I think for Trump, it's very important because he does know if we don't go to zero tariffs, that there will be some increases in CPI because of the tariffs. And, of course, if they can make it up by having lower oil prices, that then would, imply that headline doesn't go that much higher. That's very important to keep the consumer happy. The consumer in the U.S. very much looks at the pump price and more than anywhere else in the world, really.
Talk to us a little bit about more of that. I mean, Anna there was talking about the tax policy, perhaps, at least in the last 24 hours, getting a little bit more attention than the tariff policy. Just walk us through the math there. Donald Trump is making the argument that the tariff policy works if you get tax cuts on the other side domestically, which he has the GOP backing for. Does that math work? Do tax cuts equal, or even tax cut extensions, equal or offset the impact of tariffs?
Many things here. I mean, first of all, the tax cut extensions, I think everyone has baked them in, but they cost around $4 trillion or so over a decade. Now, it depends on where we land on the tariffs. If we now hear that possibly there could be a zero tariff with India, you wonder where are we going? Are they really saying we have a minimum, let's say, universal tariff of 10% in order to generate revenue?
Yeah.
Or, are we, walking back on all of this? The less tariffs we have, the less income. I think the market now is mostly focused whether we get additional tax cuts in the U.S. beyond the extension of the TCJA. And that, in a way, I think, is one reason why also yields are moving a bit up, because it does look as if there's a lot of ambition to cutting tax beyond that. And that would imply, you live in the U.S. with deficits of 6-7%, with a slowing economy possibly higher.
Yeah.
A debt ratio that continues to go up. And markets are wondering, are there any efforts, in a way, to deal with that dynamic?
So when it comes to the real economy, we talked about kind of the tariff versus tax cut argument that the Trump administration is making. Let's talk about a different argument that they're making when faced with that question of yields ticking higher. A Trump official would make that argument that if yields tick higher, it's offset by the lower gasoline prices that you're seeing, the drop in oil prices for the end consumer, even if pricing may get a little bit more expensive. Or is that math that offsets each other?
But you have the consumer that consumes and it looks at prices. So if CPI is lower, that helps. You also have a consumer, however, who wants to take mortgages and buy a house, etc. And there, the 30-year rate that your colleague just referred to is very important. So I think, will it offset? It really depends. I mean,
What are they more sensitive to, though? Is it that mortgage rate, or is it that oil price, the gasoline price, the price at the pump?
Ultimately, 70% of U.S. GDP is private consumption, and private consumption is very dependent on a lot of it is on energy. Longer term, however, if you look at the housing market, if you have a higher 30-year rate permanently, and you have these mortgages that don't allow really for people to refinance or finance new housing, that will have an impact as well. You have to then say really where's the level, where do we end up to make up whether one offsets the other. But they're certainly walking in different directions.
Do you see a cheaper dollar going forward?
The dollar is a good question. There have been so many gyrations. I think in the short term, everyone was always caught on the wrong foot, going into the year thinking the dollar is going to be strong, tariffs add to dollar strength, then thinking, oh my God, the U.S. is so radical that there was a shift out of the dollar globally. By the time everyone got short the dollar, we got the China deal. Now everyone again got wrong-footed, was short the dollar. That's why you saw the shift back. We think in the longer term, there is now a view, I think, among international investors that may want to be more diversified, diversified out of the U.S. dollar. And I think longer term, that doesn't bode well for continued dollar strength.
Why is that? Is it because they don't trust the United States? Is it because they're worried about deficits? Or is it ultimately that the global economy needs to rebalance? And the easiest way to do that, you could argue, is not via tariffs, it's by the dollar. If you reduce the value of the dollar, you change the whole dynamic. Is the dollar the easiest way to get to the kind of balanced economy that Donald Trump and many within the U.S. administration are ultimately looking for?
There's some debate of that, how much the strong dollar really led to what, the administration, has criticized a lot, the downturn of the manufacturing sector, et cetera. I mean, the U.S.
is consuming a lot, and one of the reasons it can do that is because of the strong dollar. If you want to reduce consumption, one of the ways you do that is just by changing the dollar dynamic.
The exchange rates are important, and if you look at the dollar over like a 40-year horizon, we've never seen dollar strength in real effective terms. So we like to look at it. The only time you saw peaks like this was in '85 and in 2001 or so, and we are at a peak now. You would think that is likely now to go in more likely to go in the other direction than to go for the further strength.
So the logical thing to do is the administration is denying it, but is the logical thing to basically say to your trading partners, we would like a weaker dollar?
Yes, that would be. I would doubt, however, as I said, that the U.S. deficits in trade are really driven that much by the dollar. There's a saving investment balance, and I think the U.S. is not addressing that one.
Yeah.
And taking us back to trade then, Christian, I was just looking at lines, the EU's Maros Sefcovic, who of course manages the trade brief, talking about how he's going to meet with Howard Lutnick, and he's had another call with Lutnick yesterday. We've had our expectations managed about how slowly we get to a Europe deal on trade. How much does it matter to Europe? What's the sort of downside for the European economy that you're pricing in if we don't see a deal done on trade?
The downside is quite large, and Europe, in a way, seems to be at the very end of the queue. They keep emphasizing this. I think the Europeans also don't want to rattle the boat before the NATO summit on the 24th, 25th of June. It's very important for the Europeans, because that whole security issue is very, very key to them, and I don't think they want to upset Trump before that. But then afterwards, there's not a lot of time between the 25th and the 9th of July.
And the 9th of July is when the time expires.
The moratorium ends. That can always be extended. But the rhetoric out of Washington that the Europeans are, I think as Trump put it, in many ways more nasty than the Chinese, all that, I think, indicates that the negotiations will be difficult, but they're important. The European economy has 20% of its GDP are exports, many of them to the US. It's an open economy, and the sectoral tariffs on autos hurt it a lot. We'll see what's coming on pharma, very important for the Europeans. So they have a strong interest in really dealing with this, much more, for example, than the UK economy, which has a trade deficit with the US, actually.
Talk about the labor market for a moment. There's been a lot of questions of that, of when a trade war, the fear of just an absolute trade stoppage or blockage, similar to what we saw in COVID, for example, would show up in the labor market. We haven't seen businesses reacting that way. In fact, we're likely seeing the opposite. In Donald Trump's press conference just moments ago, he actually made the comment that some of these deals that are coming from the Middle East would include 3 or 4 million jobs creation in the process. At what point does the labor market break down?
The labor market without a recession, and we took out our recession for the US, is actually going to continue to remain quite robust. And I think the interesting part of the US labor market is now the supply side. We have no longer seen the kind of inflows that we've seen over years, which were very high. So there's no more fresh inflows, and you keep, having 150,000 jobs a month or so, which we think will slow, but you keep having positive numbers. It is unlikely that the unemployment rate will go up much. And that's a very interesting perspective now for the US, that they may have a slowdown without that much of an unemployment rate going up.
We got a technical recession, a technical contraction in the GDP, though, in the last quarter. If we were to hypothetically get that again, does it matter that the U.S. would be hitting a technical recession if we don't see the layoffs to match it?
And no, frankly, these technical recessions, I mean, the first quarter in particular that you mentioned, where you had a 40% increase in exports, amazing, huge front running of exports that then automatically, mechanically drives down your GDP. We know that this will revert in the second quarter, so you get a better number in the second quarter. The technical definition of a recession, if there is no impact on the labor market, is really not that relevant. That's why we think the Fed will only cut once this year, probably towards the end of the year.
Why would it cut? If you've got a labor market that looks pretty strong and you've got an inflation picture that looks reasonably benign, why is
Well, you
could
argue
give me a reason for moving.
Yeah, you could argue that the economy is slowing, and you have a tightening of financial conditions if for example, the back end of the curve stays high. So that's why we have one cut.
Is inflation a bigger problem for the Fed now? Therefore, if the labor market's solid, is inflation the bigger problem?
It automatically becomes a bigger problem. If you think underlying inflation is very dependent on the labor market.
Yep.
We now think the tariffs as we have them, which is 10% on the rest of the world, about 30% on China. We think you end up with still above 3% core PC inflation by the end of the year. And that then we see coming down over 26. Now, if the labor market remains strong and there's a lot of demand, the fiscal deficit doesn't come down, who knows? Maybe inflation remains sticky above 3. Then the Fed may cut once or twice.
But they have to hike in that kind of environment.
It will try to avoid hiking as long as it can.
That would make life politically quite interesting. Christian, great to see you. Thanks very much indeed. Christian Keller, Head of Economics Research at Barclays. Coming up, President Trump has said he'd still travel to Turkey Friday if peace talks move forward. He just spoke in Doha. I think he's now on the way, I'm assuming in a beautiful helicopter, to the biggest US military base in the Middle East. You're looking at live pictures coming from there. He will speak there again shortly. That's next. This is Bloomberg.
much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico this way or that way. It will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Welcome back to the opening trade, 47 minutes into our European equity session. That maybe has slipped our attention a little bit as we've been listening to President Trump a lot this hour. But this is where we are on the European stock story, down by 0.4%. Weakness in energy stocks, weakness in basic resources, all of that really to do with the weaker oil price. We're down by 3% on the Brent price right now. And Chrissy, President Trump has been talking, as I mentioned, a lot this hour and hitting a number of themes.
Absolutely, talking about serious negotiations with the likes of Iran on a nuclear deal. Reports of that had moved the market earlier. He spoke earlier this hour in Doha.
Iran has sort of agreed to the terms. They're not going to make, I call it in a friendly way, nuclear dust. We're not going to be making any nuclear dust in Iran. And we've been strong. I want them to succeed. I want them to end up being a great country. So we'll see what happens. But we're in very serious negotiations with Iran.
Horizon's Middle East and Africa anchor Jumana Bersetchi is on the ground and joins us to cover the presser and kind of the comments coming out of there. Jumana, walk us through what he said with Iran. And again, there were pieces of this kind of floated via various parts of the media earlier in the session. What's changed? What's the latest?
Yeah, so let me string it all together for you. So let's just recap exactly what President Trump said during that press conference in Doha a short while ago. He did say, I think we are getting close to doing a deal, but then he also said, you probably read the story that Iran has agreed to the terms. Here he's directly referencing an interview that was conducted by NBC overnight. An advisor, close advisor to the Supreme Leader, sat down, and the journalist specifically asked a question about what deal terms that Iran would be willing to accept. The first question was whether they would accept lower enrichment levels to civilian level type of enrichment. And the second was whether they would accept closer inspection from international monitoring agencies. And they said, the advisor said yes. So when Trump was giving this press conference, he referenced specifically some of the comments that were put out overnight in the last 24 hours. That's not to say that there hasn't been a lot of progress. We know that 4 rounds of talks have taken place between the U.S. and Iran. And it's becoming clearer now that Iran seemed to be open to the idea of no further enrichment from these levels. The whole aim of these discussions from the U.S.'s perspective is to ensure that Iran does not develop a nuclear weapon. And with 60% enrichment, they are months away from being able to develop what the IAEA estimates is about 4 to 5 nuclear weapons. So they want to stop it in their tracks. At the same time, this is something that President Trump has brought up as well in this GCC leader meeting yesterday in Riyadh. He said that it's also important, another condition is that they stop sponsoring quote-unquote terrorism via proxies, the Iranian proxies in the region, a direct reference to Hamas, to Hezbollah, and to Houthis. So there is a two-dimensional approach going from the U.S. here. And whether or not Iran are going to be open to accepting those terms is a big question mark. But from what we can gather, especially from the comments now that Trump made at the press conference, it seems that they are moving in the right direction. But at the same time, there are people within the Trump administration who would like to see the U.S. go further. The Israeli prime minister would have preferred for full dismantlement of the nuclear program. If they only come up with a lower level enrichment, is that going to be enough to satisfy the hawks in the Trump administration?
Okay. Well, oil prices are certainly responding to some of these headlines, aren't they, Jemana? And we see that down by around 3% on Brent right now. So we've heard a lot about geopolitics. We've heard a lot about attempts to find peace in various different theatres in the Middle East and wider. What about deals? President Trump was surrounded in that press conference we heard in the last 50 minutes by important U.S. business leaders from the aviation sector in particular. What have we heard on deals?
Yeah, big flashy numbers. So we had the 600 billion figure from Saudi Arabia with a pledge to increase that to $1.2 trillion worth of economic agreement, quote unquote, with Qatar. That is not the same as deals. The real number for deals in Qatar is something closer to about 254 billion. And you spoke about this earlier on the show, that big record-breaking Boeing order that came through from Qatar Airways, valued per the White House at around $96 billion. That was a major breakthrough, both for Qatar Airways and for Boeing, the U.S. manufacturer. But then also we saw more deals being inked on the defense front, around $38 billion worth, a $1 billion deal with Raytheon. And as we speak, President Trump now is making his way to the military base, the Al Udeid Air Base, about 45 minutes away from Doha. It is the largest U.S. military base in the Middle East. So defense, obviously still an important focus of some of these agreements that are being inked in the Middle East. In a couple of hours, he makes his way over here to Abu Dhabi, where we're expecting more of these types of announcements.
Jemana, thank you very much. Horizon's Middle East and Africa anchor Jemana Basech waiting for President Trump to arrive in Abu Dhabi a little later today.
Absolutely. So, as we saw a little bit earlier on, flanking the President of the United States, the CEOs of Boeing and GE Aerospace, Kelly Ortberg and Larry Culp, two important figures on this deal, as we see this huge order coming out of Qatar Airways, 210 wide bodies. It's a huge moment for Boeing, and let's get some analysis on how significant it is with Bloomberg's Benedict Campbell, who leads our global aviation coverage. Benny, just talk to us about how important this deal is. We knew that the CEO of Qatar was going to place a big order. We didn't know it was going to be this big. Obviously, politics and diplomacy interacting with the business story. How important is this for Boeing?
Well, it's obviously a huge deal, and Trump likes to tout these big numbers. At one point, he said it was worth $200 billion. That's obviously not quite where we're at, but it's nevertheless a big deal. The White House now saying it's $96 billion. 130 787 Dreamliners, 30 777Xs, and then another 50 options that they might turn into firm orders. So all told, 210 aircraft. That would be, as you said, the biggest order yet in terms of value. There have been bigger in terms of numbers of planes ordered, but in terms of sort of wide-body jets, and those are the big, long-range, expensive planes. So for Boeing, that's a big deal. It's important to win an anchor investor, as it were, with Qatar. This is obviously a very successful, large sort of halo airline. They had a similar deal about 2 years ago in Dubai at the Dubai Air Show, where Emirates placed another big order for the 777. So this is an important win for Boeing to cement its dominance in the wide-body market, where they still have an edge. If you look at the duopoly between Airbus and Boeing, Airbus has very much pulled ahead on the narrow bodies, on the A320 versus the 737. We've obviously heard a lot about the issues on the 737, but in wide bodies, that's where Boeing still has an edge. So this was very important for them to bring this one home.
Benny, walk us through just how difficult or easy it is for Boeing to actually fulfill these orders.
Well, these are obviously huge numbers, and it will stretch well into the next decade to get these fulfilled. Right now, the monthly cadence of the 787 is about 6 units. They obviously want to raise that, but they have to get all their ducks in a row, as it were, at the factories, and that's going to be tough. Kelly Ortberg, the CEO, he has said he's still worried about the supply chain. It has to perfectly, it has to work. Any disruptions, through tariffs or other things, that would obviously be a problem. So getting the orders is not easy, but that's one thing. Actually getting these orders out of the door, that's going to be the tougher part. And that's something they're working on very hard. Ortberg has managed to improve the overall factory output, the quality, the speed, but he'll have to keep that going if he actually wants to get off this huge backlog that stretches, as I said, into next decade.
Let's see how it all unfolds and actually how Boeing shares react at the U.S. Open. We thank you so much. Benny Campbell there, our global aviation editorial lead, joining us out of Berlin, Anna.
So we are waiting to hear once again from President Trump. He's going to be speaking again in Qatar. We are also getting live images of President Macron speaking at a JP Morgan event in Paris. The French president saying, he's speaking at the Choose France summit. He's saying there's no longer a level playing field between the EU and elsewhere. We will later on from that event be bringing you a conversation with Jamie Dimon, Chairman and CEO of JP Morgan Chase. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Newsmakers and market movers. This is The Pulse with Francine Lacroix.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in Paris at the JP Morgan Global Markets Conference, and these are your headlines. Donald Trump says India has offered to drop all tariffs on U.S. goods as the deal-making continues on his tour of the Middle East. The pound gets a boost as the UK economy records its best quarter in a year. But the dollar and treasuries face pressure as the billionaire Steve Cohen puts a chance of a U.S. recession at 45%. Plus, Vladimir Putin snubs peace talks with Ukraine as he sends a low-level delegation to the meeting in Turkey. Now, we also have a great lineup of guests joining me here today from Paris, including JP Morgan's head of global market strategy, also the chief data and analytics officer, and then a little bit later on, we'll be speaking to the chairman and chief executive, Jamie Dimon. Also, definitely a buzz here as we're still listening to Emmanuel Macron, the president of France, speaking in the room just behind me. But before we get to news, before we talk about recession risks, let's check your markets as always. Stocks actually falling globally. Again, traders await a speech by the Fed chair, Jay Powell. Also, U.S. economic data coming out later today. Those will give us clues on the sustainability of recent market recovery. The other things that we're watching out for is, of course, signs of a possible recession. That would, that's the main question, to see whether equities then push higher or not, amid optimism around de-escalating trade tensions with China, but also a bit of optimism regarding this U.S. deals in the Middle East. You can see S&P futures down 0.4%. Let's also take a look at the European market snap. Now, I know there's a bit of relief across the board because we're mostly through earnings season, and that was tough in terms of forward guidance to try and figure out what we saw. Stocks stumbling a bit. Again, maybe that changes with the speech from Jay Powell and the data out of the U.S. Now, President Donald Trump says India has made an offer to drop tariffs on U.S. goods as the Asian nation seeks an agreement on import taxes. Now, Trump was speaking earlier at an event with business leaders in Qatar as part of the Middle East tour. Now, the U.S. president also spoke, or said he spoke, with the Apple chief executive Tim Cook to discourage him from expanding production in India.
I had a little problem with Tim Cook yesterday. I said to him, Tim, you're my friend. I treated you very good. You're coming in with $500 billion, but now I hear you're building all over India. I don't want you building in India.
Well, President Trump also says the U.S. is in serious negotiations with Iran.
Iran has sort of agreed to the terms. They're not going to make, I call it in a friendly way, nuclear dust. We're not going to be making any nuclear dust in Iran. And we've been strong. I want them to succeed. I want them to end up being a great country. So we'll see what happens. But we're in very serious negotiations with Iran.
Bloomberg anchor Jumana Bersace joins us now from Abu Dhabi. Jumana, what's the president been saying this morning?
Yeah, well, two bits of market moving information. Let's attack them one by one. First of all, the comments on India, interesting. Obviously, the Trump administration is riding high on the momentum that they had in Geneva this past weekend. With that new Geneva mechanism, constructive talks between U.S. and China, now President Trump going further and suggesting that India are looking at potentially dropping tariffs on U.S. goods to 0%. So that also would be a major development, not least because earlier in the week, the sounds coming out of the Indian Commerce Ministry suggested that they were looking at imposing higher retaliatory tariffs, i.e. they were taking a more assertive role with the U.S. It seems to have worked. Their strategy has worked. President Trump suggesting now that they're looking at lowering tariffs. And we expect to hear more developments there because the Commerce Minister, the Indian Commerce Minister, is actually making his way to the U.S. for further negotiations later this week. So a positive development on the trade front. But then also take a look at the price of oil. We're down about 3% this morning. President Trump also saying in that Doha press conference that they are potentially getting close to a nuclear deal with Iran. So this is the first time he's articulated that. There have been 4 rounds of discussions between the U.S. and Iran about a nuclear deal. In an interview yesterday, one of the advisors to the Supreme Leader did seem to suggest that they were willing to accept lower enrichment levels of nuclear material, in addition to further inspection from international monitoring agencies as conditions to getting that nuclear deal across the line. So things seem to be moving in the right direction, and that is why you're seeing that reaction in oil prices today.
So, Jumana, what's next on the agenda for the president, but also leaders in the Middle East?
Yeah, so we were just referring to President Trump's press conference in Doha. He's still there now. He's actually headed to the largest military base that the U.S. have in the Middle East. It's called the Udeid Air Base. So he'll be visiting there perhaps in the next 15, 20 minutes, doing a tour. This on the back of some of the big deals they signed in Doha. Economic cooperation pledge, I should say pledge, not actual deals, worth $1.2 trillion. But in terms of deal value, he's walking away with around $250 billion worth of deals from Qatar, including the largest ever Boeing order from Qatar Airways. This is a record-breaking order valued at around $96 billion per the White House. They say it will create about 150,000 jobs, and obviously is a very positive step for Boeing, the U.S. manufacturer, which has been set back by multiple issues over the last year. So that was a big announcement that came out. And then after that, he will be making his way to where I am right now, Abu Dhabi. And on this side, in the UAE, we are expecting, again, more announcements and also more potential deals inked in the AI space, Francine, because that was one of the breakthroughs that came through from Saudi Arabia, the fact that the Trump administration are open to now sending some of these high-end chips to these GCC countries to help power and fuel their AI ambitions. So we're watching out for that over here in Abu Dhabi.
Jumana, thank you so much. Jumana Bersachi in Abu Dhabi. Now, the International Energy Agency has just released its monthly oil report, saying it expects global oil demand growth to slow for the rest of 2025. Well, I'm now delighted to be joined by Troll Bozzoni, head of the oil markets at the IEA. Troll, as always, thank you for joining us, but it's so nice actually to see you in person and do this interview in person. Now, what are the chances of actually an oil glut this year?
Well, we're seeing clear signs that the global economy is slowing and oil demand growth is slowing. We had negative demand growth in China, hardly any growth in India for the past few months and in other Asian countries. So we're expecting oil demand growth for the rest of the year around 700,000 barrels a day. And while supply, as we all know, OPEC has announced that they will increase production, accelerate the unwinding of production cuts, and we're still seeing continued increases from non-OPEC producers, including the United States and Brazil. So the way our market balances are looking right now, we're seeing an oversupplied market for the remainder of this year and extending into 2026.
So, Tara, what happens to the market if OPEC plus does increase by 400,000 like expected on June the 1st? What happens to the oil markets?
So what we're seeing, we do expect the increase to be slightly less than the nominal increase, both in May and in June, because a lot of the countries are already overproducing. That's including Kazakhstan, the United Arab Emirates, Iraq, and also Russia in the latest month. And a lot of some of the other countries are bumping up into capacity constraints. So we're expecting a slightly lesser increase, but we're already seeing the market pricing in this higher supplies and this oversupplied market, which is one of the reasons we're seeing oil prices falling about $14, $15 over April and into May before recovering somewhat. And we're seeing other producers responding to the lower prices, in particular in the United States. The earnings season this year, the financial reports, we're seeing a lot of the independent producers cutting their spending plans for the year, laying down rigs. So we're expecting lesser growth in the United States in response.
But, I mean, I think there's something about, like, OPEC could actually increase production by 400,000 or a little bit less, but thereabouts until October. I mean, that's not priced in the markets right now.
Yeah, so we're seeing, I think the market is expecting the increases, is particular from Saudi Arabia. The biggest increase will come from Saudi Arabia. But of course, the market is also looking what's happening in Iran and Venezuela. We're seeing the United States putting increased sanctions on those countries. And while negotiations are underway in Oman for a nuclear deal, there's a lot of uncertainty what will happen to Iranian supplies. Latest month, for April, we did see Iranian exports continuing at relatively strong rates of about 1.6 million barrels a day. But we are seeing China taking less of that. So it's a question if we will have a significant supply loss with the new sanctions that are being put on regularly now over the past few weeks.
But so if Trump does reach a deal with Iran, how much idle capacity comes back online?
So it's a question. We're seeing now Iran Iranian production about 3.4 million barrels a day in April. We think their capacity can be slightly higher, 3.7, 3.8. So there could be more, a few 100,000 barrels a day of supply to come. The question is more if sanctions are lifted, if there will be other buyers other than China that comes into the market. So, and alternatively, if sanctions are really new Chinese independent refiners and ports have been put on the sanctions list now. So if that pressure is maintained or even increased, we can see lower exports from Iran. So there's a lot of uncertainty there, depending on the deals that are being made and negotiated at the moment.
So Troy, for the moment, it feels like it's quite difficult actually to price a U.S.-China kind of normalization. But if prices stay low, does it kill off growth from U.S. shale?
We have reduced our U.S. shale forecast for the second month in a row this month due to the lower prices. And as I said, it's the U.S. producers already announcing cuts up to 9-10% in their capex spending from what they had planned earlier in the year. So we have cut our shale forecast by about 200,000 barrels a day for 2026. The biggest impact will come next year, not this year. So we do expect growth this year. Next year, we may see a decline in shale for the first time since 2020. And this is in response not just to higher OPEC supplies, but also to the weaker economic outlook and lower oil demand growth expectation as a whole.
Troy, thanks so much. As always, Troy Bozzoni there from the International Energy Agency. Now, you can hear the crowds actually leaving that Macron speech here at the JP Morgan Capital Markets Forum. And so the loudness, and actually there's really a buzz here as they talk about the global economy and possibility of recessions. Now, trade chiefs from some of the world's biggest economies are competing for access to U.S. Trade Representative Jameson Greer as they look to advance negotiations with Washington at a gathering in South Korea. Our Chief North Asia correspondent Stephen Engel is there for us at the APAC meeting in the island of Jeju. Stephen, thank you for joining us. It's less than a week after Jameson Greer helped the U.S. and China agree on a temporary cut in tariffs. Are other countries now hoping for a similar deal?
Yeah, that's absolutely right, and that's why we're here as well. We were here early this morning. It's all obviously into the evening now, and Jameson Greer, the U.S. Trade Representative, was the first of the major officials that we saw come in here. He said he wasn't doing media right now, but again, he's here for 2 days. He still might sum up what he talked about and who he talked about after tomorrow's closing of the trade ministers gathering here on Jeju Island in South Korea for the APEC 21 member economies. And what we do know is he has already met with the South Korean trade minister. Obviously, South Korea and the United States are working at a possible trade deal of their own. But also, we've heard he's met with Lee Chang-gang, who is the Vice Minister of Commerce for China. He is essentially the trade representative, the counterpart to Jameson Greer, whom he met in Geneva, and the two of them across the table, along with Scott Bessent and He Lifeng of China, came together with that trade truce for 90 days, obviously. So for those two gentlemen to meet and have a talk within about 5 days of each other is a positive sign. We don't know the exact details of their conversation behind closed doors here at the International Convention Center of Jeju, but the fact that they met again to perhaps flesh out further agreements is a positive sign.
It certainly is. Stephen, thanks so much. Stephen Engel there in Jeju in South Korea. Now, coming up, we'll be joined by JP Morgan's head of global market strategy for an exclusive conversation on where he thinks markets are heading. That's next, and this is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome back, everyone. Now, the French president, Emmanuel Macron, says there's no longer a level playing field between the EU and the rest of the world. Now, Macron also says the relationship with the UK must be totally reinvented. He's been here speaking at the JP Morgan event in Paris. Well, JP Morgan was the first big US bank to expand a presence in France after Brexit, and Macron met with the chief executive, Jamie Dimon, earlier. Now, we're now joined by Dubravko Marcos-Bujas, head of global market strategy at JP Morgan. Thank you, Dubravko, for being here with us. Congratulations on another successful global markets conference. I mean, if you're in global markets, I don't know how your heart is holding up, because there's been quite a lot of volatility. Has it been good volatility for JP Morgan or not so good?
So first of all, thank you for having me. I think volatility has been manageable, and I think along the way it's created a lot of opportunity. We've seen a ton of dispersion, especially beneath the market, and I think that in itself sort of creates a lot of opportunity. Obviously, you just have to be very smart about it, focus very much on risk management, because things keep being thrown at you from like left and right.
Yeah, and they change very fast. So have you had to change some of your systems on what to look at?
Yes, I mean, I think if there's one thing that we're sort of learning along the way is you sort of have to keep a pretty open mind. You have to stay very nimble. I think forecasting beyond sort of like a month or 2 or 3 is really hard. So, one of the things that we've been sort of focused quite heavily on is just kind of scenario analysis and thinking about different types of scenarios that sort of play out if certain things sort of crystallize or not, and then sort of try to position and sort of put out views along those lines.
What do you think we know? And I mean, it feels like there's a lot we don't know, but are there certainties that you see in the markets?
So I do think that there's definitely more clarity than than sort of say a few weeks ago. I would say high level, the left tail of the distribution, I'm going to keep it pretty big here, has definitely been truncated and cut. And the distribution of outcomes were extremely wide several weeks ago, and I think that's been narrowing as some of the sort of uncertainty around trade, tariffs, policy sort of started to get reined in. I would probably say there's a good chance that the detox period that the U.S. administration has been talking about to a large extent is behind us. I don't think we're fully out of the woods yet, but the focus is now very much so turning towards tax cuts, which has been high on the president's agenda. Deregulation is still there. And so we need to see how things play out there, because the fiscal backdrop still remains a very sensitive backdrop in the U.S. And you never know. You could have sort of surprises and risks, especially on the bond side.
Yeah, I mean, I was going to say, actually, treasuries were behaving sometimes, there were a lot of question marks on how they were behaving, on what they were behaving as. And then there were a couple of, bond auctions that you weren't sure who was buying, because one didn't go so well and then the other one went quite well. How do you treat treasuries right now?
So I think it's hard to have a lot of conviction. I think it's hard to deploy a lot of conviction on the rate on the bond side. Look, the move up in rates recently has been relatively quick and abrupt. Fed expectations have gotten reversed. We've sort of pushed out our view around sort of future Fed easing to basically back end of this year, starting in December. But again,
so one cut.
Four times, but starting in December, and then sort of going into 2026, keeping in mind the Chair Powell mandate ends sort of halfway through next year. So I think you really need to pay close attention to how the fiscal backdrop evolves, how the deficit discussion evolves, what the House, the Senate end up doing on the tax side along with the president, because you could have the bond vigilantes trade sort of back in the game. 10 years sort of back to 4.5, 4.6. We're not that far from 5. And if you sort of start going back to 5, that could start creating, again, issues for various parts of risky markets. And risky markets, whether it's equities or credit, it's enjoyed a very, very strong sort of comeback over the last few weeks. So that's something that we're paying very close attention to.
Would you worry more about credit than equities?
I would not worry. I would worry more about equities than credit. I would sort of make a case that credit probably remains sort of the superior asset class here with the most attractive risk reward. We as a bank, as a research department, remain generally positive on the credit side, especially in the U.S., where I think a lot of the things continue to go in the right way for the asset class. And frankly, if you envision a scenario of, let's say, no recession, we're able to dodge a recession, but the growth backdrop remains challenged, sort of sub-trend, I think that's one of the perhaps best environments actually for credit, especially areas like high grade.
Are we able to dodge a recession? I think still Steve Cohen this morning had it like 45% probability. That's pretty high.
It is pretty high. I would probably throw my own view at about 35%. Our economists might be a little bit higher. Stock market might be flying something a bit lower. So I would say it's below 50, and I think it's definitely sort of come down. I think we can probably dodge it. Our forecast call for a negative growth quarter in the back half, third quarter, but then fourth quarter, we believe things again resume on the positive side. In 2026, probably will be able to eke out some growth. So we're not out of the woods, but we think the left tail again has gotten cut a lot, and most likely recession, we should be able to dodge one.
Any opportunities in Europe?
Well, I think it's a tough one. I think Europe has a ton of upside potential, but I think a lot of homework needs to be done. I think a lot of it depends on execution. President Macron just basically talked about that. Revisions to things like capital formation, I think, is very important when you sort of think about innovation prospects, growth prospects, and making Europe more competitive on a global landscape and versus a heavyweight like the U.S. So I'm hopeful as a European, but a lot of homework needs to be done. I would say sort of aerospace defense, it is a bit consensus, but I definitely think there's still a lot of upside there. These are secular themes, and a lot of these companies could become a lot bigger in size. And then I think, there's definitely a question mark around areas like luxury, which historically has been hot. I would say not all of luxury, because some things are pretty expensive at this point. But that's the way I would go about it.
I know we have a lot of questions from viewers, for example, on German bonds, right? Because of the defense spending, but the Chancellor seems weakened. Again, when you look at FX and bonds in Europe, is there anything that looks attractive?
Well, we think that there's still upside in terms of like downside for dollar, upside for the euro. Not a lot, maybe. Our convictions are not as high as they were, but generally still, I would say, an upside trade. I think as far as Germany had sort of these debt breaks on. Now they're sort of being released. We're talking more about a fiscal, thrust kicking in, both in terms of defense as well as in terms of infrastructure. We need to see how much of that stays in Europe in terms of like the multiplier. But I do think that the German bond market, in terms of supply, actually looks quite attractive, and maybe in some cases more attractive than sort of the U.S. side. And I think the demand should be there, right? So I'm not really that worried about that.
This is, one of the questions is, U.S. supremacy, what happens to dollar as a reserve currency? Could this be the time for European leaders? I know, Emmanuel Macron at your conference was a little bit downbeat, but could this be the time for Europeans to take it seriously and try to push Europe?
Yes, I do think the opportunity set is definitely much bigger than previously, because a lot of what used to be headwinds facing Europe, I think there's a case to be made that they're turning into more of a, call it tailwind or semi-tailwind. The potential is definitely there. I still think the dollar remains a reserve currency to a large extent. U.S. exceptionalism got sort of hit a bit along the way, but I think we're going from sort of this hyper exceptionalism to still relatively strong exceptionalism. The U.S. brand got hit, but I still think remains intact. So I think the opportunity set still remains quite strong on the U.S. asset side, so I would not dismiss it. And the one thing we haven't talked about, frankly, is AI. I think AI theme remains a power theme, and Europe, unfortunately, I don't think has a very strong footprint there. I think there's potential for Europe to invest more, but it's really, I think, down to the U.S. and China. And U.S., I will say, just from a global perspective, does have a pretty strong first mover advantage, just in terms of how much money and capital has been thrown into the sort of AI complex, including on the private side.
I mean, it's interesting. I'm glad you brought up AI, because there does seem, because of the trade wars between the U.S. and China, the AI story is being looked at the markets, but maybe not looked as it was 4 months ago. Is there a danger that the market just focuses on one thing and misses sometimes the bigger picture, the bigger trends?
No, I think it is. I frankly think AI and sort of technological disruption sits at basically the center of just about everything, right? And so I think that's going to continue to create a lot of dispersion. We're going to have winners, losers, and so I think it's really important to sort of pay attention to this theme and see how it basically intersects with basically all kinds of sectors, because it's touching everything. It's touching not just sort of the broader technology complex, infrastructure, it's touching healthcare, it's touching the consumer space. So it's touching all different fronts. Industrials. I think that's the elephant in the room here.
Dubravko, thank you so much for joining us. That was Dubravko Lakos-Bujas, head of global market strategy at JP Morgan. Now, coming up, Donald Trump's efforts to secure peace in Ukraine hit a roadblock as President Putin snubs talks in Turkey. We'll have the details next, and this is Bloomberg.
In case you missed it on Balance of Power.
If we're going to get all this revenue from tariffs, why would the president be pushing for higher taxes on anybody? Because our understanding is for the wealthy, he's looking at a new rate of 39.6%. And I thought the Republican Party didn't stand for that kind of thing.
Well, you realize that the tariff revenues doesn't count toward the reconciliation numbers. Don't ask why. I can't understand why. We're running at like 20, 25 billion a month, and they're not counting it, but we'll leave that aside for another day. This is Washington. They have their own accounting practices. So the president's trying to make sure he gets no tax on tips, no tax on overtime, and no tax on Social Security. And if he says, look, the richest Americans, remember, he cut it from 39.6 to 37. So if he just goes back to what he did last time, I'm in favor of that. I think it's smart.
Don't miss Balance of Power live every weekday.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua at the JP Morgan Global Markets Conference in Paris. Now, Donald Trump says India has offered to drop all tariffs on U.S. goods as the deal-making continues on his tour of the Middle East. The French President Emmanuel Macron tells the JP Morgan Global Markets Conference here in Paris that European Union must revamp its alliance with the U.K. Plus, Vladimir Putin snubs peace talks with Ukraine as he sends a low-level delegation to the meeting in Turkey. Now, the Russian President Vladimir Putin has named a group of low-level officials for peace talks with Ukraine and Turkey, giving no indication that he plans to join negotiations. Now, this comes as top NATO diplomats are meeting elsewhere in Turkey, where the Secretary General Mark Rutte has said the ball is firmly in Russia's court.
Ukraine is ready to commit to a ceasefire and immediate negotiations. That's absolutely clear. The ball is now clearly in Russia's court. They have to explain what they are doing, why they are here or not, and with what team or whatever. But let's make sure that we all understand that the ball is in their court. Ukraine is wanting to start the negotiations as soon as possible. And as I said before, it is thanks to the Americans and President Trump that the deadlock has been broken.
More on that NATO meeting shortly, where Bloomberg's Piotr Skolimowski is standing by. But first, let's bring Greg Sullivan, Bloomberg Russia economic and government editor. Greg, hi. So Putin waited until very late to name his delegation. What do we know about them, and what does it tell us about, what's going on?
Well, that's right. Speculation had been building that President Putin could actually attend these talks, these direct talks that he had actually proposed last weekend. However, late last night, the Kremlin did name the delegation. As you said, it was a very low-level delegation. Likely, these are not people that are empowered to make decisions. So that's likely to tamp down any expectations for a major breakthrough. In a lot of ways, it's signaling a very slow and cautious approach to any kind of negotiations with the Ukrainian side. But there's still a lot that we do not know about these negotiations, including who from the Ukrainian side will attend, when these negotiations will happen, and including what format they'll take place, whether it will be direct engagement between the two sides. So a lot of questions remain, even as we know that it's a relatively low-level delegation with few hopes for a major breakthrough from the Russian side.
So, Greg, what is Putin looking for in these talks?
Well, one thing that's interesting about the delegation that he named, it's being headed by someone named Vladimir Medinsky. It's a delegation that largely reflects the same delegation that went to earlier talks in Istanbul after the start of the war in 2022. Those talks obviously fell through, but they could signal that Putin is looking to restart negotiations where they left off. Throughout this process, Putin has really stuck to maximalist demands. He sees himself making slow but very costly battlefield gains, having the military advantage. So he's largely stuck to very tough demands that Ukraine is unlikely to accept, or that will be very hard for Ukraine to accept. So that's one possible thing. Another thing that we should be looking for is a very technical engagement that could lead to some sort of future engagement, including possibly Putin joining negotiations down the road.
Thank you so much, Greg Sullivan there. Now, Piotr, the uncertainty over these peace talks dominating, of course, the NATO meeting today.
Indeed. So NATO foreign ministers are meeting here in Antalya in Turkey, also in Turkey, for an informal meeting, which is sort of a preparatory one for the summit. Will happen in Hague next month. And obviously the question of whether those talks between Putin, Zelensky, and whether there are going to be talks between Russia and Ukraine and Turkey as well, they were dominating the discussions as we went into the meeting. Generally, foreign ministers from NATO countries criticized Putin for not showing up. They pointed out, to what they called an empty chair in front of Zelensky, who is going to come and he's ready to get involved. At the same time, the main topic for the discussion here is that Trump has called on NATO allies to spend 5%, to raise their defense spending to 5% of GDP. This is the goal that's very ambitious. Even the US doesn't meet that goal. And they're here to discuss how to achieve that. So there's clearly the willingness. We also heard from Foreign Minister of Germany a very, very strong statement saying they will follow the US. So they're obviously very much in line and very much in condemnation of where Russia is on those talks and ready to play ball when it comes to more defense spending that the US is demanding.
Piotr, thanks so much. Piotr Skolimowski there from the very latest on this NATO meeting. Now, Boeing has landed its biggest ever aircraft order, with Qatar Airways agreeing to buying up to 210 wide-body planes. And the deal was signed during Donald Trump's visit to Doha. The White House says it's worth $96 billion. Now, for more, let's bring in Bloomberg's Benny Kamel, who leads our global aviation coverage. Benny, good morning. So how did politics and business actually intertwine on this deal? Are we seeing aircraft diplomacy on display and at its finest?
Yes, absolutely. So this has been a trip of dizzying numbers. He started it off in Saudi Arabia, and then yesterday, Doha. That's where the big Boeing deal was announced. We'd been hearing about it for a while, but in the end, it ended up being even larger than we expected. So it's all told 210 aircraft. That includes firm deals and options. So if they were to throw in the options and actually turn those into firm deals, that would be 210 aircraft, almost 100 billion in terms of value. So this is obviously a huge number, much to Trump's liking. He likes to throw around these big numbers and the kind of deals that he throws in. And for him, as you said, it's been very much sort of the blend of politics and economics, sort of economic statecraft, if you will. And planes have featured very heavily in that. We had a small deal in Saudi Arabia. We had some military deals. And then we had the big one yesterday. And the one that's still kind of looming, the slightly curious one, is what will happen to the Air Force One jet that Qatar is allegedly considering as a gift. We have no clarity on that yet. But again, that was sort of one of the stranger episodes and also had to do with planes, which are very much something that Trump cares very deeply about. He's a big plane buff. So this was very much sort of a blend of all things that he cares about.
Yeah, so Benny, where does this leave Airbus and its own aspirations for a deal?
Well, at the moment, it looks a bit like a winner-takes-it-all kind of deal. You have this blowout accord with Boeing, obviously very happy faces on that side. Will Airbus be able to come back? That's the big question. They might do so at the Paris Air Show. That happens next month. That's typically a forum where Airbus can shine. So maybe Qatar, they are a big buyer of Airbus planes. They might come back. They fly the A350 aircraft. They fly the smaller A330 aircraft. So they could come back. But it's unlikely that you'll see these kinds of numbers coming out of Airbus as well. So in this case, this is very much Qatar throwing its weight behind Boeing, and that's why it's such a decisive win for the US manufacturer.
Benny, thank you so much. Bloomberg's head of global aviation, Benedict Kamel. Now, JP Morgan has been ramping up its use of artificial intelligence along with other U.S. banks. That's as technology transforms the way millions of people, as you and I, do their job. Now, joining us now is Teresa Heisenreiter, the Chief Data and Analytics Officer at JP Morgan. Teresa, thank you so much for joining us. I mean, you're really at the forefront of one of the things that's probably most transformative and exciting. What surprised you the most since you took this job?
So we think that AI has the potential to really deliver amazing scale and efficiency as well as client benefits. So it's a real priority for us. And we've been very focused on this for a long time. We've used traditional AI and machine learning in areas like fraud detection and risk management and marketing. But the big surprise has really come with generative AI, which really opens up new possibilities for us. We, I think, were one of the first in the industry to really roll out Gen AI to the majority of our employees. So we have 200,000 people who use this now as part of their everyday work.
What does this look like? So do I ask a question that can help me do my job on a day-to-day? And this is proprietary JP Morgan things.
We've set it up in such a way that you can use the benefit of the models with JP Morgan data. So that's really where the value comes from. We think data is what differentiates us. And so people are finding ways, whether it's lawyers looking at contracts or bankers preparing presentations for clients. What it's doing is really freeing up time and capacity. On average, we're seeing people gaining an hour to 2 hours of productivity a week, which is really quite significant, and we're really still in the early stages.
I mean, it feels like, so you have an added support, right? It's like an extra assistant.
It's like having your own personal assistant, exactly.
Teresa, how does that change, hiring plans in the future? So without actually talking about job losses, will it lead to less hiring?
So at the moment, we're still in the very early stages of the technology, so it hasn't had any material impact on workforce or hiring. Over time, there is the potential that there'll be some job dislocation, but we really think that this is a tool that just makes people more productive, so we should be able to grow and do more with less investment, and that's really where we see the value. In the long run, ours is a business that's based on trust and relationships, so people and having the great talent is always going to be a priority.
Is it difficult to put a number on that productivity or on job losses in the banking sector as a whole?
I think it's really still early at this point. I think that we will see significant productivity gains, and the question is, does that open up the opportunity to just expand and grow and do new things? I think a lot of that capacity will get absorbed in growth.
Teresa, what does that mean for your models in markets, for example? Does it change how you see risk and things like that?
So we've always used AI and algorithmic analytics in our trading businesses for pricing and hedging. I think what's changed is now we can bring Gen AI to supplement that as well. And that's allowing us to really give our sales and trading teams better, quicker information because we can synthesize news and social media. We're also working on behalf of clients to let them have interfaces that allow them to look at the great wealth of JP Morgan research and get insights much more quickly.
So again, what does that look like? Is it words, for example, the number of words used? I know we used to, when I started news, actually, that was one of my first jobs, is counting the number of words that, the Fed president or the Fed governor.
We can look at Fed minutes and analyze them very quickly now and look for themes in the news and associate. Gen AI can look at data across different modalities, and just the ability to synthesize and aggregate information to drive insights is really very innovative.
I know there are a number of central banks that are looking, for example, at potential regulating or that have worries. The Bank of England launched a paper a couple of weeks ago on AI in banks. How do you look at regulation or trying to make sure that you have a good handle on it?
Yeah, we've been very actively engaged with regulators around the globe, and we think we have an important part to play in helping them formulate safe AI policy for financial services. I think where our industry is very different than others is that we have a great prudential framework that protects market integrity and end investors, and the same is true in AI for trading. I think there are very well-established rules, and I think we'll continue to see the same outcome-based regulation take effect here as well.
Teresa, coming back to actually JP Morgan employees, how do you teach them how to use AI? I know your chief executive has said, look, AI will never fully replace humans.
Right.
But I guess our skills will have to significantly change as AI increase.
We agree that the skills will likely change over time, and that's why we've been so focused on putting the technology in people's hands. There's no better training than actually using it, and we've introduced a lot of training. We want people to develop those skills to be effective as AI becomes even more and more embedded in the way we work.
Thank you so much for joining us.
Thank you.
Is, of course, Teresa Heisenrether, the Chief Data and Analytics Officer at JP Morgan. Now, coming up, can Alibaba keep up the momentum for Chinese tech when it reports earnings later? We'll have a preview next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Next week, Bloomberg brings you live coverage from the Qatar Economic Forum. Bloomberg Horizons Middle East and Africa and The Pulse will be broadcasting live from the conference floor. Then, throughout the day, we'll bring you all the highlights from the key policymakers and market movers on the issues confronting the global economy. Live coverage from the 5th edition of the Qatar Economic Forum starts Monday, right here on Bloomberg Television. Context changes everything.
We don't have the same exodus symptom in Europe in any way whatsoever. So the reality is that European companies continue to list in Europe. London-based companies continue to weigh their options. I can tell you that among the few companies that were waiting 6 months ago or 1 year ago, prospects of being listed in Europe versus the US, I had dialogues with all of them. They are fundamentally revisiting the US options because the level of uncertainty over there.
Well, that's the Euronext chief executive speaking to Bloomberg a little bit earlier. Now, Chinese tech companies are enjoying a good week. Solid earnings from Tencent and JD have added to the momentum from a U.S.-China trade thaw. Now, it's now up to Alibaba to keep the rally going as it reports results today. Well, Bloomberg's Tom McKenzie joins us with a preview. Tom, so good to see you. Alibaba has had a stellar year. What can we actually expect from earnings?
Yeah, Fran, the stock is up 56% year to date, despite, of course, all the concern in April about the impacts on tariffs. And Alibaba is, of course, that touch point on the Chinese consumer. It is the largest e-commerce company, of course, there, but also it's a touch point on the question of the innovation around AI and how effectively they're rolling out products on that front, and how effectively they're actually integrating AI into their own businesses. And then, of course, they are also a touch point on the impact on trade and tariffs, to what extent they're absorbing some of that increase in tariffs, even after, of course, that easing of tensions over the weekend. Top line, we're expecting net income for the most recent quarter to come in at $3 billion, around $3 billion, on revenue of about $33 billion US, which would put Alibaba on a good footing. And as you say, Tencent coming out with that beat earlier in the week, JD.com's CEO as well, saying that they're starting to see an improvement amongst Chinese consumers, some optimism from JD.com with their revenues up about 16%. So on all those touch points, Alibaba is interesting. I think the cloud division is going to be particularly in focus, as is the logistics business. On cloud, it's going to be about AI and how much demand they're getting from their enterprise customers.
So can it actually sustain, Tom, the AI frenzy?
Well, what they're able to do and have effectively done is continue to iterate around the models they're pushing out as they try and compete with DeepSeek in the Chinese market and others in terms of the large language models that are being produced and the labs that exist now in China. And they're keeping up in terms of that competition. They continue to iterate. In fact, they came out with 2 changes to one model, 2 upgrades in just a single month. And then the question is, to what extent can they drive margin gains, again, as they create those efficiencies, better targeted advertising, better connections between their merchants on their platforms and the end buyer as well. So those are all the kind of details that we were looking for around the AI push. But Alibaba is front and center, certainly, in terms of China's broader ambitions to be a leader when it comes to AI products and innovation on that front. So details and what executives have to say as well, given that Joe Tsai, one of their team near the head of the board, of course, on the board, has suggested that he's starting to see a slowdown, and maybe there's a bit of a bubble in terms of that data center demand. So what we hear from executives, as well as the details that come out on terms of their investments around AI, how much capex they're putting to play there, and the demand they're seeing from their customers.
Tom, thanks so much. Tom McKenzie there with the very latest, of course, on some of these tech companies. Now, Siemens has reported a jump in revenue and profit, driven by a recovery in factory automation sales in China. Now, the German manufacturer also confirmed guidance that revenue this year could grow as much as 7%. Now, the chief executive, Roland Busch, has been speaking to Bloomberg's Oliver Cook.
The tariffs this is not stable, as you know. They change from one day to the other, and based on what we know, we obviously dive very deep into understand what the impact on our numbers would be, and the conclusion is here very limited. And here comes the reason. Number one is we have a very, very strong manufacturing all over the world, also in China, in the United States and China. In the United States, we have 80% of local for local value. Then we have measures in place. So in some cases, we're also pushing higher costs through to our customers. We increase the prices as our competitors do as well. In some cases, we have even contracts which allow higher commodity prices to go through to the prices. We work on our cost savings as well. So all in all, the impact on Siemens so far is limited. The largest impact is eventually by Siemens Healthineers, as I explained. And this is a reason why we kept the guidance. There are secondary effects, for example, that the supplier of our suppliers might increase the prices, and that comes to us. Hard to say, we cannot calculate it yet. And of course, if there's higher inflation in the United States and the growth rate would go down, would be an impact too. We took that all into consideration and came to the conclusion that we can keep our guidance as it is so far.
And also looking into the future, because one of the sort of main objectives of the tariffs and the Trump administration is to bring a lot of manufacturing jobs back to the United States, building new factories, updating factories. There has been some skepticism about some of the announcement in terms of how real those sort of deliveries are going to be. You in your digital industries business, this is factory automation. Are you seeing any evidence of a surge in sort of desires? Have you been having conversations with manufacturers who are trying to expand their footprint within the United States? Are you seeing any evidence of that happening?
So not yet is the short answer. Of course, we see some momentum in, for example, semiconductor industries, which are many-year projects and they're in place and they're ramping up. But if it comes to really manufacturing of any kind of parts for automotive and the like, we don't see it yet. Reason is that the uncertainty on where these tariffs are finally ending is so high that people say, let's wait and see before we invest. Number one. Number two is if manufacturing comes back, we strongly believe it will be highly automated. There are limited trained labor available in the United States market, and that will not change going forward. So what would you do? You would automate and digitalize as much as you can. And this is where Siemens comes into play. We have a very, very strong portfolio, also for the United States, supercharged now with AI technology. We can simulate everything, the products, the plant, before you build it, and really drive it in a digital twin way in order to optimize productivity, save costs, but also working with less labor. So therefore, we believe there will be an inflow of more investment in the United States. By the way, Siemens, we invested too. We recently opened a plant in Fort Worth, in Texas, for data centers for electrification. So we see more coming, but it's too early to say, but it will come.
And moving from the United States to China, the last time we spoke, you started to see a few bright spots within the Chinese economy. What are you seeing in China?
So if you talk the automotive industry, this is really muted, if not China. China is really picking up momentum in automotive industry. We see that, and this pulls a lot of also machine building, machine tools, and automation. So there's also the private consumption is gradually starting. As I said before, it will not be a step up, a steep step up, but a gradually step up, and we see that China is picking up momentum.
The Siemens CEO there, Roland Busch, speaking to Bloomberg's Oliver Crook. Now, Walmart reports earnings today with analysts and investors focusing on how the world's largest retailer is responding to global trade tensions. Now, let's get more from Bloomberg's Charlie Wells. Charlie, it's our daily wrap-up for retail. What do you have?
That's exactly right, Francine. Now, we are counting down to these earnings because Walmart is such a bellwether for broader consumer sentiment. We can see that Walmart has been outperforming the S&P 500 this year, and Walmart tends to perform better in periods of uncertainty because consumers really razor in on price. That is something that Walmart is well known for, but we're looking out for any surprises here at Walmart. There are expectations that same-store sales at Walmart could trend down in the quarter, so we're looking out for that, but we're also focusing in on the impact of trade here. That really is what analysts and investors want to know about. We got a little bit of a sneak peek at Walmart's Investor Day last month with their CFO talking about their import mix, talking about how about a third of the products that Walmart sells in the United States are imported. Their key sourcing comes from China and comes from Mexico. We know that for this quarter, at least for a while, those 145% tariffs were in effect. So that is an issue that we're going to want to unpack here. And on that call later today, we may hear analysts talk about shortages. That is a topic that has certainly been in the air. We know based on external reporting that executives at Walmart and other big box stores talk to the White House about this issue of shortages. That is unlikely to be addressed publicly. But when you look at the traffic into the Port of Los Angeles, such an important port of call for goods from China, you see that traffic dropping significantly. So that could speak to some issues there. But another question that we're really likely to hear later today is how Walmart, where price is so important in the context of these tariffs, do they plan to pass on price hikes to the consumer or eat into their own margins?
Charlie, thanks so much. Charlie Wells there with the very latest on some of the shipping and, of course, retail concerns. Now, there's plenty more to come here from the JP Morgan conference in Paris, including an exclusive interview with the chief executive, Jamie Dimon. That's at 1 p.m. London time. We leave you with these live pictures in Qatar of the Al Udeid Air Base, the largest U.S. military installation in the region. We believe the president could address the crowd shortly. This is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
And Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes out in this discussion is in the crypto area where the regulators said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Good morning from our global headquarters in New York. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. Fading enthusiasm, global stocks snap a 7-day winning streak as markets await Chair Powell. A deal in sight. Oil drops as the president says that U.S. and Iran are inching closer to a nuclear deal. And a read on the state of the American consumer. U.S. retail sales are on deck with earnings from Walmart also coming later today. Now, it is a stock market rally that seems to have run out of steam. We barely moved into the green with the close yesterday, really led by tech. Today, it is declines. It is waning enthusiasm. S&P 500 down more than 0.5%. NASDAQ 100 leads the losses, down 0.8%. Perhaps a more interesting move, though, has been the bond market. The sell-off continued yesterday. That eases this morning, but look where we are for your 2-year yields. We are still above 4%. That is the highest level since February. Your 10-year yield also still above 4.5%, the highest closing level since January, and the 30-year yield getting really close to 5%. These are the worries, the levels that had worried the administration prior, and now it's really fiscal concerns and easing back of Fed cuts that seems to be moving this bond market. Let's take a look under the hood and look at the stocks that are moving in the pre-market session. With that, as always, is Bloomberg's Joe Easton. Good morning, Joe.
Morning, Danny. So there's big news in the sports retail space today with news that Dick's Sporting Goods potentially going to be doing a deal for Foot Locker in the US retail space. That bid price potentially $24. Take a look at Foot Locker stock, though, up 69% almost in the pre-market, sitting just below that price. We might even get news of that deal confirmed later today, according to the report. Then in terms of United Health, this one looking weak on report of a potential probe into Medicare fraud. We are seeing United Health stock. Bear in mind, we did just have JD Sports up, that one rising with Dick's Sporting Goods. United Health, though, lower today on news of that probe. The company says it is cooperating with the investigation. And finally, Cisco touting the AI boost to their systems in their latest earnings, seeing a jump up in the orders. Kind of just throw in the word AI in every earnings report these days. But we are seeing Cisco rising following that earnings report. That one higher in the pre-market by around 4% this morning. Danny.
Does that still work? I thought kind of the days of just saying AI and your stock going higher was over.
I think it still works today. We're seeing Cisco up a little bit. Maybe a bit of a buzzword on that one, Danny.
Joe, thank you so much. Over to Joe Easton. We'll catch up with you later in the hour. Also in this hour, in just moments, we'll be speaking with Ella Hoja, head of fixed income at Newton Investment Management, and later in the hour, Mark Malik of Siebert Financial. Now, I mentioned the stocks have not only reversed their drop since April 2nd, but the S&P 500 is nearly 4% above its pre-Liberation Day levels. The bond market, though, telling a different story. 10-year yields are still nearly 40 basis points higher, while 30-year yields are hovering around 5%. Joining us now is Ella Hoja, head of fixed income at Newton Investment Management. Ella, great to see you this morning. What story is the bond market telling us?
Good morning. I think last month we talked about the year of the roller coaster, so I think this proves this is exactly that. So we've gone from the extreme fear of recession, which we're pricing certainly in the front end of the U.S. curve, as early as maybe 3-4 weeks ago, and we're now swinging to the other dimension, which is potentially fiscal concerns. So I think bond markets are telling you that as we remove this tail to the more extreme case scenario on growth, we potentially are engaging with the other tail, which is quite concerning for bond investors, and that is obviously, can we deal with this additional supply that's coming to markets? Can we deal with the fiscal burden broadly? So not just in the U.S., but more broadly across the world. So I think that's the story, Danny.
Well, these are the levels around 5% that last time got the attention of the Treasury Secretary, Scott Bessent. And of course, it was a president and Treasury Secretary who said, we don't pay attention to stock markets, but seem to pay attention to bond markets. It's much more orderly this time. But can this be a bond market that forces some fiscal discipline into Washington, D.C.?
Well, I mean, Typically, that's the case, right? And we had a bit of volatility during April that seemed to cause some concerns. But I mean, as you say, this is a lot more orderly. If you're arguing that it's pricing less cuts from the Fed and a more benign economic setup, then you can argue perhaps it's too far to extrapolate this into discipline. So I think we're quite far from that. But of course, if repricing continues significantly higher from here, particularly at the long end of the curve, or let's say 10 years and above, you can get into a situation where it starts to affect risk markets, right? And so that might feed into the economy itself. So we could be moving from the sort of left tail extreme of growth concerns, and so the equity market leading, if you like, to the bond market leading again, which is something we've been doing for the last, say, 3 years, I think, in financial markets. So we could be switching to that dynamic. I mean, it's not a given. We're still awaiting to see what's happening to Q2 data, into Q3. So perhaps bonds do get some relief on the back of slightly slower global growth picture. But of course, you can see the bond markets now are much more nervous about the fiscal element, and so that remains in focus.
Could that convince you to buy duration, Ella, if we do see some of that weakness, or is this a long end that you can't touch at the moment?
I'd probably say still too early to touch the long end, and that's something interesting because it's also being led by the long end in Japan. If you watch, that's been a persistent theme as well, and some bond markets are actually reacting with a higher beta to that. So there is a little bit of a global phenomenon to this. I mean, the long end of the gilt market is doing the same. So this is not just a U.S. phenomenon. So it's really a broad bond market issue. Now, for us, duration sensitivity has come down significantly, and I would call this very different to January when we were more constructive. The reason being that in January you had some risks to the growth element and also a lot of optimism in markets. Now we've gone the other way through, and we can actually talk a little bit more about the fiscal concerns. So I think right here, right now, it makes sense to have duration a bit closer to home and interest rate sensitivity on the lower side.
How much does a dollar that continues to weaken play into that of the less attractiveness of going into the U.S. when the dollar hasn't been playing its role, hasn't continued to strengthen, even as we've seen ruptures in other markets?
I mean, the dollar remains a little tricky. So we've been expecting a recovery, and we've had, let's say, on the DIX index, we've had about 3.5% recovery from the bottom. But the market seems to be very quick to fade that. And I think price action is probably the most telling element in financial markets. And so, yes, I think the story remains one where there is potentially capital repatriation, and this story has legs, and it's probably going to be a longer term story. So actually, we have been sellers on this strength in the dollar, and I believe we will be consistently doing so. So I think the market psychology has shifted now into sell dollar strength, and probably that's with us for some time.
I also noted down something else you wrote in your note, talking about deals between the U.S. and other nations for trade. You said that they might not come in time to save the cycle, and hence from here, data will dominate mood for the markets, given the moves that we've seen. But Ella, how do you even interpret the data at this moment? We're about to get retail sales, we're about to get PPI. The expectation is some skewing of the data because of the pull forward effect, trying to get ahead of the cost of tariffs. How are you viewing each piece of data that comes in and applying it to where you're investing?
I mean, we always like to think in skew and probabilities because we don't have a better read than some of the smart investors out there. So look, I mean, what are the odds that data comes in stronger than expected? Relative to where we were in March, potentially you can have better data. Relative to where we are, where we went in April, potentially better data. Is the broad economic growth picture significantly better off? Probably not. So I think you have to kind of sit somewhere in the middle. Very difficult to ascertain. Jobs numbers remain very important, so that's probably what we're watching. There were signs that the U.S. economy was slowing into this anyway, but the market could see through that, right? So that's why you have to be a little bit more flexible, I think, with your mindset now. The market could see through that and say, okay, this is no longer the key story for financial markets, and therefore potentially that's why bond markets are trading with a steepener bias.
Ella, we're going to have to leave it there. Wonderful to see you this morning, and always great to get your take. Ella Hoja of Newton Investment Management. Let's now get you some other stories that are trending on the terminal this morning. President Trump said that he's asked Apple CEO Tim Cook to stop building plants in India. As a result of that discussion, the president said that Apple would be upping its production in the United States. Apple had been planning to import most of its iPhones sold in the U.S. from India. Elsewhere, billionaire Steve Cohen says that the chance of a U.S. recession now stands at about 45%, and that his expectation is for U.S. growth to slow to 1.5% next year. The founder of Point72 noted the unusual nature of the stock market's tumble and recovery in April. In April, Cohen's hedge fund gained 2.3%. Russian President Vladimir Putin chose to spurn attending a meeting in Turkey with Ukraine's President Volodymyr Zelensky and top U.S. and European diplomats. Instead, Putin is sending a delegation of low-level representatives. The diplomatic snub dims the possibility of any major breakthrough in the proposed peace talks between Moscow and Kyiv. Coming up, all tariffs off the table. President Trump says that India offered to remove levies on all U.S. goods. We'll discuss that and the president's Middle East trip coming up next on your Bloomberg Brief.
Countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Next week, Bloomberg brings you live coverage from the Qatar Economic Forum. Bloomberg Horizons Middle East and Africa and The Pulse will be broadcasting live from the conference floor. Then, throughout the day, we'll bring you all the highlights from the key policymakers and market movers on the issues confronting the global economy. Live coverage from the 5th edition of the Qatar Economic Forum starts Monday, right here on Bloomberg Television. Context changes everything.
It's very hard to sell into India. And they've offered us a deal where basically they're willing to literally charge us no tariff.
The president speaking earlier with business leaders in Qatar. He didn't offer further details of New Delhi's apparent offer. Bloomberg's Jomana Bercecci has been on the ground and joins us now from Abu Dhabi. Jomana, it has been headline after headline coming from the president's Trump. It has been relentless. What's the latest with what the president said about India?
Yeah, so that was another major headline that dropped, a surprising one, I would say, to come through from his Doha press conference. But the president seemed to imply that India are getting closer to removing all tariffs on U.S. goods. This is a significant development because earlier in the week, the sounds coming through from the Indian Commerce Ministry suggested that they were looking to go for a more hardline approach. They had suggested increasing the tariffs on steel and aluminium. The Commerce Minister is making his way to the U.S. later this week for further trade discussions. And it it seems as though that strategy of perhaps going slightly more hardball with the U.S. seems to have paid off, because the Trump comments imply that they are getting closer to some form of a trade deal, which would entail lower tariffs on U.S. goods. Currently, the trade deficit with India sits at around $45 billion. In the past, when the Trump administration had floated the idea of reciprocal tariffs, the one that they were looking to apply in India was 26%. Of course, there is a 90-day pause now. But this just tallies on to the momentum that we got over the weekend, positive momentum coming out of those Geneva talks between U.S. and China, and just another sign that the U.S. administration is looking to ink some deals with some of the major trading partners around the world. And I guess the market is construing this as a positive development from a trade perspective.
Well, it seems to go just beyond trade, Jomana. We have specific company deals, Boeing being one of them, and Trump announcing a record order coming from Qatar Air. It's remarkable to see not just trade deals, again, but to target specific companies, specific homegrown American companies.
Yeah, so the thing is, there are lots of headline numbers coming out. The other headline that came out yesterday from Qatar was that the two sides, Qatar and the U.S., had agreed to a $1.2 trillion, quote, economic cooperation. That is not the same as actual investments or deals, but it is a sort of promise to work together in the future. As for deals that have been signed, those amount to around $254 billion. Those are actual deals. The Boeing one is significant. Qatar Airways, we spoke to the CEO a couple of weeks ago, and he actually hinted to us that a big order was coming. We didn't think it was going to be an order of this magnitude, the largest value order ever that Boeing has received, $96 billion in value. They're looking to purchase up to 210, 160 firm order with the option to buy another 50. But again, is also an endorsement of Boeing. And this is a plane maker that has come under a lot of scrutiny, a lot of pressure over the last year, and is an endorsement of sorts. And also, of particular note, that the Boeing CEO himself was traveling to the region with President Trump, and part and parcel of, I guess, some of the deals that this administration was looking to ink. On the Boeing side of things, we also had a $4.6 billion order come through from Saudi Arabia. And beyond that, we're waiting now for President Trump to address some of the U.S. military troops at the Udeid Air Base in Qatar. That's quite significant as well, because this is the biggest air base that the U.S. have in the Gulf region. And they are also inking a defense deal with Qatar of as much as $38 billion in value as well. So the deals are coming through, but of course, the headlines that Trump has been talking about are much higher than what actually has been agreed to on the ground between some of these companies and some of the GCC companies that we've been talking about.
Jomana, just quickly, what are we expecting next on the president's agenda on his trip?
Yes. Yeah, so I'm obviously in Abu Dhabi now. President Trump is going to make a tour of that airbase, and then he's going to hop on a flight and come over here to Abu Dhabi. We'll be here for a day and a half, and it is expected that he will be meeting, of course, with the President, Mohammed bin Zayed. So that will be a notable trip, too. The last time a U.S. president was in the UAE was 17 years ago, so another major milestone for Gulf countries. And in the UAE, I would say the focus is going to be a little bit more on artificial intelligence. We spoke about this in Saudi Arabia, and the fact that the U.S. are now allowing for some of these high-end chips to be used with these AI data centers in the Middle East. We expect something of that sort of scope to be announced in the UAE in the coming days as well.
Jomana, thank you so much for joining us. Looking forward to your coverage there out of Abu Dhabi. That is Jomana Bercecci. And in his latest press conference in Doha, President Trump also gave an update on negotiations with Iran.
Iran has sort of agreed to the terms. They're not going to make, I call it in a friendly way, nuclear dust. We're not going to be making any nuclear dust in Iran. And we've been strong. I want them to succeed. I want them to end up being a great country. So we'll see what happens. But we're in very serious negotiations with Iran.
And oil falling for a second day after those headlines over fear of what could happen to supply. NYMEX crude now down more than 4%, Brent crude almost down 4%. Joining us now is Bloomberg's Julian Lee. Julian, clearly this is something the market is concerned about. If there is a deal with Iran, what could the supply picture look like?
Well, we really don't know because Iran has been constrained by sanctions for such a long time that we really have very little idea of what their production capacity truly is and what, therefore, their export capacity is. But if we look at what they've done in the past, we could easily see another 1 million barrels a day of Iranian oil on the market, coming at a time when other members of the OPEC Plus group have also upped their production targets by more than 800,000 barrels a day for May and June, perhaps more to come for July. And on top of that, of course, we've got new projects starting up in Guyana, in Brazil, off the coast of the US, all adding to supply this year, and a year where demand growth looks fairly anemic.
Could this be the thing, though, that forces more discipline among OPEC Plus members? We've heard that Saudi might look at putting more barrels to kind of get that discipline back into the rest of the members. If you have Iran coming back online and oil prices falling as much as they are now, Julian, could this be the thing that allows OPEC Plus members to fall into line?
I really don't see it. I mean, if you look at where the cheating, if you like, comes from, it's really from Kazakhstan and Iraq, and perhaps, you know, some estimates would say the United Arab Emirates as well. But if you look at Kazakhstan and Iraq, Kazakhstan, their oil industry is dominated by 3 huge projects, all of which are run by major Western oil companies. So really the production decisions are in the hands of boardrooms of those companies. Yes, the government can perhaps lean on them, it can restrict access to pipelines, but they have to tread a very careful line because they need the investment from these companies, and they need their investments going forward. They also need the oil revenues. So it's difficult for them. And really, when it comes down to it, the numbers that we're talking about are not huge. I mean, we're talking about overproduction of, you know, a couple of 100,000 barrels a day, perhaps. And you put that into a global context, and it's really not a huge number. And I'm not entirely convinced that what OPEC Plus is doing and what Saudi Arabia is doing is really driven by a need to punish Kazakhstan.
All right, Julian, thank you so much for that update. That is Bloomberg's Julian Lee, and you are watching Bloomberg.
The President of the United States does say he wants to keep a more mutually beneficial trade balance with these countries. What does a country like Egypt and Kenya and some of these others have to provide that won't completely dent their own GDP?
No, it's tough. I mean, there is the commodity side. There is the. I think it's less about bringing it to the table and more trying to take advantage of the hit elsewhere. So China exports 30% of all the textile exports to America come from China in 2023. It's something like $40 billion. And whatever the tariff rate ends up being on China, it's going to be a lot higher than it is on Africa. So there might be scope for African countries to say, well, let's move those textile factories.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Take a look at what's on the front pages this morning. The Wall Street Journal leading with the bombshell that United Health Group is under a criminal investigation by the Justice Department. The DOJ probe has to do with possible Medicare fraud. United Health, though, said that the DOJ had not notified them about the reported investigation and that they stand by their Medicare Advantage program. The FT, meanwhile, is leading with the U.S. preparing to announce one of the biggest cuts in banks' capital requirements in a decade. FT sources say that the regulators are looking at the supplementary leverage ratio. Finally, the Washington Post, leading with Democrats, rattled again by new claims that President Biden's aides had hid his fragility. A growing number of Dems are publicly second-guessing their party's handling of the disastrous election last year. Coming up, ignore inflation at your own peril. That's the warning from Mark Malik of Seaberg. We're going to take a closer look into the numbers and his view. That's coming up next on Bloomberg.
Literacy is a big problem in the United States. I think 14% of adults are functionally illiterate, which means they can't read past the 4th grade level. That's a large percentage of the population. Nothing the Library of Congress can do can completely solve that problem, but are you surprised at how many people still cannot read in this country and how many people have another problem called illiteracy or illiteracy, which means they can read, but they don't choose to read?
It's a challenge with the digital age because they're reading on tablets, so we do count that as reading. If you have an e-book, you're reading the book, and I've been often asked if I'm listening to a book, are you reading? Does that count? But there is a concern that the amount of reading, actual text that people are doing, is diminishing. And so how do you work with other organizations? So the Library of Congress connects to public libraries, school libraries, and we do joint programming with them.
Why do we actually have all these thousands of libraries anymore when people are often doing things digitally and they don't need to go to a physical place to get a book?
People are using public libraries and someone has said, as opportunity centers. And libraries are offering collections that are beyond books. So libraries are circulating and responding to communities in so many ways.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
From our global headquarters in New York City, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Fading enthusiasm, global stocks snap a 7-day winning streak as markets await Chair Powell. A deal in sight, oil drops as President Trump says the U.S. and Iran are inching closer to a nuclear deal. And the state of the American consumer. U.S. retail sales on deck alongside earnings from Walmart. And it is an equity rally that has run out of steam. We barely eked out gains yesterday with really poor breath. Today it turns to declines, down 0.7 for the NASDAQ 100, leading the way down 0.5% for your S&P. Risk assets abound, doing poorly. You can see oil at the bottom of your screen, down 4% over hopes of an Iran nuclear deal. Meanwhile, maybe it's the bond market that's been more interesting. Some real pain yesterday turns into an easing of yields this morning. We're still, though, above 4% on your 2-year yield and 5.5% for your 10-year yield. Those are the highest levels since February and January, respectively, on a closing basis. And we get closer to that 5%. Is it fiscal concerns that this market has now flipped to? Let's get a look underneath the hood. Back with some stocks to watch. Here is Bloomberg's Joe Easton. Hey, Joe.
Hey, Danny. So we got a big move in Foot Locker today. The stock rising currently around 69% as we get news of a potential bid coming in from Dick's Sporting Goods. I keep thinking about those stripy black and white shirts over at Foot Locker. That company potentially getting a takeover bid at around $24. We're currently trading just below 22, so potentially you might see that one moving even higher. Then we've got Boeing on the radar once again after those comments from Trump earlier and yesterday's news of potentially around 200 jets being bought by the Qataris from Boeing. A massive deal that Trump reckons could be worth around $96 billion, but potentially might be some discounting on that. But nonetheless, Boeing up massively. Well, maybe not too massively, up around 2%. Anyway, a massive order nonetheless. Then we've got Cisco Systems beating on expectations in terms of the AI demand. We're up around 4% for that one today. Continued strength, not just in AI, but also in cloud as well. Cisco on the radar today, but really the big mover is over for Foot Locker. That one really catching my eye today. Keep an eye on all of those ahead of the open in New York.
Joe, I demand you show up next time in one of those Foot Locker kits that are striped. I demand it.
I'm going to get on Amazon and buy one.
Perfect,
I'm going to go buy one today, 100%.
Thank you so much. As always, excellent work this morning. That is Bloomberg's Joe Easton. Now we're going to get some more data. U.S. PPI, that comes in less than 3 hours, and that followed from earlier this week, cooler than expected CPI. Mark Malik of Siebert, though, stays cautious on the latest inflation print, writing, quote, "Inflation is like a shark. Ignore it at your own peril. A dorsal fin surfaced in CPI. What is your next move?" He joins us now. And Mark, I should note you put in your notes that you can quote me on that, so I had to. And it really makes me not want to go to the beach, I'll have to say, reading your shark notes. But so what now? Why are you concerned? This is a market that took relief from the CPI print, but you didn't.
Yeah, well, if you break down the number and you look at where any of that, we looked at the headline. Most people look at the headline number, but if you break it down and you look at goods inflation, you see that goods actually have been, they were deflating and now they're coming back into inflating, right? And so we've seen that trend slowly move up, but it now bounced above the water, similar to that dorsal fin that I referred to. And when you're talking about tariffs causing inflation, it would be in that area. So we've been hyper-focused on services inflation for good reason for the past many months, but now we have to start looking more closely at goods inflation, and we do start to see that happening.
So is it your assumption then that it is just inflation that's going to start to arrive, or are you looking at a more stagflationary environment?
Stagflation has certainly been something we've been a little bit concerned about. Obviously, we've had some recent developments in these negotiations. However, if you look at the numbers, right, it seems like the president's still settling in somewhere around the 10% level for tariffs. And if you look across the board, I mean, it's still going to be there's still going to be impairments to U.S. companies. So we have to start to get realistic on that and see which ones can navigate that situation best.
It's interesting because if you look at some of the most recent surveys, Bank of America had their investor survey yesterday. And when they asked people what sort of landing do you expect, the no landing scenario where you still have inflation, the economy chugs along, barely anyone thought that that would be the case. So if we are going to have something that looks like persistent inflation, how offsides are markets for it now?
I think markets are trying to feel their way through, right? I think we're going to see, it's definitely going to be a challenging summer. We're going to start to see some real prints over the summer that are going to really reflect policy. We haven't seen any of that yet. I think we've had a couple of positive days. I think there is certainly in the equity markets, I mean, there's a little bit of relief and exuberance, but if you look at the bond markets, certainly bond markets are a little bit more skeptical. And I think, again, while we like the rallies, we're still positive long term. Third quarter, fourth quarter going to be tough, but fourth quarter, first quarter next year, hopefully we can get past some of this stuff.
That disconnect between stocks and bonds has been really interesting because in Trump 1.0, when he was focusing on tax cuts, it was giving juice to the equity market while bonds sold off. And eventually the equity market rally stopped in late 2018 when bonds got around 3.25%. That seemed to spook things. We're at 4.5% right now for 10-year yields. How much more tolerance does an equity market have to rally as bond yields keep climbing higher?
Well, you know, it's a very different situation than Trump 1.0. You know, right now we have a deficit that's swelling, and it's swelling because also it's not being helped by higher yields, right? The debt service is higher now, so it's much more challenging, right? And the whole nature of how we float bonds in the U.S. is naturally going to push yields higher, unfortunately. And I think from the equities perspective, I think equities have become a little bit more numb and accepting of these high rates, but you know, 450 on the 10-year, you know, if it keeps going from here, you could see some impact on the equity markets if you still see it continue to bubble up the way it has been in the last couple of days.
Well, back in April, and let's be honest, that feels like it was years ago, but back in April, there was this real concern that foreigners wouldn't be buying American assets, that they'd be unwilling to fund some of the American deficit. You still hear those concerns that maybe the volatility has done enough to frighten foreigners. Clearly someone's still buying this equity market, but is that a real concern, that debt concerns get more acute if you have people overseas not willing to buy American debt?
You know, I think that, of course, that, you know, the movements in the bonds and yields themselves, I think that reflects current sort of sentiment. But I believe long term, there's still no better investment for foreign investors because where are they going to put their money? I mean, what's a better option for sovereign debt? So I think long term, it's not necessarily concern. I think it's a little bit of a tempest in a teapot, but it's something we have to watch in the short term, right? So if you see yields spiking, if dollars moving offshore, that can impact equity markets. But I'm fortunate in that I can look a couple of quarters ahead, and so from my perspective, I think we're going to look back on this as a period of, okay, we saw what happened, but this long term, I don't think it's going to affect the relationship that we have with foreign investors.
So fair characteristic that you're looking over the boat, looking to see if there are any sharks, but in the meantime, you're still buying risk. Is that fair? Or have you pulled back a little bit?
No. I think equity markets. I think you know, all equities are created differently, but there are plenty of great opportunities out there. I mean, the technology sector still offers fantastic growth. We can see that there's still plenty of room. Nobody is canceling orders for NVIDIA. You know, obviously it takes a little bit more conviction. You really have to be tough here. But if you look at the numbers support it. However, you know, you see big moves like we've had over the past several days, and so you want to be a little bit careful and give the markets a chance to sort of calm down. But if you look a couple of quarters out from here, I think, again, we're going to be higher. I think if you look at sentiment, I saw a couple of reports out on Bloomberg this morning, you know, we're at like peak low sentiment, but that typically precedes movements upwards. So if you look at the numbers, if we just look at history, we can expect rallies to go from here at this point.
Mark, I think that's the perfect note to end it on. Thank you so much for joining this morning. Really wonderful to see you. That is Mark Malik of Siebert Financial. All right, a quick check on Alibaba at the moment because they did indeed report their earnings. If we can just look at that real quickly. It's something that we had been waiting for. Again, earnings from Alibaba coming out moments ago. I will get you that in just a moment. I also want to note that we have the President Trump is about to leave there we go, Alibaba having dropped after their earnings report. Okay, quickly, officials from the U.S. and China have met on trade talks in South Korea. Just some trending stories for you this morning. Days after the two nations agreed to a 90-day pause on some tariffs, Jamieson Greer sat down with his Chinese counterpart in the island of Jeju, according to a South Korean official. No further details have yet been reported. Now, coming up on the program, President Trump says that India has offered to drop all tariffs on U.S. goods. He is speaking now in Doha. The president will be going shortly to Abu Dhabi. But for now, President Trump addressing U.S. troops on his Middle East tour. We'll leave you with live pictures of that.
As your Commander-in-Chief, I'm here to say that America's military will soon be bigger, better, stronger, and more powerful than ever before. We just did a budget. The budget was the highest by far, over $1 trillion. It's a lot. It's a lot of stuff. And hopefully it's peace and strength. Hopefully we don't have to use it.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
It's very hard to sell into India. And they've offered us a deal where basically they're willing to literally charge us no tariff.
Now, India was one of the first countries to begin trade negotiations with the U.S., but the Indian government didn't immediately respond to a request for comment. Joining us now is Bloomberg's Jomana Bersetchi, who has been following the president on the ground. Currently, she's in Abu Dhabi. Jomana, a lot of news coming out of this. How much can we read into what the president has said about India during his trip?
Yeah, so the headlines are coming thick and fast, as you say. On this particular point, President Trump was in Doha and he was giving a press conference, and he sort of made this announcement about India, suggesting that they were coming close to a trade deal in which India would lower the tariffs on U.S. goods to almost nothing, i.e. To 0%. And this is a turnaround in sentiment, I should say, versus the beginning of the week, because earlier in the week, there was a bit of controversy or sensitivity between India and the U.S. because the U.S. side, the Trump administration, seemed to imply that the breakthrough, the truce between India and Pakistan was negotiated as a quid pro quo on securing a trade deal. And they rejected those assertions. But what we do know is that the commerce minister is actually heading to the U.S. later this week to continue those discussions. The U.S., of course, riding on good momentum after the Geneva mechanism that was agreed to with China over the course of last weekend. So very intent on securing more trade deals with their major trading partners. And on India specifically, they've got a $45 billion trade deficit, something that, of course, has been on President Trump's mind. The fact that he said this, though, does imply that there has been progress in that respect and perhaps another constructive development for markets.
We also have the president at the moment speaking at an air base in Qatar, saying that the U.S. military will be bigger, better, stronger, also saying that Pete Hegseth is a great guy who was just speaking before the president. Jomana, what is next on the president's agenda as he continues his tour in the Middle East?
Yeah, let's just take a moment to acknowledge the pictures that we're looking at right now. President Trump has been on this whirlwind tour around the region. Obviously, a lot of proclamations, declarations coming out of Saudi Arabia. He then has made on his way on to Doha yesterday, where he signaled that $1.2 trillion of economic cooperation had been agreed to. Economic cooperation, not the same as deals, but a pledge to create that much value for the U.S. economy. In terms of deals, they've inked more than $250 billion worth with Qatar. The major headline being that Qatar Airways deal of around $96 billion. The Qatar Airways order is the largest order Boeing have ever received, with an order of up to 210 jets. So that was significant yesterday. But in terms of where he's standing right now, this is the largest military base in the Gulf, and really just underscores the growing role that Qatar and other allies of the U.S. in the Gulf are playing when it comes to advancing some of the Trump administration's goals in the region. Earlier on, we were talking about that press conference where he also said that he's been talking to Qatar leadership, the Emir, about advancing the Iran-U.S. nuclear discussions. And of course, we know that Qatar had been playing a diplomatic, important mediation role on the ceasefire discussions in Gaza and the release of hostages. So this is also a significant moment for the Gulf countries. This is the first time the U.S. president has been in Qatar since 2003, and then he's going to be making his way over here to Abu Dhabi, also the first time the U.S. president sets foot in Abu Dhabi since 2003 as well.
Jomana, thank you so much for your coverage this morning. Looking forward to following along. That is Bloomberg's Jomana Bersecci. Now, one stock we're keeping our eye on this morning, United Health shares are down nearly 6% in the pre-market trade. That follows a bombshell report from the Wall Street Journal that the company is under criminal investigation for Medicare fraud, something the company says that it has not been notified of. Let's go straight to Bloomberg's Joe Easton for more detail. Hey, Joe.
Hey, Danny. So as you say, it could be a rough day for that stock today. United Health down around 6% in the pre-market following that report in the Wall Street Journal. As you said there, United Health kind of saying that they hadn't actually heard about that probe and are standing by their Medicare Advantage program, which does seem to be the focus of that report. But this coming just a few weeks after they scrapped their financial guidance. We've also seen the change in CEO as well. So potentially it's looking like an unstable period for the company. We'll have to wait to see if we get confirmation of that report from the WSJ and any further commentary from United Health. But clearly some investors getting spooked by that, already nursing losses of around 30% on a 2-month basis for those shares. So potentially, again, going to be a rough day for United Health this
Yeah, they're down 38.8% so far this year. Again, very challenging, getting caught off guard by some of the higher medical costs too in scrapping their guidance. Joe, thank you so much for joining us this morning. That is Bloomberg's Joe Easton. Now, along with United Health, another potential mover today, Walmart. They are going to be reporting their first quarter earnings this morning. Shares higher by about 0.5% heading into it. Let's get more from Bloomberg's Charlie Wells. Charlie, what are we expecting from the giant, from the retail giant?
Yeah, Danny, we're spending so much attention on the stock because this is the world's largest retailer, and they are exposed on the trade front. We got a little bit of a sneak peek from the investor day that Walmart had last month when their CFO talked about the import mix that this company had. About 1/3 of the products that they sell in the United States come from abroad. The major sources of those products are China and Mexico. And let's not forget that in this quarter that Walmart will be reporting on, those 145% tariffs at least for part of that quarter, were in effect. Of course, they've been reduced on China to 30%, but still we'll be parsing how this company has been navigating this trade difficulty when they do have that import factor, but also when consumers are so razor focused on prices at a period of instability. That is something else that we'll be watching.
Well, it's not just Walmart, it is retail sales as a whole, Charlie. How much of this can act as a bellwether? Is Walmart in a special place when it comes to the U.S. consumer?
You know, Danny, Walmart is in something of a special place because they do have that emphasis on price. But what we have been seeing and what management at Walmart has been talking about when they've reported in previous quarters is this higher income consumer tending to look more to Walmart as they feel a little bit more pressed. So that is one of these issues that we'll be looking at. Do people who you wouldn't necessarily expect to go into Walmart, are they going there? And what does that say about the consumer? Because we're at a time when there are a lot of questions about consumer sentiment, where consumers have been talking about not feeling great, but that hasn't necessarily been trending into the hard data. So this could be a helpful point.
All right, Charlie, thank you very much. That is Charlie Wells. And again, we're going to hear from Walmart before the bell. We are also going to be getting some retail sales data. That will also come this morning. A lot of questions to how the consumer is holding up amid this uncertainty and as to whether or not you will actually see the impact of tariffs yet. We hadn't quite seen it in CPI, but of course, we were just speaking with Mark Malik of Siebert Financial, who said that he is concerned about the goods inflation starting to pick up. Will Walmart also be able to price some of that pricing, some of the higher tariffs to the consumer? Now, I want to take you to live pictures again of the U.S. President, President Trump. He is currently speaking at an airbase just outside of Doha, Qatar. Later, he's going to be heading to Abu Dhabi. He's been speaking there, saying that the U.S. military will be bigger, better, and stronger. He said that Hegseth is a great guy. He's been praising the ambassador and a lot of folks over there. Also said that the Qatari emir has been a longtime friend of his and that our friendship with Qatar has never been stronger. As a reminder, some of the headlines we've gotten out of his trip to Qatar, a huge blockbuster deal for Qatar Airways to buy Boeing. The president also talking about India, saying that it would lift all tariffs. We'll leave you with these images of the president.
America's military will answer our enemies without even thinking about it. We have overwhelming strength and devastating force. And we had people that didn't like to talk about that, you know? They didn't want to talk about
is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
You're watching Bloomberg Brief on this Thursday morning. I'm Danny Berger in New York. Let's get you set up for your trading day. We're going to get some data coming out. U.S. PPI, retail sales, jobless claims. All of those will hit at 8:30 a.m. Eastern. We'll also get remarks from Fed Chair Powell. That comes at 8:40 a.m. Before the bell, we're going to get earnings from Walmart. So a big day for the read of the American consumer and the health of them. United Health, that's one of the movers we're also watching this morning. The Wall Street Journal reporting that it's being probed for something around Medicare fraud. We should note that United Health has said that they have not heard from the DOJ and that they stand by their Medicare Advantage program. Cisco, they also had earnings after the bell. Gaining, they boosted their full year revenue guidance. AI really buoying demand. You can see Cisco shares up 4%, but to the downside in a big way. Again, I mentioned this moments ago. We got Alibaba earnings. Fourth quarter revenue missed estimates as the consumer downturn persists in China. Those shares down nearly 5% for the ADRs in the U.S. Now, the bond market, something that you want to keep your eye on, because even if stocks have rejoiced, yes, they're kind of taking a pause this morning, even if stocks have rejoiced and made up plus more their lost ground for April 2nd, this bond market hasn't. 10-year yields are almost 40 basis points higher since April 2nd. At the moment, you can see we are lower across the curve. That was not the case yesterday. We were moving higher, and we're still around the levels that we got to. Still above 4% for your 2-year yield. Still above 4.5% for your 10-year yield. All of that may be fiscal concerns coming back in as we reduce the bets of the Fed cuts. We're under two cuts priced into this market for the year. Your 30-year yield, that's also getting closer to 5%. Levels that spooked the administration, but will it at some point spook this equity market? Now, one risk assets that is not doing well today. I also want to give you a check on oil this morning. Falling quite a bit of an amount, 4% for NYMEX crude, 3.8% for Brent crude. That's after President Trump said that they would be getting closer to something that looked like an agreement with a deal with Iran. We also heard from the IEA saying that global demand is set to slump, all of that leading to lower oil prices. Well, the U.S. president is still in Qatar speaking at an air base this morning, praising the U.S. military. He goes to Abu Dhabi next. That is it for your Bloomberg Brief. Surveillance will have the latest on the president's tour in the Middle East. That's coming up next.
They were unable to fund Hamas or anything else. Wouldn't have happened. We wouldn't have had the disaster of Afghanistan, the leaving. We were getting out, but we were getting out with dignity and strength. We were going to keep Bagram Air Base. We weren't going to give that up.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit. Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
I just don't see any significant catalyst to the upside in terms of earnings growth or economic growth.
Our forecast for GDP is below trend. Much of that comes from a drag on the consumer.
The consumer appears to be continuing to spend. They're very healthy.
We're still talking about an environment where we have higher tariffs, potentially lower growth.
The next couple months could be a surprise. This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, facing down a triple header. The consumer in focus. As investors wait for the latest read on U.S. retail sales, Walmart reporting earnings as it doubles down on discounts to secure market share. And Fed Chair Jay Powell speaks as leadership stops well short of calling the all clear. A packed Thursday coming up.
And the big question is, what's actually going to move this market more? The economic data, the Fed speak, or what's going on in Washington, given what's going on with the actual deficit discussions? There is a real question here about how much this market, and frankly, even Fed officials, are looking at the data or even the forward looks from a lot of companies that have very little visibility at a time of still great uncertainty.
Walmart the one.
Yes.
I think for many people, a little bit later this morning, we should get those numbers in about 60 minutes from now. Walmart is the one. What is happening with consumer? We know how they feel. Bad. What are they doing? And are they continuing to trade down? And for Walmart as a company, how are they developing their pricing strategy in this moment compared to, say, post-pandemic?
So Walmart is an amazing example. It's a petri dish. It's a confluence of so many different trends coming together. First of all, it's the world's biggest retailer, so it has an incredible view into the consumer. Second, it has an incredible view into supply chains to understand just how disrupted they have become. And it has incredible negotiating heft to the point about pricing. They have said they want to compete on price, which means they want to lean in and maybe even take some margin hit in order to have the best prices out there. How much are they gaining share, and how much are they having to do that because they're not able to jawbone down some of their suppliers?
Walmart this morning up in a pre-market by 0.5%. Equity futures at the moment just a little softer. We're down by 0.5. Coming up this hour, we'll catch up with Barbara Duran of BDA Capital Partners with stocks on a 3-day winning streak. Ed Mills of Raymond James as the tax debate on Capitol Hill continues, and Gene Soroka of the Port of LA expecting a sharp drop in imports this month. We begin this app with crude dropping as President Donald Trump says the U.S. is closing in on a deal with Iran.
Iran has sort of agreed to the terms. They're not going to make, I call it in a friendly way, nuclear dust. I want them to end up being a great country. Frankly, but they can't have a nuclear weapon. It's very simple. It's not like I have to give you 30 pages worth of details. There's only one sentence. They can't have a nuclear weapon.
Joining us now from Abu Dhabi, Bloomberg's Anne-Marie. AMH, I have to say, this is somewhat unexpected.
Somewhat unexpected, Jonathan, and there was this report in NBC News that a top advisor to the Ayatollah was talking about the fact that they are ready to do a deal with the United States. They would be willing to give up this commitment to have a nuclear weapon, but they still want to keep nuclear enrichment for civilian use. And the president said, you probably read that port in Iran, they are agreeing to some terms of the deal. Well, that deal is basically the JCPOA. There is nothing in the report that looks anything more than the JCPOA, which this president pulled the United States out of. So if that's where talks stand right now, it is very unclear if that would be enough for this president to be willing to do a deal with Tehran. We should also note, earlier on the trip, his red line has always been they cannot have a nuclear weapon, but he also talked about the fact that Iran needs to stop funding and supporting the proxies around the Gulf, like Hamas, Lebanese Hezbollah, and the Houthis. When you look at this report from NBC News, Tehran is not willing to do that.
And Maria, on a larger scale, what has been accomplished and what remains to be accomplished on this tour of the Middle East that's been basically deal-palooza over in Riyadh and now heads to the more geopolitical front?
More deals are going to be expected when the president touches down here in Abu Dhabi. A ton of deals in Riyadh, of course. The focus there was really AI, and that is going to transfer here as well. There were similar grievances between Riyadh and Abu Dhabi when they were dealing with the Biden administration and this diffusion rule, putting the world into buckets. And you had these two countries really capped at the level of how many advanced chips that they could get their hands on. Sheikh Taknoun, I broke that story in March when he came to the White House, had dinner with the president, and then you saw the Emiratis say they were willing to commit $1.4 trillion of investment. They say in order to invest in AI data centers and how they want to transform their economy, they need access to those chips. So I would take a look at NVIDIA, AMD today. They can be on display yet again as they were in Riyadh.
Anne-Marie, appreciate the update. More from AMH a little bit later this morning. We'll catch up with Anne-Marie in about 60 minutes from now. Waking up to a lot of news overnight from the Middle East. Not just that news there, the prospect of a deal with Iran, also a little bit of pressure on Tim Cook of Apple from the President of the United States regarding India, right?
This just highlights how difficult it is for any company to come out with any decision about where to reshore some of their production, given the fact that it's unclear where is preferred other than the United States of America. With President Trump coming out and saying to Tim Cook, I don't like moving to India. What's wrong with the U.S.? Why doesn't he come here? And all of a sudden, the whole plan to move production from China to India gets called into question.
We'll bring those comments from the president to you in about 25 minutes' time, so look out for that. Here's the view from Wall Street this morning. Barbara Duran of BDA Capital Partners writing this: with worst case off the table for tariffs and acceptance of a patient Fed, the stock market has rebounded to near year-end levels, but tariff uncertainties loom large. Barbara joins us now for more. Barbara, good morning.
Hey, good morning.
This is a take from a lot of people. We've avoided the worst case. Markets rip. You have to cover shorts. Where are we now, and what do we have to face down in the months to come?
Well, I think it's a question everybody's looking at. I think it's that 21 PE, we're back to that, up from 18 times just a month ago. So I think the market takes a pause here, and certainly the futures today are indicating a little bit of a pullback. And I think with the uncertainty, people are taking their eye off the ball in terms of the trade tariffs are still there. And right now, the blended rate is probably about 17.8%, 18%. That's 7 times what it started at the beginning of the year at 2.5%. So even if he were to come down to 10%, that's still 4 times. That's going to have an impact. And we haven't seen it. Today we're looking at retail sales, PPI number, Walmart. Walmart will have an interesting read because they're starting to see things, but I don't think it's still, we're not going to see a big impact. People, we've seen the soft data. Consumers are really nervous. And so there's a little bit of a pullback, but frankly, for the last year, we've seen people trading down, into lower stuff. So I think we're not going to see yet the impact of the tariffs, but it will happen.
It's really a $1 question. When do you expect to see it?
Yeah, I think that is the question, because we know we've had a lot of pull forward. We've seen that in terms of the freight and all the forward ordering. So it looks like sometime in the summer, and certainly by the fall, I think we will start to see the impact of slower growth. We're going to have a better idea about inflation. And inflation we're not going to know for a while, which is why the Fed is being patient. And now all the reversals in trade shows their patience is warranted. And we'll see, even if inflation is sticky, or not? And that's the big question. We're not going to know for some time, and that data will start to come in, I think, by the end of the summer.
It seems like the new havens in the equity market are the old havens, and that's big tech. And you've seen them rally tremendously. That's been the outperformer. Even as you saw yesterday, the Russell 2000 declined by almost a percentage point. There is this feeling that once again, they can diverge meaningfully in an era of tariffs and potentially trade wars if the technology they provide is fundamental to the next phase of advancement. Is that your sense as well as an investor?
Yeah, it is. I mean, if you look as far back what happened in 22 when the Fed aggressively raised rates, the growth stocks and the mega cap tech all got killed, right? But the fundamentals hadn't changed. So that when the Fed stopped and it looked like they were in an easing path, they came back, roaring back in 23 and 24. But they have been subject to periods of extreme profit taking. That's why they run up. Even now, you've had a big bounce back. I mean, look at NVIDIA. That's up 42% in the last, since their low in April. And so you're going to see periodic profit taking, but these are stable. These are companies with long pathways of growth, predictable, big cash flow, good management, all that. And certainly this week we've had a lot of re-emphasizing or reassurance about the AI play is alive and well, and certainly the orders that they're picking up in the Middle East.
Well, I think what's interesting is if you look at the dynamics of the market, it hasn't necessarily been truly risk on, led by some of the riskiest companies. It has really been big tech that's bolstered most of the returns, which raises the question, if people are sniffing out weakness, why are they avoiding long-term bonds to such a degree? And what potentially could you see in the data that could push them into them if there is already disinflation? We saw that with the CPI report coming in lower than expected.
Right. But that's that same day, the CPI just a few days ago, you saw the long bond yields went up, right? That would be counterintuitive. But I think we've got big issues. I mean, we're watching the tax bill negotiations unfold. So far, it doesn't look like they're making much progress. And there's a lot more to come in terms of are they going to cut, how much are they going to cut Medicaid, et cetera, in terms of the deficit. And that's, I think, what's affecting the long bond yield. Plus, the reports of on the margin, other countries like China are trying not to buy treasuries if they can help it. They'll go to the yen, they go to the euro. But we have the deepest market, but I think that's impacting us on the margin. So it's hard to see the 10-year coming down all that much because of these concerns.
Got close to 5 again on a 30-year overnight. When does that start to become a headwind for this equity market?
That's a question. I think, if you look at the 10-year, I think when you start to get at 4.6, people start to get really nervous about what's this mean and how do we tamp that down? And that really, I think, makes the bond market nervous about deficits and what's coming. So a lot is hanging on this tax package in terms of what happens in that regard. And that's, the immediate concern is where do we cut taxes and the deficit? But, it's going to be hard to solve.
How it shapes the equity market is one thing. Another thing is how it shapes the conversation actually down in Washington, D.C., and whether it pushes people to change their mind about how far they can push this thing.
Or do they just change how they push this thing? Because the bill that was discussed overnight pushes this thing in the near term, during Trump's term, through the midterms, and then all of the sweeteners come off and some of the cuts come into place. So if you just prolong it until after this political cycle, then maybe that's a solution.
I've heard it described as jet fuel for the U.S. economy by U.S. officials. Do you consider it the same way?
You're talking about the tax rate? Yeah. No, I don't, because what they're talking about basically is extending existing tax cuts. And then when you look at where the tax cuts could come, Social Security, if they do that, it has to be some compromise there because you're looking by some estimates of adding $1.2 trillion over 10 years to the debt. No taxes on tips. Well, I'm not sure if so many people report their tips anyway, and overtime. I mean, it's something like 10, 11% of salaried employees get overtime, so even that's not that meaningful. So where's the stimulus going to come from? And I don't think there's any serious talk about really cutting the corporate tax rate any further. So I think it's, it's a little bit over-promising here.
Are we removing a potential headwind or providing a tailwind? How many times have we asked that question over the past few days?
And frankly, the answer is still not clear because potentially there are sweeteners to people who give birth to children. There's certain tax deductions that potentially will get thrown in there. There's certain benefits to investing in certain kinds of funds. It's unclear, but right now people are more worried about the headwinds coming from the bond market than they are some of the tailwinds.
Barbara, it's good to see you. Thanks for dropping by. Barbara Duran there of BDA Capital Partners in the bond market. A bit of comfort for you. Yields backing off. We're lower. We're down by 2 or 3 basis points on a 10-year, just sitting in and around 450. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Yahira Anand. Hey, Yahira.
Hi, John. Some New York Republicans are signaling that an $80,000 SALT cap may be on the table in President Trump's tax package, which you were just speaking about. Several lawmakers even threatened to reject any package that does not include a sufficient increase. Representatives LaLota, Stefanik, and Lawler are some of the key Republicans pushing for the increase. Meanwhile, Russian President Vladimir Putin has named a group of low-level officials to join peace talks with Ukraine in Turkey, giving no indication he plans to join the negotiations today. President Zelensky had challenged Putin to meet him for talks in Istanbul after the Russian leader offered to resume direct talks to end the conflict. And United Health is under criminal investigation for possible Medicare fraud. The Wall Street Journal is reporting the Justice Department has been probing the company's Medicare Advantage business since at least last summer. United Health said in a statement late yesterday that the DOJ had not notified it about the reported investigation. That's Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the program, building a consensus.
I will tell you, I'm absolutely confident we're going to be able to work out a compromise that everybody can live with. Virtually no one's going to be 100% satisfied with every piece of the bill. It's just not possible.
We'll get to that compromise next. We'll catch up with Ed Mills of Raymond James, live from New York City this morning. Good morning.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Just a quick programming note for you. Coming up later on this morning, 8:15 Eastern Time, Jamie Dimon, the JP Morgan chair and CEO, catching up with Francine Lacqua over in Paris, France. So look out for that later on this morning. We'll take that live right here on Bloomberg Surveillance. Let's check out the equity market. Equity futures on the S&P a little bit lower. We're down 0.5% following a 3-day winning streak. On the Nasdaq, down by 0.7% following an almost 25% rally off the April low. We're taking a bit of a breather this morning. Under surveillance this morning, building a consensus.
I am trying to be the sort of the neutral umpire in the negotiation and build consensus, so I won't come out here and handicap it and tell you numbers and all that, but I will tell you I'm absolutely confident we're going to be able to work out a compromise that everybody can live with. Look, when you have a bill this big, with this many pieces and this many components and this complex and comprehensive, virtually no one's going to be 100% satisfied with every piece of the bill. It's just not possible.
So here's the latest this morning. 2 New York Republicans signaled the capital assault deduction could reach as much as $80,000 as the party works to come to a compromise on President Trump's tax package. Joining us now in Washington, D.C. is Bloomberg's Tyler Kendall. Tyler, welcome back. Let's talk about that compromise. What would that compromise actually look like?
Yeah, hey, John, good morning. So the proposal you're referring to is being shorthanded here in Washington as 40-80. So it would lift the SALT cap from $10,000 to $40,000 for individuals. And then you double it for married couples, and that's how you could reach that $80,000 number. Now, to be sure, at the moment, we have not gotten indications from House leadership that that's the number that's being seriously considered. But at the same time, we heard from 2 lawmakers from these high-tax states like New York, New Jersey, and California saying that that's a number that they could get behind. Remember, they have already said a hard no to the current proposal that's in the legislation, which would be lifting that cap to $30,000. They came into the week looking for a number as high as $62,000 for individuals, so perhaps this could be the sweet spot. But to be sure, there's still a lot that still needs to be worked out here. We could get some indications later on today. It's our understanding that House Speaker Mike Johnson will meet with these lawmakers from these high-tax states, but there's also reporting that he's going to invite some House Freedom Caucus members, these fiscal hawks who say that the higher the SALT cap goes, the greater the need to find additional savings elsewhere. Now, John, a few other areas of compromise I'd be looking out for here. One would be income limits. Who does this apply to, at what price? And then also expiration dates, I think, are going to make their way into the conversation in a pretty meaningful way. Perhaps they will lift that SALT cap, but how long it stays on is going to be a big question.
Tyler, let's talk about those expiration dates. It seems like there are a lot of provisions within this proposal that have expiration dates at a time when some of the sweeteners will happen immediately and some of the pay-fors will happen in 2028. What do we know about that?
Right, exactly. And that is particularly kicking in also when it comes to those spending cuts, which is going to be a very big topic of discussion moving forward here, not just within the House, but of course, when the bill gets kicked over to the Senate. I'd highlight 2 of them. One is the immediate impacts that there could be on Medicaid. Some of those fiscal hawks want to see that funding pulled back even quicker. And then the other to keep your eye on is what happens to those IRA subsidies. Interesting enough, we've often heard Republicans say that they want to roll back those subsidies when it comes to tax credits on clean energy production. But at the same time, there are Republicans cautioning that they want to see those actually remain in place as they represent states with economies that are trying to make that clean energy transition. So it's going to be interesting to see where that shakes out here, because the timeline in particular is something to watch. I actually was on Capitol Hill yesterday. I caught up with Senator Josh Hawley. He's one of those senators who says they cannot support the House bill as it currently stands because of this issue.
This is going to be difficult. Tyler, thank you. Tyler Kendall, we've talked about that aggressive timeline. The House wants this wrapped up by Memorial Day. Ed Mills of Raymond James joins us now for more. Ed, let's talk about Republican leadership, and welcome to the program, sir, by the way. Republican leadership, how difficult is it going to be to please both the SALT lobby and the hawks?
It's difficult, but not impossible, John. What I've told folks here at Raymond James is that May is for the House of Representatives to get this done. June is for the Senate. July is for them to work out their differences, and early August is getting this to President Trump's desk. The big sticking point, as you've been highlighting, is what is going to be that increase in the SALT cap. But if we look at the totality of the bill, if this is what we're talking about, we're down to that kind of final pieces of negotiations. We've been watching these committees mark it up. The Ways and Means Committee finished their markup. The Energy and Commerce Committee finished their markup. The Agriculture Committee finished their markup all this week. Last week, we got a bunch of other committees finishing their markups. This has been going pretty smoothly. This is not what we normally see, John. So I always tell folks, take the over on timing coming out of D.C. With maybe the exception of this year, the House Republicans have been together because there's a lot of pressure by President Trump, and there is really big pressure on the alternative. If you don't do this, what do you get? You get the largest tax increase in U.S. history. That's an unacceptable outcome for House Republicans. So they are going to get this together, and they're going to get a bill to President Trump's desk.
Ed, if you have that confidence, I want to understand what underpins it. Some way you must believe there is a compromise. And if you believe there's a compromise, can you tell us what that compromise ultimately will look like?
Yeah, so I don't know if it's going to go to that 40-80. I think that some of the SALT caucus members are taking a page out of the playbook of Donald Trump. Move the number up higher so you can get a compromise that everyone can live with. I think what we are really focused on here at Raymond James is the fact that everyone's been saying, no, this is not a big fiscal impulse, but they are going to front and load all of these tax cuts. And we've been talking about this. It's going to be about a 3-year tax cut where they're going to spend more than $1 trillion over those 3 years. You're going to have $330 billion of fiscal impulse, plus business tax cuts that are front-end loaded, $200 billion over the next year and a half. We're going to be north of $500 billion of fiscal stimulus once this bill gets done between the end of this year and the end of next year. I think that's going to be a huge push to get this over the hump here. I just don't see that they're unable to get this done. And the final thing I'd say, John, is the fact that they have the debt limit in this. We have to raise the debt limit or we default. We respond to crisis and deadline in D.C. They are not going to let that happen. They will come to a compromise, even if, as Speaker Johnson says, not everyone is happy. But the alternative, everyone is, responsible for a complete disaster. So they don't want that complete disaster. They will get this done.
They're moving pretty quickly, Ed. So is the bond market. And yesterday, the bond market seemed a little concerned about this. And I'm talking about the 30-year yields in particular, because you do have this stimulative impulse by front-loading a lot of the sweeteners. At the same time, the Committee for a Responsible Foreign Federal Budget came out with projections that called for the increase of the fiscal deficit by $5.2 trillion as a result of this package over the next 10 years, also talking about an increase of debt to GDP of 125 to 125% from where it is today. At what point, Ed, do you think that that's going to be the ultimate check, given that that really is something that the bond market's paying attention to?
Lisa, when I talk to clients, the 30-year hitting 5% seems to be the Trump put and Trump 2.0. So we're really dangerously close to that. However, I don't think the Trump put at 5% really applies to the House into the Senate. I do think it's really important, as you mentioned, this is going to be the most expensive bill in U.S. history. And so how are we going to offset? There's some cuts in this bill, about $1.5 to $2 trillion. And as you've pointed out, some of those don't happen until the expiration of some of the sweeteners. So are those actually ever going to happen? But Trump is out there doing tariffs. He has DOGE. He has our Treasury Secretary saying that they're really concerned about the long end of the curve. That's a political permission structure to get Republicans on board here. But it's really important because I think once we get this done, the debate for this market for the second half is the path of the 10-year and the path of the 30-year, because we've raised the debt limit. We need to refill the TGA. We have a higher debt to GDP expectation. And we have to refinance $9 trillion worth of treasuries over the next 2 years because of the way in which the prior administration and Janet Yellen in particular decided to refund and front-end load all of the treasury purchases at the end of the Biden administration.
Just real quick, Ed, how much of an offset are some of the tariff revenues that are expected?
I have no idea, but because I have no, I mean, it's the honest answer. I think at the end of the day, it's probably going to be about $200 to $300 billion a year. What you have heard from the administration, it could be $6 trillion, $8 trillion. They are trying to create that political permission structure and keeping a lot of vagueness into how much it is actually going to be, trying to say that it will pay for itself. I don't buy that, but it is good politics.
We value the honesty. We appreciate it, Ed. Thank you. Ed Mills there of Raymond James. Your 30-year this morning, your yield is 4.95. It's difficult to make the argument we're 5 basis points away from the fiscal dove seeing the light. Don't you think?
Well, this is a reason why Stephen Jen yesterday came out, a longtime fund manager, and said it might take a Liz Truss type of moment to discipline this U.S. fiscal oversight, given the fact that right now it seems to be an orderly move. Yes, up to 5%, but it's not the same kind of freak out that we saw a couple weeks ago.
Got to put a number on Liz Truss. What's a Liz Truss moment in Treasuries, given where we are already?
Well, I think it's the pace also. It's the disorder that happens with it.
Then maybe Washington wakes up, just not yet. Up next on the program, and Rita said, of energy aspects as oil drops on prospects of a deal with Iran.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO? It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good, but as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episodes this spring, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Three-day winning streak on the S&P 500 coming into Thursday. A few upgrades. We've had them from Goldman, from Edgiardeni, upgrading their price targets on the S&P. This from UBS and David Lefkowitz, downgrading US equities from attractive to neutral. It appears that investors are already pricing in a substantial de-escalation in trade friction. Speaking to some of that, a little bit of steam coming out of this rally. We're down by 0.5% on the S&P. We're down by 6 or 0.7% on the Nasdaq 100, with 3 hours away until that cash open. Let's get you some morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. It is another day with United Health under pressure. Recall earlier this week, it was about them scrapping their guidance and getting a new CEO. This time, late yesterday, a report from the Wall Street Journal that the DOJ is investigating them for possible Medicare fraud. Now, to be clear, the company itself says that it has not been notified by the DOJ and that it stands with the integrity of its Medicare Advantage program. Even so, those shares down 6.6% this morning, already down 38% year to date. To the upside, though, Cisco had earnings after the bell yesterday. The guidance it gave for the current quarter was much stronger than expected. Really sure that companies are still spending a healthy amount. There had been some concern that maybe there would be a pullback. Not so. The CEO saying that demand for AI was so acute that they would keep spending until they were forced to stop. Those shares up 4%. Finally, a little bit of deal news to bring you this breaking moments ago that Dick's Sporting Goods will be buying Foot Locker for a $2.4 billion deal, confirming reporting earlier from late yesterday. Got to say, the price tag on this, it is a huge premium. $24 is what they want to buy it at. So you can see pre-market, we're getting closer to those levels. But again, a nearly 90% premium. Maybe because of that price tag, you can see Dick's Sporting Goods falling 13%. But Foot Locker, for its part, has fallen a lot this year, considering some of the concerns around tariffs and around merchandising. John.
Danny, thank you. That stock was down more than 40% before this deal. That stock has had a rough ride.
Yeah, when you're talking about less than $25 a share, it's a different type of percentage gain when you start talking about this type of deal.
Very, very difficult for some of those retailers. Thanks for the update, Danny. On our radar this morning, a US-India trade deal might be on the table.
It's very hard to sell into India. And they've offered us a deal where basically they're willing to literally charge us no tariff.
That's the view from the President of the United States. How close are we to that deal?
Yeah, and how close is that to the reality from the Indian side? Because on Monday, India announced retaliatory tariffs potentially against the U.S. should these talks go south. And some analysts were speculating that they were taking a tougher tone in response to what transpired between the U.S. and China. So a real question here about how much there is an offer on the table to drop all tariffs. And then would they be willing to unilaterally do so? Or would it require the U.S. also dropping tariffs to zero, which it has been made clear that that is not something that they really are willing to do, given that there is that 10% ceiling, or 10% floor, I should say, for tariffs going forward.
Which brings Apple into the conversation, because the president was upset with Apple and Tim Cook for moving production to India, turned around overnight and said, we don't want to see that happen. But if we're going to see a deal between the Indians and the US, then doesn't that justify the move we've seen from Tim Cook and Apple?
There is a real question around who our allies are and what kind of perks there are to being the allies of the United States. Is it business that gets transported over to that country? Is it some sort of geopolitical alliance? That really is a big question at a time where it is unclear that people in New Jersey really want to be making iPhones for the same price that they'd be making them in India.
I'm not sure they're going to make them for the same price, that's for sure. What did Dan Ives say, $3,500 for an iPhone if they're made in New Jersey?
You're going to see the prices go up.
Wow.
I will say, I've actually thought about it, what it would be like to do that.
Assembling iPhones?
Yeah, and you can stand next to your friends, have a chat.
I'm sure that's what happens in China too, because they're getting paid a whole lot less. They're doing the same job.
Anyway, I'm just saying it's probably not feasible.
Apple's down in the pre-market by more than 1%. Conversations moved really quickly. It's moved away from trade to taxes, just like that to start this week. 2 New York Republican lawmakers signaled the SALT cap could rise to as much as $40,000 for individuals, $80K for couples. Lawmakers planning to meet with House Speaker Mike Johnson later on this morning.
And a real question about what they can actually get passed. If you look in the details, also, who actually is eligible for this? Is it a joint married couple? Is it people who make less than $200,000? How much is this really important for some of the Republicans, particularly from high-tax states that have seen huge uproar about this particular provision? It just goes to show how many different cats they're hurting and how they're going to deal with it, which is to have all of the sweeteners up front and then the pay-fors later after the political cycle is over. I find this a fascinating tactic. It's been deployed before. Will the Senate sign off on it, though, if there is a response in the bond market that suggests probably there will never be pay-fors?
Ed Mills of Raymond James thinks you can get this deal done, this bill passed, and signed before the end of summer. Speaking of herding cats, foreign policy, Russia, Ukraine. The peace talks seem to be on ice for now. The Russian President Vladimir Putin sending a low-level delegation to hold talks with Ukraine and Turkey, despite calls from Ukraine's Volodymyr Zelensky for Putin to attend.
And it doesn't seem like President Trump is going to attend either. He said, we'll see, kind of busy. My question ultimately is how much this ratcheted up the pressure on the side of the U.S. to take action against Russia if these talks are not perceived as being in good faith. And that's the tone, at least from the Europeans, and a real question about whether the tenor of discussions take on a very different tone after there was a low-level delegation sent to Turkey.
This can change. This is just the current state of things so far, and the planned talks over in Turkey. I want to turn to commodities and look at oil. Crude is lower for a second day after President Trump said the U.S. and Iran are closing in on a deal.
Iran has sort of agreed to the terms. They're not going to make, I call it in a friendly way, nuclear dust. I want them to end up being a great country, frankly, but they can't have a nuclear weapon. It's very simple. It's not like I have to give you 30 pages worth of details. There's only one sentence: they can't have a nuclear weapon.
They can't have a nuclear weapon. Joining us now to discuss, Amrita Sen of Energy Aspects. Amrita, welcome to the program. Your thoughts on what the president just said there, and how unexpected is the prospect of a deal for this energy market?
Yeah, I mean, look, you guys were just talking about Russia, Ukraine as well. I mean, that's also happening. But right here, right now, it is the Iran talks, as you rightly point out. That's why oil is down so much today, because the market's at least interpreting what the president said as meaning that there is a deal that is close. But I think what we would want to highlight is that despite the flurry of headlines that we've seen, and I will also say that it's difficult depending on which bit of what he said you pick out, the nuances can be quite different. Neither side has actually made any significant movement on their red lines. The Iranians are not going to give up on enrichment. In fact, what they're talking about is much more like a JCPOA-like deal, which we understand Trump isn't particularly keen to say yes to, and he is going to come under a lot of criticism from kind of not just the Republicans, but just generally people around him as well, if he were to accept that. But I appreciate why the market's reacting the way it is, because the headlines have very much been, we're in serious negotiations, there's a deal. We do believe there is a pathway for a deal eventually, but we also think that sanctions will need to tighten first, and we will probably see some decline in Iranian exports from very, very high levels currently.
Well, let's talk about those export levels. Where are they currently? How does that compare to when we actually had the JCPOA before the president tore it up? Where are we now? Where were we then? And what could it mean going forward if we actually secure a deal?
No, I think that's a great question. I mean, we've been, again, depends on a month-on-month basis. On average, it's been kind of hovering around 1.5 to 1.6 million barrels per day of exports, pretty much all of it going to China. It does dip a couple of months. It's been as high as like 1.7, 1.8. Under the previous Trump administration, when there was maximum pressure, it was as low as 400,000 barrels per day. It's a huge delta. If, let's just assume, all sanctions were to be lifted, the actual volume coming back to the market is not going to be that much. It's around that 200,000 to 300,000 barrels per day mark. So from where we are today, even though headlines like this are clearly negative for sentiment, the change to balances is not going to be that much because most of Iranian oil is already in the market. The flip side is if you were to actually get significant tightening in sanctions, we're not going to go down all the way to 400,000. You know, the networks, the smuggling networks are bigger and better, but we are likely to go below 1 million barrels per day. So the swing is actually more on the downside than the upside. But I think the problem is the headline skew can continue to remain negative, at least in the next few weeks, because Iran has every incentive to continue painting a picture that, oh, by the way, the talks are positive and it's continuing because they don't want sanctions.
Amrita, you sound incredibly skeptical of how long-lasting some of the effect from these headlines could be. At the same time, I wonder how much signal we can take from the tone of the headlines in terms of what President Trump wants in terms of oil price. We saw that yesterday from Goldman Sachs, analyzing social media posts, saying it seems like President Trump wants the price to be between $40 and $50 a barrel. How much do you get the sense that regardless of whether it's with Iran or whether it's with production, it's going to get there if that's what he wants?
I mean, look, mainly to do with tariffs, right? Like you said, if you are going to put tariffs on the whole world, yes, the ones against China have come down, but we are still at least 10% for pretty much most of the world. And even for China, it is going to continue to escalate. So the global growth picture isn't particularly positive. It's better than what it was a few weeks ago. We've revised up our demand numbers, for instance, versus a few weeks ago, but we're still below where we were at the start of the year. So we're calling for about 800,000 barrels per day of demand growth. We also have OPEC that has accelerated its unwinds for 2 months. If compliance doesn't improve, we potentially could see them doing that again. Again, it's a month-by-month decision, but again, you do have more oil. So yes, we are likely to see prices kind of in this range that we are seeing. If we continue to build stocks, right now stocks are super low, but if we were to build stocks in Q4, which is what our balances show, then you could have even downside risk to prices, right? But I think then, to your point, we will be in that kind of $50 to $60 range, or in the 50s or in the 60s for oil prices. And if that's what, you know, in some ways my point being is that's why Trump gets the low oil prices, but it's not that he's getting the low prices because production has surged. He's almost getting it because demand is weaker because of his own creation.
And Amrita, you think that actually demand isn't going to weaken quite as much as certainly the International Energy Agency said this morning, where they see it really weakening pretty dramatically throughout the next 12 months. Why do you disagree? Why do you see it hanging in there?
So from current levels, we also see it decelerating. I'm just saying versus where we were just a few weeks ago when, you know, tariffs on China were 145%. That would have been catastrophic. We were predicting only 500,000 barrels per day of demand growth at that point for the full year. Now we've raised it to 800,000. It still means that the second half of the year will see more deceleration than the first half because we are also getting a lot of buying, basically demand being brought forward right now ahead of it potentially, let's say, tariffs go back up again, right? We are definitely higher than what the IEA has because we also note that a lot of countries are doing stimulus. China's doing it, Japan, Europe. There will be some offsets. There's also some offset from lower oil prices. I don't think the IEA has necessarily taken those two into account, but the general trajectory is H2 should be weaker than H1.
We're getting lower prices this morning, that's for sure. Amrita, thank you. Amrita Sen of Energy Aspects. Your lower prices look like this. We're down by 3.6%, just holding on to the 60s. On WTI, $60.84. On Brent crude, $63.82. With an update on stories elsewhere this morning, here's your Bloomberg Brief with Yahara. Hey, Yahara.
Hi, John. President Trump says he asked Apple CEO Tim Cook to stop building plants in India. This as Apple was planning to import most U.S.-sold iPhones from India by next year as it tries to diversify manufacturing beyond China. Trump said as a result of their discussion, Apple would be upping their production in the U.S., but gave no further details. Meanwhile, Boeing has landed its biggest ever aircraft order. Qatar Airways agreed to buy up to 210 wide-body planes in a deal worth $96 billion. The deal also provided a record order for GE Aerospace, as the pact includes 400 engines. And shares of Foot Locker are surging more than 80% in the pre-market. Dick's Sporting Goods announcing this morning it's buying the company for an equity value of about $2.4 billion. Dick's said it plans to operate the shoe store as a standalone business. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next on the program, preventing an escalation.
Now we have a mechanism with our Chinese counterparts to prevent an escalation again. I think over the next 90 days, we can accomplish a lot.
Never mind sentiment, never mind happy talk. What is happening with actual physical trade? Up next, the must-watch. Gene Soroka of the Port of Los Angeles.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is a $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on.
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Busy morning coming up. 13 minutes away from numbers from Walmart. Look out for earnings from them later on, 8:30 Eastern Time. So 90 minutes after that, we'll have U.S. retail sales and jobless claims. And 10 minutes after that, you will hear from Chairman Powell of the Federal Reserve. Now, the comments are meant to be about the framework review, but it's an opportunity to comment on the economy if he wants to take it. The price action looks like this. 3 days of gains on the S&P, slightly softer so far this morning. We're down by 0.5%. Under surveillance this morning, preventing an escalation.
It was a very important step in establishing a working relationship with the tariff program. We had a plan, we have a process, and now we have a mechanism with our Chinese counterparts to prevent an escalation again. We're going to go into a series of negotiations. They're going to be fulsome, and we have a lot to talk about, but I think over the next 90 days we can accomplish a lot.
So here's the latest this morning. Talks between the US and China easing trade tensions. Port of Los Angeles Executive Director Gene Soroka with a word of caution, telling the Wall Street Journal, quote, even at a 30% tariff with a 90-day reprieve, it's not going to dramatically change what we're seeing now. Gene Soroka joins us now for more. Gene, welcome back.
Good to see you, John.
Tremendous feedback the last time you were on, so thank you for your time once again, sir. Let's talk about what you are seeing now. What do you see now compared to what this looked like, say, 12 months ago, a month ago?
Yeah, last time we visited, I talked about a quick drop in cargo. We saw that last week, down by more than 30%. The balance of the month seems to be holding, unfortunately, to be down maybe 25% compared to year-on-year stats. Canceled sailings, 17 out of a scheduled 80, still off the books.
So you've got a 20 to 40-day forward look, just based on shipping times. What leaves China now arrives in 20 to 40 days. How has that changed in the last few days off the back of, let's just say, the easing tensions over the weekend?
Just last night, talking to some of my friends in Hong Kong and Singapore, bookings or reservations have ticked up. But it's going to take the liner shipping companies a few weeks to reposition vessels in places like Qingdao and Shanghai, Xiamen, Yantian. Pick up some of the products that have been manufactured and sitting, and then another 2 weeks to get to Los Angeles before we try to distribute throughout the country. So while we're starting to see some momentum, a lot of what's taking place here in the States is the finance game. Does it make sense at an average of averages, 30% tariff to start bringing in products? And what will the American consumer's willingness be to buy?
So Ryan Peterson of Flexport came out and said there's going to be a shipping boom with all of these ships coming to the fore that have been waiting to come to get some clarity on tariffs. It sounds like you disagree. Why do you think that it's not going to result in a shipping boom to make up for that month, with the fact that it's going to be more expensive to make it, say, in the U.S. rather than just pay the 30% tariff from China?
Now, there's a lot there, Lisa, as we've talked about before. Number one, let's pick up some of the product that's already been manufactured, sitting on factory floors, warehouses, and in containers. Get that flow going again. The manufacturers in China have got to get their folks back to work. And there'll be a considerable look at Southeast Asia, albeit at 10% tariffs is where we can go. But this 90-day reprieve, as you know, is not a long runway. That's typically the amount of time it takes for a procurement person here in the U.S. to put an order in, get the goods made, and get them on a ship in Asia.
Which raises the question, does that 90-day pause do enough to make sure that shelves are not empty, say, when back-to-school sales period comes around?
We're cutting it so close. Spring fashion has already passed us by. Now you're talking summer fashion, back to school. May is typically the month where purchase orders go into Asia for the year-end holidays. So now folks are kind of rolling the dice a little bit. Do I buy now at these kind of prices? And remember, when I say an average of averages, not every commodity is a 30% tariff. There are some that are extremely high compared to that, and this is cumulative on top of tariffs that have already been put in place. So once again, what's consumer sentiment? How much do I buy, and how much stock do I get out there?
This is a huge problem. Buyers don't know what to buy, and producers don't know how much to produce, even though we've moved the tariffs over the weekend once again.
So do you avoid the paralysis that many people were complaining about when businesses had no idea, or does this just really ease things on the margins but still create some big lapses? And that really is going to be something that we're not going to see for a couple of months.
Gene, as you look at trade flows, can you describe how things have changed? Whether shipping routes have begun to go somewhere else, whether people are starting to think more about air freight than they are just using traditional shipping. How have things changed from your vantage point in the last few weeks?
A lot. And it's about what do we need just to get by over these weeks and months ahead. And going back to 2018, China was 60% of our business at the Port of Los Angeles then. Today it's 45% and dropping. The folks on the ground in Asia are telling me you'll start seeing even more migration of manufacturing and sourcing to Southeast Asia and beyond.
So the likes of Malaysia, the likes of Vietnam, is that where we're looking to finish the shift?
Thailand, Indonesia. Yes. And of course, a lot has been talked about India. But remember that just last year, China exported about 250 million container units. India, about 20 million.
There's a question not only about manufacturing the goods that will come over here, but also manufacturing the ships. And we know that that's been a huge focus of this administration and potential fees on ships that have been built in places like China. How have some of the proposals like that affected your business?
Right. First thing is, it's another fee. It's another charge that the liner shipping companies say will be passed on and ultimately get to the factory level or consumer. But I'm really pleased with the way the U.S. Trade Representative and that office responded. There were more than 500 public comment letters, 2 days of hearings in Washington back in March to talk about what this fee would mean if implemented based on the draft form, which was $1.5 million for every port call in the United States for a ship that was built in China. Now it's on a tonnage basis, vessel voyage, albeit additive to cost. It's a lot better than it was. So the feedback was really heard by the administration.
I'm listening to everything that you're saying, and it sounds like a lot's going to hinge on how much companies believe they can pass along higher prices to consumers. What, from their perspective, given your conversations with them, do you think they'll be looking for in retail sales, in Walmart earnings, to understand just how much power they have to increase prices on consumers that, yes, are tired but are still spending?
I don't know if I can answer all that, but what I'm hearing on the ground is, okay, prices go up, tariffs, other fees, et cetera. I'm first going to talk with my manufacturer about the cost of those goods, the landed price, and we'll see what we can negotiate. Second, how much do I gain from efficiencies at my company? Can I get smarter and sharper? A little bit of margin compression maybe, but I got to deliver on that cost-saving side. And then thirdly, what can I pass on? If I'm a parts supplier, that cost goes straight to the factory. If I'm a retail finished goods person, it goes to the consumer. So there's still a lot to be worked out. Chances are, with what we know, lower inventories, fewer selections, and higher prices.
And this is why Walmart could be so interesting in a few minutes' time.
Because they've already said they want to compete on price, and they're going to take it probably somewhere else. And it also points to how much they're going to make their suppliers eat as well. So margins all around get compressed in order to offset some of what gets passed along to consumers. The fact that it comes an hour and a half before retail sales gives you a sense of the 1-2 punch, what companies are doing, and then how much appetite consumers have to keep on spending.
We know how consumers feel. What have they been doing? We'll get retail sales at 8:30 Eastern Time. Numbers from Walmart. That stock is up by 0.7%. Numbers from Walmart in about 5 minutes' time. I'm just shocked I said route and not route.
Welcome.
Been here too long.
Welcome.
Been here too long. I did that for you, Gene. It's good to see you.
Thanks, John.
Gene Soroka there of the Port of Los Angeles. Trading routes.
Yeah, look at that. That was good.
Sound like a local,
I'm really
right?
impressed.
Yeah.
Like a local. Yeah, that really made you seem like you are absolutely native.
Very, very American. All right. Equity futures at the moment on the S&P down by 0.5% on the S&P 500. Talk lots about the day ahead. It includes Chairman Powell speaking a little bit later. In the last 24 hours, the Federal Reserve has talked about being a steady hand. And they don't believe that this twin shock, upside inflation risk, downside growth risk, goes away even with that truce over the weekend.
And part of the reason why is exactly what Gene Soroka was just saying. There are certain things that have just fundamentally changed. I will say Mary Daly seemed to echo what Fed Chair Powell said last week when she said yesterday that the word of the day is patience. Patience to see, not guess.
I think we're all losing patience. Up next on the program, Jim Zauter of Apollo, Bloomberg's Tyler Kendall, Joe Feldman of Telsey Advisory Group, and Michelle Meyer of the MasterCard Economics Institute. The second hour of Bloomberg Surveillance, up next.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
the transactions,
Really a record-breaking moment.
Crypto VC is back.
and the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world, and so that has been very lucrative as a business.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, is a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
It's all about the underlying, the internal momentum that we're seeing in this market.
There is something more exceptional about U.S. equities and U.S. corporates.
The decisive move is in favor of international assets.
While markets are up, that is still market volatility.
Sometimes the most important action is not doing anything.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning, good morning to you all. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P 500, just a little bit softer so far this morning, following 3 days of gains in an aggressive rally off the lows of April. We're down 0.5% on the S&P. On the NASDAQ, we're down by 0.6. This hour, a big focus on the consumer. Likewise, next hour, earnings from Walmart just dropping, retail sales dropping at 8:30 Eastern Time, alongside jobless claims, and you will hear from the chairman of the Federal Reserve at about 8:40 Eastern Time. That's your day ahead. Here are the numbers from Walmart. Bramo, what have we got?
Well, the most interesting thing is possibly the adjusted earnings per share coming in higher than expected, but for the full year, the expectation is for it to be below expectations. What does this tell you, given the fact that sales across the board are above expectations? It says that maybe they're going to be taking it on the margins. What you see across the board is this real strength. The earnings per share for the first quarter is 61 cents versus the estimate of 58 cents in the Sam's Club unit, also seeing a gain of 6.7% versus an estimate of 4.93. But again, the idea that for the full year earnings per share is going to be lower signifies how they're going to take the hit on the margins in order to gain market share.
For how long? Standout quote of the morning. We will do our best to keep our prices as low as possible, but given the magnitude of the tariffs, even at the reduced levels announced this week, we aren't able to absorb all the pressure given the reality of narrow retail margins. The latest this morning from Walmart.
This, to me, is going to be the struggle. If Walmart is having trouble absorbing all of the potential increase through discussions with suppliers and potentially taking a hit to their margins, what does that mean for everybody else who doesn't have the same number of levers to pull? And that, I think, is going to be a real question embedded in that earnings call, which I believe is happening right now as well.
Stock is up at a pre-market by more than 2%. Equity futures recover somewhat. We're still lower by 0.4%. Busy hour hour ahead. Coming up, Jim Zelter of Apollo, with the rally showing signs of exhaustion. Joe Feldman of Telsey Advisory Group reacting to Walmart earnings, and Michelle Meyer of MasterCard on why underlying consumer fundamentals remain strong. We begin this hour with our top story. President Trump saying India has offered to drop all tariffs on U.S. imports. Joining us now from Abu Dhabi is Anne-Marie. AMH, what's the latest?
Well, President Trump there, Jonathan, talking about India, saying that they had one of the highest tariff barriers in the world and they're prepared to drop it. So basically setting the scene that maybe India will be next when it comes to a group of these countries that can get across the finish line with this administration to inking some sort of agreement. What was more interesting is what the president said immediately after that. He said he spoke to Tim Cook of Apple. He has a bit of a problem there. What we know what Apple's been doing is trying to move manufacturing and production of iPhones from China to India. That would be a de-risking of China, but that doesn't seem to be enough for President Trump. He said, why are you building in India? India doesn't need the help. Come build in the United States. What is interesting, this is the second time on Trump's Middle East tour that he called out Tim Cook. The first was on Tuesday. He was speaking to investors in Riyadh, and he saw Jensen Huang of NVIDIA in the audience and said, my friend Jensen is here. Tim Cook isn't here, but you are. And then once again in Doha, he's calling out Tim Cook and Apple, saying, stop moving your production to India, which really is the key to Apple right now in terms of trying to move their supply chain out of China. And he's saying, we want you to come to the United States.
Anne-Marie, on the ground in Abu Dhabi, with some of the power brokers alongside the president coming from the world of tech. I have to say, the biggest power brokers we've seen over the past few weeks didn't come from the world of tech at all. They came from the world of retail. I keep going back to that meeting several Mondays ago in Washington, D.C., between the biggest retailers in this country and the President of the United States, which many people believe led to the truce we saw over the weekend.
And the threat of empty shelves heading into the back to the school season. And we just heard from Gene Soroka that still is a question mark as companies try to figure out the new landscape that they're trying to order in. The fact that Walmart CFO is saying that price hikes from tariffs may start this month, this coming out in news reports right now, gives you a sense of the pressures that are going to be building at a time where even though tariff rates have come down from some of the worst case scenarios, they still are materially higher than where they were at the start of the year.
That's a warning from Walmart this morning. Here's the view on Wall Street. Jim Zelter, the president of Apollo Global Management, weighing in on the administration's trade regime the last time he joined us, saying this: globalization is not going to be like we have seen it in the past. It is a new global world order. I'm pleased to say for the next 30 minutes, Jim Zelter joins us this morning. Jim, good morning.
Good morning.
There's a phrase you used last time around that stuck with both of us. We've been repeating it over the last several weeks: macro paralysis. Can you adjust that term now? What phrase would you use to describe this moment?
First of all, it was good to be here. I think I would frame it right now as a macro political pivot. The administration, clearly, I agree. I think that Monday meeting with the retail executives was I don't want to call it watershed, but it was a critical moment for the administration to hear about the challenges on the ground of their plan. And the administration certainly has not admitted they made a mistake, but they've clearly pivoted. And that's not a surprise, and it's not a surprise that they're out going around the globe right now trying to and successfully inking a lot of deals, a lot of MOUs that are non-binding, but certainly it's great headlines, and it's hundreds of billions, if not trillions. But so that's where I think the big question now is, I'll pull back in the COVID library. There's a big gap between confidence, sentiment, and the results. And confidence and sentiment is still pretty negative or concerned, but the results have been pretty strong. And so there's a very, if you think about, we're all, history of the past, and we see signs of what we've seen in the past, and pattern recognition, if you will. And, if you input all the things that you see right now, you would have been saying recession went from 30% to 70, 80%. Now it's probably below 50%. But the three questions are, does the consumer, do corporates and countries, are they going to be on the V-shaped recovery, the U-shaped recovery, or the L-shaped recovery? Our view at Apollo is right now that the consumer is still pretty strong, a bit of a V-shaped recovery. Corporate's a bit of a U-shaped recovery because a lot of CapEx. And I've been traveling around quite a bit, and I think the global response is a bit more like the L. And what you pointed out earlier, what Anne-Marie did with Tim Cook, I am not surprised. None of us should be surprised that this administration is going to put their arm around all of these tech titans and other leaders and saying, come to America. China was not the plan. We didn't love the idea of going to India. Come back to the U.S. This is going to be a theme that they're going to keep hitting.
Is there enough of a framework that you're gleaning from this administration that's solid to bring deal-making back? We've seen on the margins some deals being made, some IPOs. They're just a few. Is this the beginning?
Well, I think let's separate the headlines from activity. It's been an incredibly active time for folks that have been involved in the markets. You know, we at Apollo, we opened up the IPO market. We brought out Aspen, one of our reinsurers, for an IPO. We did a multi-billion-dollar deal for Lottomatica, IGT Every. We announced a big merger between New Home and a Land and Sea. So there's been a lot of transactions since April 2nd. I know the headlines may show contrary, but there's been a tremendous amount of financing, and I think it shows the depth and breadth of the markets right now because of private capital in the equity and the credit world. So this idea that the market shut down, that's actually what happened 2 decades ago. 2 decades ago, the high yield market would go into periods 6, 8, 10 weeks where there would be no issuance based on the flows from retail, the old AMG numbers. So this economy, this capital markets is very robust. Obviously, a lot of volatility. You know, one of the benchmarks in our market would be HYG, the high yield index, the listed HYG ETF. That went from basically 79.80 down to 73, 74, back to 79. It's been a round trip, but there's been a tremendous amount of activity underneath the headlines.
How much do you think this is because people see the environment as being brighter than some may worry? And how much do you see this as just simply pent-up demand that's been backed up for a long time? There is this sort of cyclical move toward industrialization, and you have that kind of fundraising that is kind of independent of any economic cycle.
I think the bigger long-term trends of massive CapEx, the year or two of CapEx, global industrial renaissance, the demographics, every asset class is higher today as we sit here this morning than it was on Liberation Day, except for treasuries, which have 10-year basically 30 basis points higher, and the 30-year about 40 basis points higher, about 5, 50, and 6% respectively. That's telling you that folks think that the economic backdrop is not going to be a recession. It's going to be slow to moderate growth, and that's what you're seeing right now in the market. So that's what we're seeing from our companies. We're seeing a lot of concern, a lot of hand-wringing about big strategic M&A transactions. I don't think you're going to see a massive equity calendar except for a few large deals here and there. But the reality is companies need to operate, finance, and grow, and they're positioning themselves for an environment that the administration's putting forth.
This is what companies need. Let's spend some time talking about what investors need. Never mind the rebound. What did you learn from the drawdown, public versus private?
Well, what you saw is that I come up here a lot and talk about market structure, and what you're finding right now is that longer dated capital is us and many of our peers have long dated insurance assets. Those were the folks that were the most active during the marketplace. And they were a bit of the buffer, if you would. You know, we put about $27 billion to work in the IG market from April 2nd to last week. That's on a gross basis, about 17, 18 billion. I think in the past, that participant was not in the market as much. And the buffer from the Wall Street bank trading desk taking that balance, I think that we collectively as an industry helped out. So you didn't see as much volatility. There's a lot of cash on the sidelines. There's a tremendous amount. And again, as you see what's going on right now around the globe with, you know, the pension assets, DC assets, other assets, really trying to get long duration assets against their liabilities, it's really, really critical. I mean, the one big overhang that's still in the market is what's going on in the Treasury market. You know, certainly if you pivot right now to what's going on with the budget issues in DC, it doesn't look like they have a clear path to a deal that would be really deleveraging to the U.S. over time. Now, Bessent is saying a lot of great things, but Treasury rates are higher, and you know, as we've been saying, the one real left tail risk for this administration is the Liz Truss moment. Is that still out there? It's not a zero. It's not a big number, but it's a left tail risk for this administration.
Can we ask you what you think that looks like? What does a Liz Truss moment look like in the Treasury market?
You know, it's the deepest, most liquid, broadest market in the world, and I don't really participate day to day, so I'm not. It really is, it's a confidence issue, and it's when that stream of confidence goes from not being substantial to being a little bit more material. And I don't know what that number is, but certainly it's got to be in the back of the head of the administration. And again, the prior administration did not really extend duration in their liabilities. So there's I think, I don't know if it's 7 or 9 trillion of refinancing over the next 24 months. It's a big number. But these rates are real. Rates are real in terms of where they are right now. So you are finding buyers of that paper, but it is a challenge in the backdrop.
There is this belief that private credit markets offer this ballast, this sort of haven from some of the volatility that we're seeing in public markets, and in particular from the Treasury market. At the same time, how can you say that private debt in particular is really immune to the fluctuations and the sucking sound of capital into the Treasury market, given all of that issuance?
Well, I'd say 2 things, and this is a longer conversation that I do want to get into. Real rates are higher, and if you can in private credit, you know, high single digits, low double digits on a compounding basis, it's a tremendous asset class over a decade or 2. I really want to spend some time with you both this morning talking about, you know, these comments about private credit being a bubble. You know, that's just a mistaken comment, and when you really break it down, as I said before, private credit in the traditional manner, the narrow manner, is the high-yield market, the leveraged loan market, and now the emerging direct lending market. When people talk about a credit bubble, it's just not the case. What they are talking about is there could be a credit cycle. That's normal. We haven't had one in a long time, but that credit cycle will impact debt and leveraged balance sheets, high-yield, leveraged loans, and direct lending. It'll also affect private equity. It'll affect equity multiples. But it's not a bubble per se. It's a good old recession and a credit cycle. We're going to have one of those. It may be pushed out again a year or 2, but let's not go out there. I think folks that are not in private credit or private capital say, oh, it's a bubble because they're not involved. But the reality is there's lots of opportunities. There's a massive amount of opportunities. We were very active last month. Boeing decided to spin off its aircraft, one of its businesses. We worked in conjunction with Citi on it, multi-billion-dollar deal, a tremendous asset, heated auction. There's opportunities for real companies, but there will be a credit cycle.
It's always a bubble when you're not invested in it, right?
I love that.
Isn't that a takeaway?
Yeah, basically. If you don't like it, it's because you're not in it, and so too bad for you.
Jim, we're going to make some time for that conversation in just a moment. Jim Zalter of Apollo is going to stick with us. Equity futures at the moment on the S&P, just an update there for you, negative by 0.4%. With an update on stories elsewhere, here's your Bloomberg Brief with Yahara. Hey, Yahara.
Hi, John. We start with Walmart. Those shares are up nearly 3% in the pre-market after it reported first quarter sales and earnings that beat analyst estimates. Despite the strong results, the company warned tariffs and economic uncertainty will lead to price increases. Meanwhile, Starbucks is considering options to revamp its China business. Sources telling us here at Bloomberg, the company has contacted private equity firms, technology companies, and even considered a possible stake sale. Prospective bidders are expected to submit initial feedback in the next few weeks. And United Health is under criminal investigation for possible Medicare fraud. That's according to the Wall Street Journal, which is reporting the Justice Department has been probing the company's Medicare Advantage business since at least last summer. United Health said in a statement late yesterday that the DOJ hadn't notified it about the reported investigation. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate the update. More from Yahara later this hour. Up next on the program, Republicans looking for a deal.
I will tell you, I'm absolutely confident we're going to be able to work out a compromise that everybody can live with. Virtually no one's going to be 100% satisfied with every piece of the bill. It's just not possible.
Up next, we'll catch up with Bloomberg's Tyler Kendall live from Washington and get more reaction from Jim Zelter of Apollo, live from New York City this morning. Good morning.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
US retail sales due in about 1 hour and 11 minutes time. Going into that, equity futures still softer by 0.5% on the S&P. Under surveillance this morning, Republicans looking for a deal.
I am trying to be the sort of the neutral umpire in the negotiation and build consensus, so I won't come out here and handicap it and tell you numbers and all that. But I will tell you, I'm absolutely confident we're going to be able to work out a compromise that everybody can live with. Look, when you have a bill this big, with this many pieces and this many components and this complex and comprehensive, virtually no one's going to be 100% satisfied with every piece of the bill. It's just not possible.
So here's the latest this morning. Speaker of the House, Mike Johnson, working to advance President Trump's economic package before Memorial Day. Joining us on one of the big sticking points is Bloomberg's Tyler Kendall. Tyler, let's talk about that sticking point right now, the so-called SALT lobby, and they're pushing hard.
Yeah, hey, John, they definitely are. And we could get some updates later today. House Speaker Mike Johnson is set to meet with some of these lawmakers from those high-tax states like New York, New Jersey, and California. But there's also reporting that he's inviting some House Freedom Caucus members, these fiscal hawks who say that the higher the SALT cap goes, ultimately that means they're going to have to find some more savings. Now, one of the proposals that we're learning could be on the table is what's being called here in Washington 40-80. It would result in lifting the SALT cap from $10,000 to $40,000 for individuals. You then double it for married couples, and that's how you could get to as high as $80,000. Now, to be sure, House leadership has not confirmed that they are looking at it, but we have heard from at least two of these House lawmakers in the so-called SALT caucus who says that's a number that they could get behind. And that could be important because they have already said no to the $30,000 proposal that's currently in the legislation as written. So perhaps 40-80 could be that sweet spot. We're going to have to wait and see how this all shakes out. A few other areas where we could see compromise, of course, could be income limits as well as what expiration dates could look like. Because as you well know, many of these tax provisions in this bill are set to expire before President Trump leaves office in 2028. So perhaps this could be one of those areas up for negotiation.
Tyler, thank you. Tyler Kendall with the latest in Washington. Still with us, Jim Zelter of Apollo Global Management. Jim, we talked about the prospect of a credit cycle. How can we have a credit cycle when we're running deficits this large in Washington?
Well, I mean, as I said before, we've been waiting for those who have been professionals in this sector for decades would have expected a few things right now. And I've talked about pattern recognition. I was here several years ago talking about the rate hike and how that would create a period of tighter financial conditions. And many of us that were expecting a serious credit cycle, predicted something that didn't occur because of the macro backdrop. Certainly right now as we have a higher rate environment, which means a bit of economic strength in the overall economy, there always are a number of companies that just have too much leverage and are not going to grow out of their balance sheets. And you're going to see that. Last couple of years, you had actually fairly high numbers of restructurings in non-investment grade credit. It just didn't overwhelm the headlines because of the overall returns and the strength of the equity market. But I do think there are, as I said before here, when you look back in the last 4 or 5 years in private credit direct lending, a lot of the largest sector of financing was technology and enterprise software. And I do think that there's a possibility with what's going on with AI that many of these companies could really have massive impact on their operating business. The renewal rates that are 80, 90, 95% could plummet dramatically. And I could see a variety of challenges in the enterprise software tech space that have been a big area of private credit. And I think there will be those who are not involved will say, aha, there was a problem, it's a hoax. That's not the case. It was just bad companies, over-levered, that didn't grow out of their balance sheet. And that happens every day in the equity market and other markets. But, you know, as much as we are a player in the insurance balance sheets on safe yield, we also do play in that riskier end. And I don't see a massive credit cycle happening in 25. Certainly, we've taken care of a lot of the refinancing risks, that refinancing cliff that was pretty large in 26 and 27. It's been pushed out. But we're not seeing, although the risk premiums have been raised. And I will tell you, there's a very large U.S.-based retailer based here in New York that has undergone a transformational merger. They had a private credit solution in front of them, which we were quite involved with. They decided to go to the public markets and issue a public bond in the safe public markets. And that bond today, within 6 months, is trading below 50. So again, I think there's a lot of noise about risk and reward in various asset classes, but that's our view of private credit.
Just quickly, how much could higher long-term U.S. yields spur that credit cycle? I won't call it a bubble, because we could talk about what a bubble is, or what what we could see with some sort of just negative price action. But do you see that as being a catalyst?
Well, I think that the overall, having higher real rates are good for long-term investors to a certain degree. They're good for a certain degree until we lose confidence in the actual underlying market. And again, the U.S. Treasury market, deepest, most liquid in the world, rates of 4.5% and 5% with real rates right now, pretty strong on a relative basis over the last 25 years. But I'm not seeing that in the current zip code.
Just to wrap it up, biggest opportunity right now for you and the team. What do you think it is?
Well, I think it's a few places. I do think the volatility that has taken most people on the sidelines in a bit of a paralysis, just operating day in and day out on the business that we do right now. We have $850 billion of capital, doing a lot of refinancing with PE firms. There's over 2,000 PE situations where they've owned companies more than 5 years. A lot of refinancing there. Listen, the global industrial renaissance is alive and well in the U.S. With the delay in deploying the CHIPS Act, a lot of financing onshore of chip manufacturing and other assets. I've been traveling around the globe quite a bit. You know, Japan's still quite interesting from a insurance perspective, from a global wealth perspective, and a PE perspective. And we cannot forget about Europe. I mean, Europe really is what's going on there. It's a once in a generation. I do believe that there's a variety. When you look at a 30 trillion economy in the U.S., 24 trillion in Europe, there's a massive amount of financing to occur.
You've been traveling too much. It's good to have you back.
Good to be back.
Welcome back to New York, Jim Zelter of Apollo Global Management. Jim, thank you, sir.
Always,
appreciate it. Coming up next, we'll talk about retail and Walmart. Joe Feldman of the Telsey Advisory Group, live from New York City. You're watching Bloomberg TV.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Walmart, the main mover in the pre-market. We'll get to that name in just a moment. 60 minutes from now, U.S. retail sales. The consumer in focus this morning, stateside. Equity futures down 1/3 off the lows on the S&P 500 with 2 hours until the opening bell. Here are your morning movers with Danny Berger. Hey, Danny.
Hey, John, let me show you that move in Walmart. It is higher in the pre-market, 2.3%, a really solid set of results. The numbers on the upside of what was expected, but perhaps it's the commentary that was the most interesting. The CEO saying that they can't keep absorbing price pressures forever, that sales were choppy, and because of the thin margins, at some point they just can't keep prices as low as they currently are. I know you'll be discussing more in detail of those earnings in a moment. In the meantime, we're also looking at Coinbase falling down this morning, down 1.7% in the pre-market trade. The company says it was the target of what it is calling cyber criminals who have demanded $20 million in ransom pay. Coinbase says that it refuses to pay that amount. It is compensating customers who've been affected by that attack. It says that nothing like funds or, for example, really sensitive information was taken by what it calls cyber criminals. Finally, we also got some earnings from Deere this morning, the agriculture tractor company. It is unchanged. It was higher just moments ago, but the fact it's unchanged is a good sign in itself because it lowered the low end of its range of forecasts, saying that it might be lower now what the results will be for this year given the tariff uncertainty, but perhaps that's not as bad as expected given that Deere is often caught in the crosshairs of Donald Trump, and its forecasts do fully incorporate what it says will be the damage from tariffs. John.
In the headlights, Danny. Caught in the headlights. Deere in the headlights.
Ooh.
Next time. All right. On our radar this morning, President Trump with some choice words for the Apple CEO.
I had a little problem with Tim Cook yesterday. I said to him, Tim, you're my friend. I treated you very good. You're coming in with $500 billion, but now I hear you're building all over India. I don't want you building in India. You can build in India if you want to take care of India. We want you to build here, and they're going to be upping their production in the United States, Apple. So Apple's already in for $500 billion, but they're going to be upping their production.
It's one of my favorite versions of Donald Trump, the President of the United States, when he riffs like that and just reveals a conversation he had with a major CEO in corporate America and the pushback he gave them.
I had a little problem with him. Hey, Timmy, I want to talk to you for a second. This whole thing about moving production to India, not a great idea. Look, this to me highlights the uncertainty that persists among a lot of corporations, how they get manufacturing back to the United States that a lot of people say is just not possible from a financial standpoint unless you raise prices dramatically. And certainly that's what we heard from Dan Ives, right? That the price of an iPhone would more than double if they made them over in New Jersey. There's also a question of the whole worker base, right? And people are trained to do these kinds of things. And what would you have to pay someone, and then would you even have the stable of talent to do it?
They've got fat margins, they've got options. Other retailers do not. I want to get to this Walmart quote again. We'll spend some time on Walmart in a few minutes' time. But this quote that came from them this morning: we'll do our best to keep our prices as low as possible given the magnitude of the tariffs. Even at the reduced levels announced this week, we aren't able to absorb all the pressure given the reality of narrow retail margins. That's the warning shot again, from retailers in America.
Saying that potentially they could start raising prices as soon as this month. They also said the lack of clarity that exists in today's dynamic operating environment, there's that word dynamic again, thank you McKinsey, makes the very near term exceedingly difficult to forecast. This is the world's biggest retailer. This is the one with the biggest negotiating heft. This is the one that really tries to have the best prices and has said they want to compete on price. They cannot do that without having to raise prices, at least on some level.
Which is why the Fed can't signal the all clear. The billionaire Steve Cohen can't either. He says the chance of a US recession is 45%, thanks to, quote, significant slowing growth. Cohen adding he doesn't see the Fed cutting rates anytime soon because, quote, they are going to be worried about inflation from tariffs.
This is something that a lot of people are building on, that yes, you have seen the range of outcomes shrunk to some degree, but there still is a very real risk of a stagflationary type of environment. Back in February, I think it's important to mention that Steve Cohen said at a conference in Miami, I think this is one of those moments where there's really a lot of uncertainty. Tariffs cannot be positive. I mean, it's a tax. And you can imagine tit for tat if the U.S. does something and implements a tax on somebody or something else is going to raise the response. Meanwhile, what you're going to get, slowing immigration, it's not going to be a positive backdrop for the economy.
They can be positive, depending on the goal and depending on how they're calibrated and how you execute. If you want to protect a growing industry, tariffs can work. I think if you're going to go broad-based, universal tariffs and introduce lots of volatility where people don't know the rule from 1 week to the next month, to the next year, when you've got to build a factory over 5, 10, 15, 20 years, that's where things get really complicated.
The uncertainty is the tax, in addition to the actual tariffs, and that uncertainty is persisting. I mean, even though we've gotten these delays of 90 days, there still is a lack of understanding of what the goal is, especially as we talk about the budget, and we talk about how much a potential offset could come from tariff revenues. How do you then use them in this sort of targeted way to support specific industries?
More on that in just a moment. I just wanted to squeeze this in, a really important developing story. United Health under criminal investigation for possible Medicare fraud. The Wall Street Journal reporting the DOJ has been leading a probe into the company's Medicare Advantage business since last summer. Their stock is down in the pre-market by 6.5%. It has cratered, literally crashed over the last several months.
It's had a lot of bad news coming at it from a whole host of things, from the gutting down of its CEO to potential stepping down of the current CEO and questions about its visibility into the future. They had a previous long-running Medicare fraud trial that they actually got dismissed in March. A real question here about how much this is the structure of billing that is under question, because a lot of these insurance companies get paid a lot more for the sicker patients. So if you end up saying someone's sicker, does that give you bigger revenues? And this is something that is a trend that people have been following.
Questionable incentives, let's put it that way. That stock is down in the pre-market by more than 6%. We've mentioned Walmart a few times, so let's get to it. Reporting a solid first quarter, but withholding income guidance for the current quarter. The retail giant warning price increases are on the way due to trade uncertainty. Joe Feldman at Telsey Advisory Group has an outperform rating on the stock with a price target of 115. Joe joins us now for more. Joe, that stock is up this morning by 1.9% in the pre-market. Just your initial thoughts off the back of these numbers we got 36 minutes ago.
Yeah, so I thought that the quarterly report was very good. It was a little better than expected in terms of sales and on earnings. And they maintained their guide for the full year, another thing that we were anticipating them to do. Now, the second quarter guide, sales came out better than expected, at least the constant currency guidance, 3.5% to 4.5% sales growth. That's definitely pretty solid. So they're still seeing the top line. Though they gave or didn't give guidance on operating profit, they said, you know, there's a wide range of outcomes, which I think we're going to hear a lot from others that as they report. And it's not surprising in this environment. I mean, tariffs are creating a lot of uncertainty and causing retailers to need to take price increases, which, you know, Walmart is going to be one of them doing that as well.
Joe, how surprised were you that they indicated that they could be raising prices as soon as this month, that they really cannot simply absorb the prices in their margins? How surprised were you that that was the message, given some of their previous messaging that they wanted to compete on price?
Well, I think Walmart is still going to be the lowest price retailer out there, even if they do raise price. In a sense, Walmart gives everybody else an umbrella to kind of raise prices up a little bit higher as well for themselves, because usually people try to compete with whatever Walmart's price is. Now, it is a little bit sooner than we anticipated. We thought maybe it would have been more June, July, where we would have seen that. But, you know, we are kind of mid-May at this point, so we're sort of there. And it makes sense, you know, at the moment, there's a 30% tariff on everything that comes in from China, 10% on the rest of the world. Prices are going up. Walmart can spread it around better than most because of all the different units that they do sell, and they have a very broad portfolio of goods. So you don't have to necessarily raise the price of the item that goes up by 30% on the tariff. You could spread that to other places. Plus, they have buying power, negotiating leverage. They're working with their supply chain and their vendors to be able to, accommodate and take on some of that price increase as well related to the tariff. But very clearly, tariffs are causing a price increase on the consumer.
Joe, we'd love you to build on that. There's an experience we have in the West that I think we all take for granted. We walk into a store like Walmart and the shelves are full. They're always full. These companies are very good at making sure the shelves are full and bringing that product in on time, just in time for all of us to consume. Joe, how much harder is that getting over the last few months, and how have they been handling that situation?
Yeah, well, I think the retailers have brought in inventory a little early to maintain that shelf stability and be able to have good in-stocks. The reprieve that we just got, based off of, what Treasury Secretary Bessent's negotiations, to get to a 30% tariff definitely helps a lot, because now we were concerned that kind of June, July, August, back to school period is when you were going to start to see some empty shelves. Now inventory can start to flow again. And it's interesting because if you look at the Walmart US business, their inventory was up 4.5%. Now, sometimes people would be upset that it's up that high, but I'm not in this environment. You want to have that inventory on hand to be able to sell. And very clearly, Walmart's the one that's getting traffic. I mean, their transactions were up 1.6% in the US. The Sam's Club business was up like 4.5%, 4.8%, I think. So they're seeing good demand for the goods, and they'll sell through that. So I do worry that there are others that you could start to see some empty shelves in some spots. But for the most part, given what we got with the tariffs being lowered for the next 90 days, I think we'll be okay.
Joe, we've gotten mixed messages. On one hand, the sentiment surveys indicate that the consumer is feeling very nervous and is withdrawing some of their purchases, particularly for large ticket items. At the same time, we haven't seen that consistently across the board in either retail earnings or some of the data that's come out of the United States. I'm just wondering, given the fact that Walmart is showing a willingness to raise prices this quickly, does that indicate to you that the consumer can absorb it, that they are strong enough to actually say, okay, I'll keep buying at the same pace?
Well, we haven't seen a very resilient consumer. Unfortunately, all of us have gotten used to higher prices over the past 4 or 5 years, and continuing to see higher prices. And, at the grocery store, you see that pass through pretty quickly when commodity prices like eggs or milk change. And so I think that, unfortunately, we are more used to it. We are able to handle it. Now, that is starting to fray a little bit. You're seeing a more pronounced paycheck cycle for that lower income consumer. The more middle to upper income consumer, you're seeing some trade down activity. You're seeing more purchases of private label goods or bulking up on multi-pack purchases when they're in the store. The good news from Walmart's perspective is they do, even with raising prices, will have the lowest price. Plus, they sell 60% of what they sell is groceries. The largest grocer in the U.S., they're getting the customer every week to come in, and they'll be able to maintain that strength. I do worry about other areas in retail. Some of the more discretionary names are going to have some pressure in this environment, because you have seen, really for the past year plus, the consumer has been has held back a bit on discretionary goods.
Who are you worried about, Joe? You said it a couple of times. Who specifically are you worried about?
Well, look, there are definitely those that are quite discretionary. I think there's a lot of concern from the investor community what Target might look like when they report. We think that the consumable side of their business will stay robust, but there's some concern that the discretionary side of the business will be tougher. The department stores remain pretty soft, and we think that's going to continue. So those are a couple areas where there is a little bit of incremental concern.
Target next Wednesday. Joe, appreciate your time. Joe Feldman there of the Telsey Advisory Group. I had Target in mind for a different reason. Inventory had a few problems over the last few years. I'm thinking back to May 2022. I think at the back end of 24, struggled to make sure they had things on time, then got it wrong the next time around.
This is just impossible. I mean, you have too much, you have too little. They were penalized for having too much. Are they going to get penalized for having too little? It is incredibly difficult managing through this cycle. But now, if you also have the lack of the grocery business to really uphold some of the just foot traffic, how do you deal with a business cycle, an economic cycle, a trade cycle, and then a technological cycle on top of it? It's not easy.
A price warning from Walmart this morning, the big takeaway from retail. We'll have more comments on that in just a moment. Let's get you an update on stories elsewhere this morning. With your Bloomberg Brief, here's Yahira. Hey, Yahira.
Hi, John. President Donald Trump said India has made an offer to drop tariffs on U.S. goods as part of its ongoing trade negotiations. Trump made the comments today at a meeting with business leaders in Qatar. An Indian official told reporters later in the day that trade talks between India and the U.S. are ongoing and any judgment on it would be premature. Also today, President Trump said the U.S. is close to reaching a nuclear deal with Iran. The president referred to an NBC News report that said Iran would be willing to give up nuclear weapons in exchange for sanctions relief. Iran's foreign minister suggested the two sides are not close to a deal, saying he hoped for a more realistic approach from the U.S. in the next round of talks. And Shein lowered U.S. retail prices this week after the Trump administration temporarily cut duties on Chinese imports. Shein sent a price drop alert to U.S. consumers yesterday, touting reduced prices across a range of styles. They promised that shoppers wouldn't be asked to pay any tariff-induced fees or additional costs at checkout. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in the next hour. Up next on the program, a fragile consumer.
The consumer is still fragile, and that consumer confidence has been a cautious point. It's something we're watching, in the seesaw of consumer confidence is key.
Up next on the program, Michelle Meyer of the MasterCard Economics Institute. We've had the earnings from Walmart, a warning on prices, just around a corner, 46 minutes away, U.S. retail sales.
The President of the United States does say he wants to keep a more mutually beneficial trade balance with these countries. What does a country like Egypt and Kenya and some of these others have to provide that won't completely dent their own GDP?
No, it's tough. I mean, there is the commodity side. There is the. I think it's less about bringing it to the table and more trying to take advantage of the hit elsewhere. So China exports 30% of all the textile exports to America come from China in 2023. It's something like $40 billion. And whatever the tariff rate ends up being on China, it's going to be a lot higher than it is on Africa. So there might be scope for African countries to say, well, let's move those textile factories.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Three-day winning streak on the S&P 500. A bit of an interruption this morning. We're down by 0.4% on the S&P. Check out Walmart. Numbers were pretty decent. Stock is higher in the pre-market by 1.6%. But the standout quote of the morning from the CEO: "We'll do our best to keep our prices as low as possible, but given the magnitude of the tariffs, even at the reduced levels announced this week, we aren't able to absorb all the pressure given the reality of narrow retail margins."
What this really makes evident, and Joe Feldman pointed this out, this basically gives a free pass to all other retailers. It's okay to raise your prices because there really is no other way to absorb these tariffs. And that is going to be something a lot of retailers will hear.
It's a warning shot this morning, that's for sure. Under surveillance this morning, a fragile consumer.
The consumer is still fragile, and that consumer confidence has been a cautious point. And as people have paid more for food and still feel inflation now, they've been skipping trips on apparel, skipping trips on things they don't necessarily need. It's something we're watching, in the seesaw of consumer confidence is key.
So here's the latest this morning. A slew of companies warning of a spending slowdown. This as investors wait for the latest read on US retail sales. Michelle Maher of MasterCard Economics Institute writing, "There are significant risks, but at the moment consumers are still engaged and spending." Michelle joins us now for more. Michelle, good morning.
Good morning.
We know how they feel. Not great. Seen that in the sentiment surveys. What are they doing, and how have they changed behavior?
So that is so important in this discussion, is what the data is telling us they're doing now versus what they're saying or what the fears are of both companies and of consumers. In terms of what they're doing now, they're spending. And they're spending in a fairly trend-like basis relative to what we've seen over the last year. And I think the main reason for that is that they still have purchasing power. The labor market is still supported. If you look at the last several jobs report, we're still seeing strong job creation, a low unemployment rate, wage growth that is running above underlying price pressure, even with the threat of tariffs at the moment.
So why are we hearing that consumers are fragile?
Yeah.
Where's the disconnect?
I mean, I think that that's been the narrative for a really long time. The consumer's going to crack, the consumer's going to crack. Just wait for it. And then you see this resilient consumer continue to come out time and again. And I think a lot of it is because you have a labor market that has been strong. You have labor force participation that's been robust. And you've had a lot of choice for consumers over the last several years. Consumers have been able to navigate the pandemic very well. And now we're looking ahead to see how they'll be able to navigate this tariff environment.
So this really goes to the ultimate question, which is how much of the price increases that seem to be evidently coming not only from Walmart, but other retailers as well, as soon as potentially this month, how will consumers be able to absorb that?
So that is the big question, and that is where the risk lies. As you talked about that opening quote, there's lots of risks out there, of course. And the pricing environment is a big one. So the question is, what do consumers do with that, given that they're not going to see the same degree of increase in wages? So they're going to have to try to absorb in some way. And I think what we'll end up seeing is consumers that try to shift their basket as nimbly as they can. So if it's for discretionary items, discretionary goods where prices increase, they may try to buy a little bit less of that or buy different items. They're very savvy consumers. We've seen that over the last several years. When faced with the pandemic, they bought goods, then they went to services, then they bought certain types of experiences where they found the most amount of value. And I think that's what we're going to see to some extent with the consumer to the path that they can't do that for more of the discretionary items. For the necessities, it's going to be harder.
The first warning we saw didn't come from the retailers, it came from the airlines, it came from the doubters, not the Walmarts. Are you seeing that already? Never mind the outlook, are you seeing people shift from discretionary to make sure they can afford everyday items, the necessities?
So here's what's really interesting about two things that you mentioned there. One, in terms of the retail sales report that we got yesterday. We're going to get the update, not yesterday, last month. Yeah. Time is flying. We're going to get...
It's all the same thing. It's a blur. I'm with you,
really
Michelle.
We're going to get the next round of data out any moment. And what you saw there is discretionary goods were up very strongly. You had a big increase in furniture. Apparel did well. Electronics did well. Maybe that's some evidence of a pull forward of spending.
Well, let's talk about that. Is it evidence of just a front loading? Is it just flattering the underlying data?
Again, I think it's evidence that the consumer is going to do their best to try to navigate this. They are aware and worried about higher prices. They are aware and worried about being able to get their goods in the future. So the extent to which they can prepare for that, I think they're trying to do that. But that takes me to the travel economy as well. And we just published a report out this week. It's our big annual report on the health of the travel economy and what consumers are doing and how they're participating in travel. And yes, there's been some shifts clearly that have happened in the last few months. But if you look at forward-looking bookings data, if you look at where consumers have been traveling and why, you still see a consumer that is out there traveling, and increasingly, what we found, traveling for purpose, for value.
There's been a question about the upper income consumer and how much it can continue to power this economy in a massive way. And that even though you are seeing those cracks that you talk about, and you really are seeing them in significant ways, particularly for lower and lower middle class families, how much do you see the upper class continuing to spend at the same pace that they have in the past few years, which has been one of the stalwart features of this bull market?
Yeah, well, certainly the story of higher income consumers driving spending was transparent the end of last year, the holiday season. That is significant above expectations numbers that we saw for holiday sales had a lot to do with the upper income consumer who had just experienced a very favorable equity market and had a lot of wealth to be able to lean in on. Earlier in the year, obviously, it was very volatile. It was a moment where we were trying to see, okay, is the wealth effect going to stay positive? How are consumers, higher income consumers, going to navigate it? But, I mean, look at the markets now. They've obviously become a lot more favorable again. And I think even for upper income consumers, it goes back to the health of the labor market.
Steve Cohen of Point72, also the owner of the Mets, who a lot of people really like as a result of that, has come out and said he sees a 45% chance of recession still, even with some of the walkbacks of the tariff policies. It sounds like you completely disagree based on some of what you're just talking about.
Yeah, I don't see evidence that the economy is falling into recession. Anything is possible. We could always be one shock away. That's why recession probability is never zero. But the data is not indicating that a recession is around the corner. I do think we have to pay a lot of attention, again, to the labor market. We have to pay a lot of attention to small businesses in particular and their ability to navigate this environment. There are a lot of moving parts. Tariffs are not going back to zero, right? There will be higher prices. There will be a need to navigate a changing environment when it comes to supply chains. So we'll have to see how that plays out. And there's going to be parts of the economy that feel that stress. But no, I don't think we're turning into a recession.
It's the recession probability cheat guide, isn't it? 40, 45%.
And they move so quickly.
You get to the end of the year and you just say, you know, yeah, I told you, you know. I said 40, 45%. I didn't say it would be one. Didn't get one. Get one. I told you.
Yeah.
40, 45%.
I love it how people say that there's always a baseline probability of 15% recession.
Right.
And you should build on that. So how do you come up with these numbers? I don't really understand what they mean, but it sounds bad, I guess.
40's a favorite, isn't it? What's that about?
What I think is fascinating is how much they can change off of data and headlines. It's like, oh, we're shifting a little bit in this direction.
So a lot of changes after the weekend.
So but the reality is that I understand why. As a forecaster in this environment, it's really hard because you are looking at the incoming data and then you have to make assumptions for
but
where
you're
things
actually
are
trying to
going
forecast. That's the difference. I'm talking about people that just sort of throw out there 40%.
Yeah, it sort of sounds
45.
vaguely maybe bad.
Yeah.
So be careful.
I know what I'm talking about. 45%. Michelle, good to see you. You know what you're talking about. Michelle Meyer at the MasterCard Economics Institute. And so does Stevie Cohen, of course. You know,
He does.
I'm not throwing
and let me
shade.
tell you,
I'm just
he's
saying.
done a great job with the Mets.
Yes.
Can I just say, Uncle
Okay.
Stevie has done really well.
All right, go Mets or whatever that's
Thanks.
about.
Good.
Okay, all
That
right.
was good. I really like that.
Up next, Samir Samana of Wells Fargo, JP Morgan CEO Jamie Dimon, Neela Richardson of ADP, Christina Campmany of Invesco. From New York, this is Bloomberg.
You have had a number of games overseas in recent years, and in fact, you opened the season going to the opening game in Brazil. So do you expect to do more overseas games, and is that a part of your strategy?
It is. We had 5 last year. We expect to have 8 this year, which will be the highest we've ever had. Our hope would be at some stage to get to 16 games in the next few years. We think we could do that. I think it's an indication of the popularity of our game. Every time we take our game to a new market, Brazil's a great example of it, the fans go crazy for it. They sold out the tickets in less than 90 minutes. People had a wonderful time. It was the talk of the town. And it will be the basis and the sort of the match that lights the excitement and the popularity of the game in that market, as well as what we're doing around the world. So we're very excited by it. It's just one element of that strategy. You need to have television. You need to have activity and participation in the sport, and flag football is a big part of that. So all of those factors, I think, are going to be what we think will be a very successful formula to be a global sport.
Do you ever envision having a team that's based overseas in Mexico City or in London?
Listen, we've talked an awful lot about it, and I think there are markets that could, without question, support an NFL franchise.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
I just don't see any significant catalyst to the upside in terms of earnings growth or economic growth.
Our forecast for GDP is below trend. Much of that comes from a drag on the consumer.
The consumer appears to be continuing to spend. They're very healthy.
We're still talking about an environment where we have higher tariffs, potentially lower growth.
The next couple months could be a surprise.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Go Mets, are you serious? So I've got to level this up and say, go Yankees.
This is ridiculous.
Anne-Marie, throwing in some abuse.
Yeah, from overseas, from the Middle East. Yeah, nice
try. Work through every single franchise in Major League Baseball just to keep people happy.
Oh, yeah.
Equity futures on the S&P look like this. Let's turn to the markets. We're down by 0.4% on the S&P 500, softer by 0.5 on the Nasdaq 100. In 30 minutes' time, make it 29. You'll get US retail sales and jobless claims. PPI 2, data in focus. And this is a data point we've talked about repeatedly. Earnings from Walmart. Numbers were pretty decent, but the quote we had from the company earlier on this morning getting a lot of attention. For how much longer can they absorb tariffs without passing on higher costs? This from the CEO. We'll do our best to keep prices as low as possible, but given the magnitude of the tariffs, even the reduced levels announced this week, we aren't able to absorb all the pressure.
And Walmart, given that they are the biggest retailer in the world, giving a free pass to other retailers to do the same. Because if they all do it together, then they're in it together, and that is just the new price. This is the reason why the data that we get in a half an hour is going to be so important. How resilient is that consumer? How much are they continuing to spend? How much do they still have jobs and are not getting laid off? Which means those prices can be passed on to them. They can absorb them and still buy things even though the prices are higher. And this is what the Fed is going to be watching as they figure out how that path goes forward of the rate.
Lisa, as you know, there's been this massive disconnect between the soft data, how people feel, and the hard data, what they're actually doing. retail sales is going to be a perfect example of that potentially. The consumer's been telling us now for months they don't feel good about the situation. Retail sales has been holding up. Is it the same story at 8:30 Eastern Time?
This is the reason why core retail sales is going to be really key for a lot of people. How much are people continuing to spend in the same way that they've been spending over the past few months? But what we just heard from Michelle Meyer is there has been no change. What we have heard from an ongoing number of guests has been they have not seen a material pullback. We heard that yesterday from Holly O'Neill of Bank of America. So do we see that in the numbers? And then what does this mean going forward? Is that a good thing or is that a bad thing for markets that are a little concerned about this stagflationary mix of slowing growth and higher inflation that comes from sales of goods that are going to have to be priced at higher levels?
The latest economic data just around the corner. Equity futures going into it softer by just a third of 1% on the S&P following a 3-day winning streak. Coming up on the program, Samir Samana of Wells Fargo with stocks looking for that 4th straight day of gains. Christina Campmany of Invesco reacting to the latest retail sales data, and moments away from an exclusive conversation with the JP Morgan chair and CEO, Jamie Dimon. All of that and more this hour. We begin this hour with stocks lower as the rebound rally loses some steam. Samir Samana of Wells Fargo writing, after the recent rally, is the S&P 500 ahead of itself? We see limited upside from here in the near term. Expect volatility as the tariff story plays out. Samir joins us now for more. Samir, welcome to the program. When you say as the tariff story plays out, how do you think it does play out?
So I think the part that maybe the markets are missing, or maybe it's taking that advice about being a goldfish too much to heart, is that, look, we started the year with basically de minimis tariff rates, and now we're much, much higher. Now, I don't know where the tariff rates will land exactly because there's a lot of delays, there's a lot of back and forth, but suffice it to say, they will be higher than they were where we started the year. To me, that means a couple things. One, the earnings number that we started the year with, around 275, will be lower. And then two, the fact that the S&P is back where we started the year is probably about as good as it gets. So now, with us pretty close to the year-end target of 6,000, I think it's a good idea to maybe, take a little bit of money off the table, put it into cash, put it into maybe fixed income where yields are starting to back up. So I think that's the right thing to do going into the summer.
Well, Samir, let's get to where, how, and how much. If we are going to see a deceleration in growth from 2 to 3%, maybe to 1 to 2, doesn't have to be drastic, doesn't have to be a recession. Which part of the equity market is most exposed to that deceleration?
So in the U.S., it's got to be small caps, right? I mean, that's the area that hasn't really played in, kind of the best of times, and I can't imagine it playing during the worst of times. Outside the U.S., I would say that's emerging market equities. I think people are still much too sanguine on the risk to emerging markets with kind of this global reordering of the trade picture. And then I would also say that consumer discretionary, even if the consumer was to hold in okay, the thing is somebody's got to pay the taxes with respect to tariffs, and it might end up being consumer companies.
It seems like you think the old playbook is applicable in this new moment of a tariff regime. Samir, you talk about buying bonds, buying income, and going back in some ways to the United States if you're worried about the emerging markets equities. I'm just wondering why you think that playbook will work this time around.
So it comes back to composition. I mean, if you look at the fact that the U.S. market is so tilted towards kind of those growth companies with those secular drivers, I mean, one of the things that we can take away from earnings season is that the AI story is still very much intact. And so it's one of the few areas that you can still access growth, and they have that cash flow and those really strong balance sheets. So I guess we're looking at it as that's the best way to participate in further upside if it happens. But if there's downside, you've got kind of those stalwarts, which can kind of rely on kind of the strength of their balance sheets if there's a bigger downturn.
How concerned are you, Samir, that those stalwarts will not be stalwarts in the next cycle? And I say this at a time where we were talking to Jim Zelter earlier of Apollo and said the tail risk right now is of a Liz Truss moment in the United States, of some sort of disruption in bond markets in the face of big fiscal deficits, potential inflation, or even stagflation. Why do you reject that?
So I think it's possible that you could see higher bond yields due to term premiums, et cetera. It could be that valuations in some of those growth areas do get reset. I think the tricky part is, look, none of us are using less technology in our lives, right? And so from the standpoint of a secular growth driver on the earnings side, I guess that's maybe what I would rely on. Now, to your point on valuations, we recently upgraded tech on April 4th, right in kind of the throes of the downturn. So yeah, we wouldn't buy those areas at any multiple, but I think if you can get them on the right pullback, I think they make a lot of sense.
We're back to discussing defensive properties of tech stocks, Samir. Lisa's been talking about this all morning. We all have the bond market. Can you run us through the so-called defensive properties of the bond market? And when you said take some money out of equities, you were very precise with your language. You said go to cash. You didn't say take on duration in the bond market and position for an economic growth slowdown that would support fixed income. What's the difference between the call, Samir? Why not go out and take on some duration?
Yeah, just the problem is you're not getting paid for the risk, right? We talk often about how there's like a growth premium and an inflation premium and a term premium, and then you could argue there's kind of an uncertainty premium that should be, available kind of on the long end of the bond market, and it's slowly normalizing. But if you look at term premiums, they're still historically low. So for us, it still makes much more sense to be kind of on the shorter part of the curve, maybe the intermediate part of the curve, because you can get much of the yield. It's not until, to your point, recession that you really want to access kind of that long end, and we're not in that camp. We do think the economy moves closer towards, kind of a stall speed, which does make it vulnerable to shocks. But really, because of kind of some of the issues around deficits and debt, you don't want to own bonds except for kind of episodically.
Samir, you said that it's a time to maybe shed risk around the margins, but this is as good as it gets. How bad could it get? I mean, is this something that you're expecting to be really a negative picture, or just that there could be a bit of a better entry point, or just a sell-off that you want to buy?
I mean, the tricky part is so fluid around tariffs and tariff rates and kind of what eventually kind of makes it through kind of the gauntlet of the negotiations. I would say at the very least, you should see some kind of retracement. Wouldn't surprise me if we saw 53, 5,400 again. Now, that being said, if there's some kind of worst case scenario where there's just no deals, or a lot of the deals are really just on paper, but they don't actually show up with respect to rolling back tariffs meaningfully, I mean, it wouldn't surprise me if you had kind of a full retest. But again, I think that's right now more of an edge case than the base case.
Samir, I just want to finish on what we heard from Walmart and that quote that we got from them about passing on higher prices, and pair that with what we could get from Washington, D.C. with a tax effort. Do you see enough support down in Washington to continue this economic resilience that we've really underestimated now for years and years coming out of this pandemic?
I mean, the tricky part is, look, there's winners and there's losers, right? I mean, it's clear to see that consumer companies and consumers are probably the losers in tariffs. Now, that's not to say that there won't be some shouldering on the part of international producers and international companies. And then there's kind of this wealth transfer where those kind of tariff rates get retranslated into lower tax rates for corporations, maybe, higher income earners. I think the tricky part is at the end of all of that, what are you left with? And I think it's a slower economy.
Samir, appreciate the update on your thoughts. Samir Samana there of Wells Fargo. Looking for a slower economy, not a recession, a slower economy. And there's a difference.
There's a big difference between recession that almost is a washout moment and something that's stall speed that leads to both higher inflation and slower growth, lower margins for companies. This is kind of what we're grappling with as we hear some of these earnings reports, particularly from the retailers.
Which is why the tax bill is so important down in Washington.
Completely.
Extending current law, as Neil Dutta of Renmac and many others have said repeatedly, is just removing a potential headwind. You go above and beyond that, then we can start talking about a tailwind. How much of a tailwind is this tax bill actually going to provide this economy in the years to come?
Can it provide a tailwind without also providing the headwind from the bond market? I know this sounds a little bit like head spinning, but at the same time, if they do pull forward all the sweeteners, you end up with a deficit that's a lot bigger. You could end up in a very different situation than, say, 5 years ago when rates were basically from zero.
Let's get you an update on stories elsewhere this morning. Let's cross over to Yahira Anand with your Bloomberg brief. Hey, Yahira.
Hi, John. Some New York Republicans are signaling that an $80,000 SALT cap may be on the table in President Trump's tax package. Several lawmakers even threatened to reject any package that does not include a sufficient increase. Representatives LaLota, Stefanik, and Lawler are some of the key Republicans pushing for that increase. Meanwhile, a check on Walmart shares, those are up about 0.4% in the pre-market after it reported first quarter sales and earnings that beat analyst estimates. Despite the strong results, the company warned tariffs and economic uncertainty will lead to price increases starting this month. And United Health is under criminal investigation for possible Medicare fraud. That's according to the Wall Street Journal, which is reporting the Justice Department has been probing the company's Medicare Advantage business since at least last summer. United Health said in a statement late yesterday that the DOJ had not notified it about the reported investigation. That's your Bloomberg brief. John?
Yahira, thank you. Thank you very much. More from Yahira later this hour. Up next on the program, an exclusive conversation with the JP Morgan Chase CEO, Jamie Dimon, from his company's Global Markets Conference in Paris, France. From New York City this morning, good morning.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Equity futures slightly softer. We're down by 0.4% on the S&P 500. On the Nasdaq, we're down by 0.6. In 16 minutes' time, U.S. retail sales. Lisa, those numbers drop just after we got numbers from Walmart an hour ago.
The key question here will be how much is that resilience in the U.S. consumer going to absorb the price increases that Walmart says that it has to make, given the fact that their margins cannot absorb the entire effect from tariffs.
For a deeper conversation on the economy, on markets, on the state of banking, I'm pleased to say that Bloomberg's Francine Lacqua is at the JP Morgan Global Markets Conference in Paris with a special guest. Hey, Fran.
Yeah, a special guest, John. He's called Jamie Dimon. He runs JP Morgan, and I'm delighted to speak to him. Jamie Dimon, thank you for joining us.
Francine, happy to be here.
Hey, there's a lot going on. It's trade wars, markets up and down. What did you learn in the last month?
Not much, other than we have all this uncertainty. You know, some preceded the new administration, like we had large deficits, interest rates going up, inflation going up, and some are, you know, tariffs and things. And of course, the geopolitical situation is very tense, very difficult, and hard to resolve.
Okay, so if you forget projections, numbers, what's your hunch? Is the U.S. going to go into recession or not?
Look, I'm going to defer to economists who give it about a 50% chance. I think all these things are probably inflationary a little bit more and slowing down the economy. If there's a recession, I don't know how big it'll be or how long it'll last. Hopefully we'll avoid it, but I wouldn't take it off the table at this point.
If you look at, you know, the trade war and then the somewhat reconciliation between the U.S. and China, does it hold?
I think it's the right thing to do is to back off of some of that stuff, you know, to have an engaged in conversation. I'm grateful they did the U.S.-UK deal. You know, it's an agreement in principle, so, you know, there's a lot of uncertainty still. And there's a lot of uncertainty still in the China thing, but at least we started. It obviously calms down the markets. That's not the reason to do it, but the markets, you know, do vote and something like that, and so you'll still have uncertainty to resolve. There's 90-day triggers in a lot of these things, and hopefully they will be resolved. But they're complex. I don't expect immediate resolution, you know, to the satisfaction of everybody in 90 days.
But you expect markets to settle from here because we have a little bit more of a blueprint, or could volatility pick back up at any second?
You know, markets are quite unpredictable. I think there's a lot of uncertainty out there that you can't discount. You know, war in Ukraine, terrorism in the Middle East, you know, Iran, you know, huge deficits, our tax bill, which I would like to see a good tax bill passed. You know, the tariffs, the reaction of countries to tariffs. The EU and the UK are about to negotiate, and I think they have a chance to actually develop a great relationship, you know, partially making up for, you know, the disaster that Brexit became. And so, yeah, those are uncertainties. You can't eliminate them because you want to.
But what are your biggest clients saying about this market volatility? Have they made money on the back of it?
Yeah, some do and some don't. And, you know, volatility could be good or bad depending on, you know, who's facing it. So, but I would expect continued volatility. I think it's a mistake to think we can go through all the things we're going through and the volatility itself will come down.
Has it been good for JP Morgan? What's your, you know, trading revenue looking like?
Yes, because when there's volatility, this is a very simplistic way to look at it. Spreads gap out and traders make more money if there's more volume. So we had both this time, more volatility, more volume. But very often when you have a lot of volatility and spreads gap out, there's much less volume. So you've seen examples where there's good volatility and there's bad volatility. This one happened to be good. The next go around may not be so good.
Jamie, when it comes to financials, I mean, a lot of, I guess, non-bank entrants are making quite a lot of way. Citadel, Jane Street. Is that a concern for the banks? Should it be a problem for the banks?
I wouldn't call it a problem. They're both clients and very capable. But I've always had the view there are a lot of competitors out there, and all the major banks are back. I think that's a good thing for the world. Maybe not so much for J.P. Morgan. You mentioned those two. There's Apollo. There's a lot of fintechs, some very good ones. There's Stripe. There's PayPal. Yeah, my view has always been the same. I tell the management team, assume competition. Assume they're coming at you in every angle. Assume they often have their own strengths, sometimes their own weaknesses. They won't all do great, but yeah, I think they're, some of these people are gaining quite a bit of share in parts of their business. We still are too, by the way. So, we're in the fight. We're not losing out very much, but that doesn't mean you won't lose out tomorrow because you're winning today.
So what do you have to do today? How do you see the people that are doing, well today doing even better tomorrow?
Are you talking about us or other people?
Both.
It's quality of people. You interviewed Pranav. I mean, we have exceptional people in investment banking and sales and trading. And I put right next to that technology, but it's related because those people deploying technology. So there are thousands of technology projects, and then there are hundreds of AI projects, all of which are meant to do a better job for customers, consumer, research, how we deliver things to people. And if you don't move, you're going to be left behind. I mean, I remind you, you could be a country or a company, you do not have a divine right to success. We mentioned this management learning things I did. You can see it on YouTube and all that. But I point out to people, look at the bank, look at Nokia, BlackBerry, Sears, Kmart, Bear Stearns, Lehman. I can chapter up the verse of failed companies, usually because they're complacent, arrogant. They think they're, on the top of the, top of the world, and they're not. There are competitors coming everywhere, and you should assume that's going to be true.
Do you see competitors coming for the U.S.?
Yeah.
Where? Europe?
Oh, you're talking about the countries?
The countries, yeah.
Yeah, I think Europe. Let me just say this. I think Keir Starmer, Merz, and Macron. I think Macron is one of the best political leaders on the planet today. Okay, I think Keir Starmer is smart, devoted. They're saying the right things, public and privately. All of them talk about growing the economies. Thank God, pro-business, pro-capital, and they're doing all that to improve the lot of their citizens. It's not about what they're doing for J.P. Morgan. And if I was Europe, absolutely, I'd want to greatly have the UK, military, economic, and I would reform as best I can all of European things, what they're all talking about now, deregulation, simplification, and yeah, they try to compete with America, and that would be good for America. That doesn't make me sad. It makes me happy that they're strong. And then, they're allies. I want our allies to be strong and powerful militarily and economically.
But do you worry about U.S. supremacy, actually? Exceptionalism?
Yeah, I never believe we're quite that exceptional. I mean, remember, America's an unbelievable country with freedoms and the gifts of God and, water, food, energy, and then the gifts of the founding fathers called freedom of religion, freedom of speech, freedom of enterprise. Those dwarf everything. And so we still have the most prosperous economy the world's ever seen, but the Americans shouldn't take it as a divine right to succeed either. We've slowed ourselves down with regulation, stupid bureaucracy. We haven't done budgets in years, so we shouldn't assume it's forever. I don't think we'll still be preeminent, militarily and economically for a long time, but if we don't do everything right, we could lose that too, 20, 30, 40 years from now. And I think very important to that is America. The goal of America should be to help the military alliances of the Western world and to help the economic alliance of the Western world to walk side by side like you did in Victory in Europe Day the other day here, to strengthen the Western world and hold it together, not to cause it to fragment. And so I think we have to work hard to make sure that's the case.
Do you worry about the deficits, and do you worry actually in the U.S., and do you worry also about the U.S. dollar remaining as a reserve currency? Do you think Europe has what it takes to try and put the euro in there?
Yeah, so I should have mentioned deficits up front as being one of the issues you have to deal with. And I think asset prices are quite high too, and those create various risks for America. Our deficit is almost $2 trillion, 6 or 7% of GDP, the largest peacetime deficit ever, and we have 100% debt to GDP. That 100% debt to GDP is kind of universal, almost around Europe on average, but your deficits are much smaller. Does that create a risk? Absolutely. It creates a risk of inflation to me. It creates a risk of higher long-term rates. But America, will the dollar get weaker? I don't know. That's a slightly different thing. I think you could see rates go up. The long bond rates go up, and that might slow down the growth, and that's how we kind of a stagflation kind of scenario.
What do you tell? I mean, you must see President Trump regularly. What do you tell? What would you tell him?
I talked to all of his. I talked to all of the folks there. I wrote about my chairman's letter. I mean, we have first of all, America should worry about things we can do better. I call it blue tape. I mean, we are out of control. We're doing the same stuff that they did here. That virtually, the American public may not know. The GDP per person in Europe has gone from something like 90% of Americans to 65%, and they did it to themselves. Rules, regulations, overcomplication. They started the European Union, which I think is a huge accomplishment of mankind. They got to finish it. And here they call it the capital markets union, the banking union. They have to create a big common market of 450 million people. And so in America, it's the same thing. It's regulations, it's permitting. We've wasted a lot of money in the green economy. It's getting jobs back. It's training in schools. It's fixing immigration. So we've stopped at the border, but now we have to have a more merit-based immigration, more seasonal immigration. Things that can help the country grow. And then we have to work on our military alliances, on our economic alliances, and that's for the sake of the future free and democratic world.
But so on the economic alliances, is there a concern that actually certain countries in Europe or elsewhere will choose non-U.S. bank for bond issuances, will choose non-U.S. asset managers to manage their pensions?
Yeah, there'll be a little of that. We irritate a lot of people. So I run into them. They say, like they're not buying our, Kentucky bourbon or something like that. There'll be some of that, and I think it's perfectly reasonable for. I spoke to a lot of investors here. They're thinking about their asset allocation to the United States. Will they diminish that? Possibly. Is America a bad investment destination? No. If you were to take all of your money and put it in one country, it would still be America. I mean, it's still the most prosperous nation on the planet. It's got the best military on the planet. It's got huge amounts of innovation. People are catching up. That's a good thing. China's doing some very good innovation in medical and AI, and we should assume they're going to continue to do that. But America's still got the best. Our GDP per person is $85,000. China's $15,000. We don't have anything to be ashamed about. We should fix our problems because we could grow a lot faster, which help all of our citizens.
But if you put out too many tariffs and actually too much uncertainty, does that not squander actually a lot of the assets that the U.S. has?
A little bit. I mean, I think they're doing the right thing now, which is to back off of it. Let the Secretary of Treasury do the hard work of figuring out what's the right thing to do. If there are unfair trade things, do something about it. But they have backed off of specific things in specific industries, and I think that's the right thing to do. I think the first thing was very large, kind of that everything, everywhere, all at once, and now they're, kind of backing to where I think they should be.
In terms
but even at this level, it causes that kind of uncertainty. Even at this level, you see people holding back on investment and thinking through what they want to do, thinking about, how much you're going to put in the United States. And, I mean, we're going to be okay, but it is causing that uncertainty.
We were looking at the president, of course, in the Middle East, where there were deals that were signed and a lot of Wall Street, some of your competitors there. What's your strategy for the Middle East? How much do you want to grow there?
Well, we grow everywhere. I mean, we go country by country. We look at, we bank countries, cities, schools, states, hospitals, big companies everywhere. We have a network effect. So when we bank Bloomberg, we're banking in the United States, we're banking you in London, we're in Paris, we're banking you in Europe, we're banking you in the Middle East. That's what we do. So almost every one of those countries, we're growing. As they grow, we grow. We cover, more of their institutions. Overseas, we're institutional. In the United States, we also have consumer. And so, as you know, we're testing consumer and Chase UK.
Yeah, and you're growing, actually, that retail business a lot in the UK. What's next for that?
We hope to grow it more in the UK, add some products, and eventually, we've already announced we're going to go to Germany. I think we have a chance to build a great digital bank, and we have competitive advantages. We have a brand, we have research, we have a balance sheet, we've got capabilities. We're going to add, we're not going to announce it today, we're going to add more capabilities over time so that, and then someone like you, if you travel to the United States,